Good morning, friends. Okay, so today we are starting with your costing revision. As I did in FM, costing also focus is going to be only problems, and problems. We are going to solve variety of questions. When we solve variety of questions, automatically the concepts get revised. And as I had said there, you will have to supplement it with later using the concept MCQ. So here also we will do questions, and then later on you may want to do concept MCQs which are there in my concept book. Here also we have four blocks. Block 1, which is the most important block. Then totally 15 chapters are there. In that 14 chapters are practical based, one chapter is fully theory based. In the 14 chapters also, some are very small chapters like unit and batch costing or job costing, which is very insignificant kind of chapters. So broadly the major chapters could be around 10. In that 10 major chapters, 7 chapters form part of block 1 and block 2. These 7 we will fully cover it in the revision. The 7 chapters, the first block 1 and block 2 will fully cover it in the revision. Block 3 is obviously the theory part. In block 4, if time permits, I may do process costing and maybe standard costing if time permits. That is little optional. But otherwise, the main focus would be on doing the first 7 chapters of block 1 and block 2, which together approximately is around 65 marks of the paper. Theory is another 10 marks, so 75 marks of paper is taken care of. Balance, if you just do process and standard itself, you will reach around 90-95 marks of preparation, and other small chapters are there. Even though small chapters, some of them are very related, like overheads, unit and batch, and job costing are kind of interrelated, because more or less what you do in overheads is what you do in the other chapters. Now in the block 1, we are going to start today with marginal costing. I think one of the bigger chapter may take away significant part of today's discussion. Could take around 5 hours, 4 hours, we don't know, but that is a starting chapter. Now I'm going to start with marginal costing. The chapter is slightly lengthier in nature because there are lots and lots of concepts which are there. It becomes the base for taking decision. So marginal costing focuses on classifying the cost into fixed cost, variable cost, and then assist in decision making. Now, in the chapter, there are a lot of formulae which we use. So, I'll first give one master formula. Once that master formula is given, then we start doing different questions, and I'll add on formula if needed. So, the master formula is, let's write that now. Let's start with the master formula. And this is your paper pattern. I think the paper pattern you would be aware of: 30 marks of MCQ, 70 marks of descriptive. In MCQ, there will be two case studies of 10 plus 10, and individual 5 MCQs will be there, which is another 10 marks. So they have started asking individual MCQs. And then the descriptive part is again theory becomes the last question. If you're confident, you will leave theory in choice. If you're not confident, you may be forced to answer the theory part. This is broad breakup of the paper pattern. Now let's write the master formula, right? Master formula of marginal costing. Break even sales. Are you right? Sorry, right. Fixed cost, fixed cost plus profit, fixed cost plus profit equal to contribution. Fixed cost plus profit is equal to contribution. Then leave some two lines or one line gap. Fixed cost break even sales plus margin of safety is equal to total sales. Break even sales plus margin of safety is equal to total sales. Break even sales plus margin of safety is equal to total sales. Fixed cost, I'm not sure how you will have space, divided by PVR is equal to, divided by PVR is equal to, divided by PVR is equal to. Fixed cost plus profit is contribution. Similarly, break even sales plus margin of safety is total sales. Now, what is the formula I'm talking about here is break even sales is basically the level at which I make no profit, no loss, which helps me in recovering the fixed cost. Margin of safety contributes towards earning profits of an organization, and overall sales, which gives overall contribution. Now, this gives multiple formulae. One formula for break even point is break even sales is equal to fixed cost divided by PVR. Fixed cost is equal to, if you write the formula interchange and write, so the formula is, one of the formula I write from here is break even sales is equal to fixed cost by PVR. PVR goes this side, fixed cost is equal to break even sales into PVR, or PVR is equal to fixed cost by break even sales. Similarly, margin of safety is equal to profit by PVR. PVR is equal to profit by margin of safety. Margin of safety into PVR is equal to profit. Like this, you can keep writing multiple formulae. Same way with the total sales. And I can say total sales is equal to contribution by PVR. Total sales is equal to break even sales plus margin of safety. Margin of safety is equal to profit by PVR. Margin of safety is equal to total sales minus break even sales. PVR is equal to fixed cost by break even sales. PVR is equal to profit by margin of safety. PVR is equal to contribution by total sales. So multiple formulae can come. Technically, I can end up writing 20 different formulae from this one's master equation. This master equation alone, you'll have to be very, very clear. The master formula can end up giving you 20, 25 different formula I can get from this. Similarly, the another master formula is the same thing. Contribution per unit instead of PVR. Contribution per unit. If you divide by contribution per unit, break even sales in units, MOS in units, total sales in units. We'll get everything in units. Fixed cost by contribution per unit is break even sales units. Profit by contribution per unit is margin of safety in units. Contribution by contribution per unit is total sales in units. So everything you will end up getting it in units. If you divide by PVR, you will get it in rupees, and if you divide by contribution per unit, you will get it in units. This is what the master formula is. Once you are aware of this master formula, you can keep using this in different situation. Clear? This master formula is what we are going to use it in many places. Apart from that, there are a lot other concepts which will get discussed, but this is one thing which we want to start with. Clear? Can we? Okay. Let's now see questions. Again, I think this chapter will have good number of MCQs, and they are very good MCQs which you can attempt it. Let's come to question 1. Following information is given by PQR Limited. Year, sales, profit or loss 22, 23, 23, 24. Calculate the break even sales. In 24, 25, it's estimated that variable cost will go up by 5%. Fixed cost will reduce by 4 lakh 80. Selling price will remain same. Calculate the sales volume to earn a profit of rupees 15 lakh. Two requirements are there. They've asked us to calculate break even sales and also variable cost, some changes, sales volume to earn a profit of 15 lakh. In this question, do we have information on number of units? Is there any data on number of units? No. What formula can I use here? Okay, whenever two period data is given, PVR, there is a formula called change in profit by change in sales. That will give me PVR, and with that I'll be able to do the entire question. Let's first do the marginal costing income statement. Marginal costing income statement. Particulars 22, 23 and 23, 24. Particulars in 2 years. We do not have information on number of units, else we will write units data also. Sales less variable cost, contribution less fixed cost, profit. Sales less variable cost, contribution less fixed cost and profit. Whatever they have given, let's write them. Sales given is 1 crore 80 lakh, 2 crore 40 lakh. Profit is negative 380, 1120. Negative 380 and 1120. PVR equal to change in profit. There are multiple formulae for PVR. One of them is change in profit by change in sales. Whenever 2 period data is given, change in profit by change in sales. What is the difference in profit of the 2 periods? Participate, guys. 15 lakh. Change in sales is 60 lakh. 15 lakh by 60 lakh. 1120 minus of minus 380. Difference is 15 lakh, and 2 crore 40 minus 1 crore 80. 60 lakh is the difference. PVR is 25%. Let's complete the table. Contribution 1 crore 80 lakh into 25%. 25%. 22 crore 40 lakh into 25%. Variable cost is balancing figure. Fixed cost balancing figure, you should get the same amount for both the year. If you don't get the same amount, then there is some error in the drafting or the formula application. Fixed cost is how much? 48 lakh 80,000. Any doubts on the table? Now we'll answer the two requirements which are there. Any doubts on this? Now, solution. First is break even point. Break even point is equal to, from the master formula, tell me the formula for break even point. Fixed cost divided by PVR. Fixed cost divided by PVR, 4880 divided by 25%. 4880 divided by 25%. We get 1 crore 95 lakh 20,000. 195.20. That's the break even point. Second part is variable cost will go up by 5%. Fixed cost will reduce by 4 lakh 80. Selling price will remain same. Sales volume to earn a profit of rupees 15 lakh. What we can do is, if I go through the equation, they have given profit. So I will consider this profit. There is some fixed cost. Profit plus fixed cost is contribution, which I want. I'll divide by the PVR. I'll get the sales. They want the sales. Volume here would mean value only. Volume is not possible to calculate because units data is not there. Only problem is PVR may not continue at 25%. The PVR, because there is an increase in variable cost. Questioner said there's an increase in variable cost by 5%. Fixed cost will reduce by 4 lakh 80. Next, come down. New PVR. new PVR, particulars earlier and revised, earlier and revised, earlier and revised, selling price, variable cost per unit. We don't have all this, but we'll assume something and do. Selling price, variable cost per unit, contribution per unit, PVR. Earlier it was 100 rupees, variable cost 75, contribution 25. PVR was 25%. PVR earlier was 25%, 100, 75, 25 and 25%. Now the PVR will undergo a change. Reason is, questioner said variable cost will go up by 5%. Variable cost will go up by 5%. So copy the same 100. Any change in variable cost means a change in variable cost per unit. Any change in variable cost means a change in variable cost per unit. Any change in fixed cost means a change in total fixed cost. 75 plus 5%. 78.75, 21.25. PVR now is 21.25%. Contribution per unit divided by selling price, 21.25%. Now right, sales to earn profit of 15 lakh is equal to, again from the master formula. What is master formula? Is profit plus fixed cost is contribution, divide by PVR is total sales. Profit plus fixed cost is contribution, divide by PVR is total sales. So profit I want 15 lakh, fixed cost is changing. What is the fixed cost number now? Fixed cost will reduce by 4 lakh 80. It will reduce by 4 lakh 80. So earlier the fixed cost was 4880. Now will reduce by 4 lakh 80. Fixed cost is 44 lakh. PVR is 21.25%. 21.25%. We get 2 crore 77 lakh 64,706. Clear? Any doubts on this? Clear? Can we proceed? Go through question 2. Okay. Any question on marginal costing, the first thing we need is something called as VC per unit and total fixed cost. That's the most important part. We are not bothered about material cost, labor cost, all that classification doesn't really matter. So here it's a Chinese soft drink company which is planning to establish a subsidiary company. Sales is going to be 40,000 bottles. Material cost, labor cost, factory overhead, admin, all I don't understand. I want variable cost per unit and total fixed cost. Also, one more variable cost is there, which is called commission. But commission I cannot write as of now because commission depends on the selling price. And part one is asking what should be the selling price to earn a profit of 10%. And second is what will be the break even point in units as well as in rupees with the selling price being given. Part one wants us to fix the selling price. Part two, the selling price is given. Let's start working note one. Computation of VC per unit and total fixed cost. VC per unit and total fixed cost. VC per unit is equal to, I can do it as a table, but I'm doing it as just a formula. Material cost entirely variable. Material cost is entirely variable, so 2,10,000 plus labor cost 80% variable, 1,20,000, 80% variable. Factory overhead 55, 200. Admin cost 40,000 into 35%, all divided by 40,000 units. 40,000 units. This is excluding commission. Commission we'll see in some time. VC per unit, deduct, divide by 40,000, 9.98. Then total fixed cost is equal to again nothing from material cost. Labor is 30,000. Labor is 30,000. Factory overhead is 92,000 into 40%, 36,800 and 26,000 was the total you get. Now we have got the two important information 9.98 and 92,800. Now question wants us to fix the selling price so that I can earn a profit of 10% on the sale proceeds in India. I don't know the selling price, but I want to fix the selling price so that I can earn a profit of 10 percentage of the sale proceeds in India. That's the requirement as of now. Problem is I don't know the selling price. Selling price will impact my commission figure. Now below this I can do an equation that is in the marginal costing income statement format. R as a formula. Now write total sales minus total cost is equal to total profit. Total sales minus total cost is equal to total profit. Total sales is 40,000 X. X is the selling price. 40,000 X. Variable cost is 399,200. Variable cost is 399,200. Fixed cost is 92,800. And commission is 8 percentage of 40,000 X. Commission is 8 percentage of 40,000 X. Commission is 8 percentage of the sale figure. X is the selling price. This I want a profit of how much? They have given the 10% of 40,000 X. Solve this. 10% of 40,000 X. 10% of 40,000 X. Total sales minus total cost is total profit. Let me know what's the profit figure you get. Sorry, X. What is X? 15 per unit. So if I fix the price as 15 rupees per unit, I will earn a profit which is equal to 10% of the sale proceeds. We could have done it like this also, that is in the marginal costing income format. X variable cost, commission, contribution, fixed cost, profit, net is going to remain same whether you do it this way or you do it the other way around. Answer is 15 rupees. Next, they've asked for break even point. Break even point is equal to fixed cost by contribution per unit 92,800 divided by, now for contribution per unit I have a different selling price here. It's not 15 rupees, it is 14 rupees. Now it is 14 rupees. So 14 minus 9.98 minus 8% of 14. 8% of 14. Commission is 8% of 14. This will give you in units 8 percentage of 14. What's the number you got? 32,000 units are multiply with the selling price. Both they've asked units as well as rupees. 32,000 into 14 rupees. 4 lakh 48,000. 32,000 or 4 lakh 48,000. Clear? Any doubts in this? Done. The focus is always getting FC per FC total fixed cost and VC per unit. VC per unit and total fixed cost. Once these two numbers are in place, any kind of question can be handled. Any doubts in this? Go through question 3. Okay. PQR has furnished the following data for the 2 years: sales, PVR, MOS, substantial saving in fixed cost. Company could maintain its quantity and they've asked for certain information of 2012. We'll do a marginal costing income statement of 2011, 2012. Again, units data is not there. There's no units information. We have only overall values. So we will do particulars 2011, only one column 20. If units is there, per unit and total will be needed. So let's open particulars, marginal costing income statement. Particulars 2011 and 2012. Sales less variable cost, contribution less fixed cost, profit. Analysis is only for 2012. I'm doing 2011 also in case it helps us in something. Sales less variable cost contribution less fixed cost profit. We'll keep writing whatever information is available and then see the solution. I have sales 8 lakh, sales 8 lakh. 2012 we'll have to find out the sales. PVR is 50%. So 8 lakh into 50% is contribution. Variable cost balancing figure 4 lakh. They have given margin of safety. Once you have margin of safety, what you can do is margin of safety PVR will give you profit. Margin of safety and PVR combination, that is MOS into PVR, will give you profit. MOS into PVR will give you profit. So profit is 8 lakh into 40% into PVR 50%. 8 lakh into 40 into 50, 1 lakh 60,000. Fixed cost balancing figure 2 lakh 40,000. Technically, the entire analysis of 2011 is of no use, but I have done it. Now, coming to 2012, they have said there has been a substantial saving in fixed cost. If this line was not there, I would have copy pasted the fixed cost. The company could maintain its quantity of 2011 in 2012 by reducing the selling price. If, for example, last year we charged a different fees, this year we charged a different fees, and number of students remain same. If number of students remain same, our overall printing cost will remain same. Our overall cost for the students will remain same. So if quantity is remaining same, variable cost will continue to be 4 lakh rupees. Variable cost will continue to be 4 lakh rupees because we have sold the same amount of quantity. If quantity goes down by 10%, overall total variable cost will also go down by 10%. Total, I'm talking about total variable cost. At a per unit level, variable cost will remain same. At a overall level, variable cost changes with the number of units. Here, they have not talked about any change in variable cost. Only thing they have told is quantity has remained same. If quantity remains same, overall variable cost will continue to be 4 lakh. If they said quantity has doubled, variable cost would have doubled. From 4 lakh, it would have become 8 lakh. So copy paste 4 lakh. And then I get to know PVR is, which means variable cost is 62.5. PVR is 37.5. Variable cost is going to be 62.5. So 4 lakh divided by 62.5. Variable cost is 62.5 percentage of the sales. This is 62.5 and contribution is 37.5. What is the sales number you got? Contribution 2 lakh 40. Same logic here. Sales into the margin of safety, into the margin of safety. What is the margin of safety percentage? Into the PVR. PVR is now 37.5. PVR is 37.5. Fixed cost balancing figure. Fixed cost is balancing figure. How much? 187,500. The question had asked for sales for 2012 done, fixed cost done, break even sales of 2012, fixed cost by PVR 187,500 by 37.5%. Formula, master formula, be very clear. From there we'll keep writing the formula. I'll not keep going back to that area. From the master formula we'll have to keep writing 187,500 by 37.5%. Break even sales is 5 lakh rupees. Any doubts in this? Clear? The quantity was maintained. If the quantity is maintained, total variable cost will remain same. Go through question 4. Okay. A meeting of head of department of Arnav Limited has been called to review the operating performance in the last financial year. Head of the production department appraised that during the last year, company could operate at 70% capacity. Now they want to increase the capacity to 95%. Because of this, there will be an extra capital expenditure of 100 crore. Head of the finance department said that last year PV ratio was 40%. MOS and break-even point is given. This will help us in calculating certain information. And overall sales is 50 plus 200, 250 of the last year. To the reply to the proposal of increasing the capacity to 95, head of the finance manager as department has said that selling price and variable costs are reduced by 8 and 5%. This word off sales will make a big difference. I'll explain that as we proceed. Fixed cost will also increase by 20 crore due to depreciation, and there will be some interest cost to be paid. And also I want to increase profit by 10 crore. What will be the revised sales of the coming financial year? Break even point, margin of safety, profit of the last year, profit of the coming year, and total cost of the last year and the coming year. Let's try to do an income statement. Again, per unit data is not possible. Particulars last year, current year. Particulars last year, current year. Last year, current year. Last year and current year. Sales less variable cost, contribution less fixed cost, profit. Last year sales is 200 plus 50. Break even point plus margin of safety. Break even point plus margin of safety. 200 plus 50, 250. 200 plus 50, 250. Variable cost, last year they have given PV ratio is 40%, had a PV ratio of 40%. Second para had a PV ratio of 40%, margin of safety 50 crore, break even 200 crore. So contribution is 250 into 40%, variable cost 150. Fixed cost from the master equation, fixed cost can be called as your fixed cost is equal to break even sales into PVR. Break even sales multiplied with profit volume ratio, multiplied with profit volume ratio. What is the break even sales of the last year? 200 into 40%. Profit is 20. This was all last year information. In the current year, there is a proposal of doing some expansion and all, and one crystal clear is I want an additional profit of 10 crore over and above the last year profit after adjusting the interest cost. Even interest has to be considered in the calculation. Normally costing ignores interest. Marginal costing is decision making area. So here they are saying after considering the interest cost, I want a profit improvement of 10 cr. So next year profit is 20 plus 10, 30. Fixed cost is 80 plus. Read the question and tell me what are the addition in fixed cost. There are some increase in fixed cost. 20 crore due to depreciation. Another increase is there. Interest will also come in the calculation. Interest will also come in the calculation. We have to pay interest of how much? Sorry? Oh, 100 crore into 15%. 100 crore into 15%. I need 100 crore for capital expenditure into 15%. 100 crore plus 15%. So plus 15. Put together fixed cost is how much now? 115. Contribution is 145. Reverse working. Now listen. It's a very important explanation. It says selling price and variable cost are reduced by 8% and 5% of sales. That of sales word makes a difference. If that word of sales was not there earlier, earlier it was like this: 100, 60, 40, 40%. 100 goes down to 92. 100 goes down to 92, 8% dip. 60 goes down by 5%. Subtract 5% and tell me. 60 minus 5%. 35. 35 by 92 is how much? 35 by 92 is how much? Into 100. Into 100 to express in percentage. 38 point. This is what I would normally take if they say selling price has gone down by 8%, variable cost has gone down by 5%. Now, what they did is the selling price change, I say did not pay any attention itself because it doesn't matter. It says ignore the selling price word. Variable cost is reduced by 5% of what? Sales. Variable cost cannot go down on sales. Variable cost can go down only on the variable cost. Of sales means variable cost ratio. Variable cost ratio. What is of sales is variable cost divided by sales is called variable cost ratio. Earlier, the variable cost ratio was 60%. Now it will go down directly to 55% after the fall in price. This indirectly mean selling price would have gone down by 8%, variable cost could have gone down by some 12-13%, and the ratio is going down by 5%. The ratio is going down by 5%. What is the impact of this? Variable cost ratio from 60 goes down to 55. PVR from 40 goes up to 45. PVR from 40 goes up to 45. So below the table, right? Variable cost of sales in bracket VCR. Variable cost of sales VCR declines by 5%, and hence VCR increase from VCR decrease from 60% to 55%. What is 60 is 100 minus 40. This will mean PVR increase from 40% to 45%. Now we can get sales 145 by 45%. 40 has become 45. 45%. 322.22. Variable cost is balancing figure. 177.22. I'm not going to even answer the MCQ part. If needed, we'll answer, but otherwise, the table is done. We'll have to use the mastery equation and then get to the answer. Any doubts on this? Clear? The question had asked for what is the revised sales? 322. Revised break even point, you'll have to use the formula fixed cost divided by PV ratio. Revised margin of safety, profit divided by margin of safety. Profit of last year 20 crore, this year 30 crore, 20 and 30. Total cost of last year, coming year, you'll have to add up the numbers and then write it. Clear? Any doubts on this? Any doubts on this part? Then go through 5. Okay. Arnav Limited manufactures and sells its product. Following figures have been collected from cost records of last year. Variable cost, fixed cost. We don't understand all this. I need VC per unit. Total fixed cost. Total fixed cost is available there. But VC per unit, I need to know what is COGS and COS to get this. COGS is this plus this plus this plus this. All of this is COGS only. Somewhere I'll get the COGS with that. Once I get the COGS plus selling and distribution overhead is cost of sales. Once we get these two numbers, then I'll get VC per unit, total fixed cost. Balance is just a formality for us to close. I have to get COGS number and COS number, cost of goods sold and cost of sales number. Working note 1, computation of VC per unit and total fixed cost. VC per unit and total fixed cost. COGS is equal to, we'll add the first 5 items. COGS is equal to 30 plus 15 plus 10 plus 2. The first 4 items is COGS. 30%, 15%, 10%, 2% plus 2 lakh 30 plus 71,000. So COGS is equal to 57 percentage of COGS plus 230 plus 71. Solve and let me know the COGS number. 57 percentage of COGS. 230 plus 71. Get the COGS number. How much? 7 lakh. Cost of sales is equal to COGS plus selling and distribution overhead. COGS plus selling and distribution overhead. Cost of sales is equal to, admin overhead is part of COGS because it said admin overhead relating to production. Relating to production will form part of COGS. Cost of sales is equal to 7 lakh plus 4% of COS plus 68,000. Solve and get the cost of sales figure. 4% of COS. That's all. We are kind of done with the major working. Cost of sales is 8 lakh. In the 8 lakh figure, 3 lakh 69 is fixed, balance is variable. 3 lakh 69 is fixed, balance everything is variable. 3 lakh 69 is fixed, balance everything is variable, and I want VC per unit. I don't want total variable cost and all. So next line, total fixed cost is equal to 230 plus 71 plus 68, 3 lakh 69,000. Four lakh 31,000 or 86.20 per unit. I want per unit number only. I want per unit number only. 4 lakh 31,000 or 86.20 per unit. We are kind of done with the major working which is needed. Always focus on getting VC per unit and total fixed cost. Any doubts on this? 431 or 86.20 per unit. Next, they said break even sales is to be calculated, profit is to be calculated, margin of safety is to be calculated, profit. All this we'll start doing it now. Solution, working note to solution. First requirement is break even sales. They have specifically asked in rupees, break even sales in rupee. Anyone's vehicle 4324, you have to repark. Break even sales, fixed cost by PVR, fixed cost by PVR, fixed cost by PVR. In that, let's get the PVR. PVR is equal to contribution per unit by selling price into 100. Contribution per unit by selling price into 100. One 95 minus 86.2 divided by 195. Keep it more decimal to have accurate answer. 55.7949 percentage. 55.7949 percentage. 7949 percentage. Any doubts on this? Here, fixed cost is 3,69,000. Six lakh 351. Clear? Next requirement is profit. Profit is very simple. Total sales minus total cost. Total sales minus total cost. Profit is very simple. Total sales minus total cost. 5,000 into 195 minus 8 lakh into 195 minus 8 lakh. How much? 1 lakh 75,000. Master formula will be very clear. Then margin of safety in percentage. First MOS in rupees. How can I get margin of safety? No. Total sales minus break even sales. You can do profit also, but total sales minus break even sales. We already have the total sales. Just deduct the break even sales. Profit also can be done, but this is already available. 9,75,000 minus 661 351. How much? 3,13,649. Then MOS in percentage. They want in percentage. 313 divided by the overall sales. Divided by 9,75,000. Percentage 32.17 percentage. Clear? 32.17 percentage. Then last is profit with 10% lesser sales. Profit with 10% lesser sales. If sales go down, number of units sold is going down. So what we can do is profit is nothing but total contribution minus fixed cost. Profit is total contribution minus all, everything is going to come from that master formula only. Total contribution minus fixed cost. What is total contribution? Is 4,500 units into 195 minus 86.2 into 108.8 minus 369. 4,500 into 108.8. 1,20,600. 120,600. Clear? Any doubts on this? Go through question 6. A slightly lengthy question. Okay, let's read this now. XYZ Manufacturing Private Limited is a prominent company in the electric appliances industry known for producing a diverse range of high quality product. Company has built a reputation. Okay, first para, only one information which could be useful is 25 days a month. That also not sure, but that's the only information. Then fixed cost, factory rent, depreciation, admin expense, salaries, total fixed cost. Number of units produced per month is 10,000. Last month there was some extra order of 2,000 units which resulted in higher production, but normally we produce 10,000 units. Selling price per unit is 1,500. Additional information, we'll have to somehow analyze this properly. Raw material include copper, plastic and other material. Per unit cost of copper is 80 more than the cost of plastic. Per unit cost of copper is 80 more than the cost of plastic. Let's write as we read it. Question 6. Copper cost is equal to plastic cost plus 80 rupees. Plastic cost plus 80 rupees. Per unit cost of copper is 80 more than the cost of plastic. Cost of other material. Cost of other material. Plastic cost into 2. Twice that of plastic. Cost of other material is plastic cost into 2. And total raw material cost per unit is 210. Total raw material cost per unit is 210 more than the combined cost of copper and plastic. Combined cost of copper and plastic. So total RM cost is equal to 210 plus copper cost plus plastic cost. Copper cost plus plastic cost. More 210 more than the combined cost of copper and plastic. This side, what is total raw material is copper cost plus plastic cost plus other material is equal to 210 plus copper plus plastic. Copper plus plastic. With this, we get one of the information. What is the cost we get? Which cost we get here? No. Other material. Other material is 210 rupees. Other material is 210. Copper plastic got cancelled in both the places. Other material cost 210 per unit. Substitute here and tell me the plastic cost. Other material cost is 210 per unit. Yeah. 210 is equal to plastic cost into 2. Plastic cost is equal to 105. Substitute in the first one. Copper cost is equal to 105 plus 80. And finally, total raw material cost is copper 185, plastic 105, and 210 of other material. 210 of other material. They have given about in a little roundabout manner. 185 plus 105 plus 210. All put together how much? 500 per unit is the raw material cost. Clear? Then it says the labor rate is rupees 100 per hour. Labor rate is 100 per hour. Labor hours used in the last month is 36,000, and last month we produced 10 plus another 2. 10 plus another 2. Last month there was some special order of 2000 units. Normally we produce 10,000 units. Last month some special order came. We produced more units. 12,000 units we produced in the last last month, and that took how many hours? 36,000 hours. That took 36,000 hours. Next, labor cost per unit is equal to labor cost per unit is equal to labor cost per unit is equal to 3 hours into 36, sorry, not 3 hours, 100 into 36,000 by 12,000 units. 300 per unit. Labor cost is 300 per unit. Labor cost is 300 per unit. Clear? And apart from this, we have other variable cost. Some utility 100 rupees, packaging cost 50 rupees. I think now almost the question is done. We'll then start answering the MCQs. They have drafted it well. Total, or that is VC per unit, is equal to 500 rupees, 300 rupees and 150 rupees. 500, 300 and 150, 950 per unit. Any doubts on this? First requirement is contribution margin per unit. Contribution per unit is equal to, what's the selling price? 1500 minus 950. 1500 minus 950. How much? 550 per unit. Part 1 is done. 550 per unit. Second is break even point in revenue. Break even point is fixed cost divided by PV ratio. Fixed cost divided by PV ratio. Fixed cost is 10 lakh. PVR is equal to contribution per unit by selling price. 550 by 1500. Contribution per unit by selling price. 36.6667%. Contribution per unit by selling price. Any doubts on this? Clear? Get the break even point. What's the formula for break even point? Fixed cost by PVR. Fixed cost is given in the question, 10 lakh rupees. Total fixed cost. Twenty-seven, 271. I think it'll be maybe this 27,025. Rounding of differences can be there. 271 I'm getting. It'll be 27,025. Any doubts in this? If the company wants to earn a profit of 5 lakh, what will be the sales volume in units? We'll go back to the master formula. If you want a profit of 5 lakh, profit plus fixed cost will give you contribution, divided by contribution per unit will give you total sales, divided by contribution per unit, because they want units. So profit plus fixed cost will give you contribution divided by contribution per unit. Next, sales to earn profit of 5 lakh. Of 5 lakh, profit plus fixed cost by contribution per unit. 5 lakh plus 10 lakh, contribution per unit is 550. 27, 2727 units. What will be the impact on variable cost if the VC per unit increase by 10%? VC per unit is increasing by 10% and they have given answer in units. So let's calculate the new break even point. Variable cost is going to increase by 10%. Next, new break even point is equal to fixed cost by contribution per unit. Fixed cost by contribution per unit. Fixed cost by contribution per unit. Fixed cost number is 10 lakh. 1500. 110% of 950. There's an increase in cost. 110% of 950. Increase in cost. Two one nine eight. If they had given answer in rupees, we would have done with the PVR. PVR will change. PVR will undergo a change because VC is undergoing a change. Margin of safety if the company sells 4,000 unit and if the variable cost per unit increase by 10%. If it's increasing by 10% and it says sells 4,000 unit, I need not do any extra calculation. I already know BEP. MOS is 4,000 minus BEP. MOS is 4,000 units minus the break even point. So MOS is equal to 4,000 units minus 2198 units. 4,000 minus 2198. 4,000 minus 2198. 19. Ideally, this should have taken care, but they have answered it in percentage because requirement is in percentage. R Divide by 4000. 45 point, which is the third option. Clear? The most important part was to analyze this cost properly. Once you analyze it, balance is just a formality for us to close. Any doubts on this? With this, my basic questions get over. We keep proceeding to balance component. The second part of the chapter focuses on something called as break-even point for multiple product. Now, what is this discussion on multiple product? Why a separate discussion? You'll understand. Let's come to 7. MK Limited manufactures and sells a single product X whose selling price is 40, variable cost is 16. Part 1 I don't want to discuss, ignore it, you do it later if you want. For the next year, it is proposed to add another product line whose selling price will be 50, variable cost will be 10. The total fixed cost are estimated at 6,66,600. Sales mix value is 7 is to 3. Determine at what level of sales next year would MK Limited break even. Give separately for both X and Y the break even sales in rupees and quantity. Now, originally I have a product 40 rupees, variable cost 16 rupees, contribution 24 rupees. Then there's a next product which I'm introducing Y, whose selling price is 50, variable cost is 10, contribution is 40 rupees. Break even point, tell me the formula for break even point. Fixed cost by fixed cost by contribution per unit or PVR. When we have single product, I can use that product contribution, but here I have product X which has a different contribution. I have a product Y which is a different contribution. How we solve this situation is what we are going to see in this segment of the topic. So here I have a sales mix which is 7 is to 3, and sales mix is for value means rupees. Sales mix is for value. The sales mix can be for units or value. What is units? Is 7 units and 3 units I sell together, or 70 rupees and 30 rupees I sell together. It can be on value, it can be on units. If it is in value, our analysis is PVR based. If it is in units, our analysis is contribution based. So let's write now BP for multiple products, particulars and two products, particulars product X, product Y, product X and product Y, selling price less variable cost, contribution per unit, PVR. Selling price less variable cost, contribution per unit, and PVR. 40, 16 and 24. Other product is 50. PVR is contribution per unit by selling price 60% and 80%. Now, the formula for break even point is fixed cost by PVR, but the problem is I have two PVR. One PVR is 60%, another PVR is 80%. Now, below this, right, the sales mix is given in value, okay. Composite PVR. Composite PVR is equal to, what is composite? Is single PVR. 60 into, the sales mix is 7 is to 3. 60 into 7 by 10 and 80 into 3 by 10. We combine it together and make it a single PVR. 60 into 7 by 10, 80 into 3 by 10, one PVR number we will get. 60 into 7 by 10, 80 into 3 by 10 into 3 by 10. How much? 60 Now we do not have two PVR, we have only one PVR, and the PVR number is 66%. Single profit volume ratio 66%. And with this, we will, if the sales mix was given for units, then we would have done 24 into 7 by 10, 40 into 3 by 10. That would have given composite contribution per unit. Composite contribution per unit. This is composite PVR. Composite PVR. Now, next part, right? Break even point is equal to fixed cost by PVR. Fixed cost by PVR. What is the fixed cost? Divided by 66%. Divided by 66%. 10 lakh. Break it into two. X, Y, 7 is to 3. 7 is to 3. 7 is to 3 is the mix. Composite PVR concept. 7 is to 3 is the mix. You get 7 lakh 7 lakh 7,000 and 3 lakh 3,000. 7 lakh 7,000 and 3 lakh 3,000. Any doubts on the number? 707 and 303. Divide this by the selling price. What is the selling price of X? X, what is the selling price? 40. Divide by 40, you'll get the units. 17,675 units. 3 lakh 3,000 divided by 50. 6,060 units. 6060 units. 17,675 units. 17,675 units. 6060 units. Any doubts on this? Clear? Can you proceed? Now, if you look at 17 and 6060, that will not be 7 is to 3. Only the value is 7 is to 3 here. Okay, there is an error in the solution. Okay, solution, I don't know, says sales mixes for units sold. It is clearly given, it is value. There is an error in the solution. Ignore the solution. The question clearly gave sales mixes for value. Solution has taken the sales mix for units and done the answer. If it is units, the answer will be done this way. But it is the sales mixes for value, which is crystal clear. I'm not sure why I've done this. I'll correct it in the next material. Go through 8. A slightly lengthier one. Go through 8. Okay, I'll start reading it. Para 1, para 2, para 3, no use. Para 4, variable cost is 100, 80, and 40 for school bag, water bottle, and geometry box, respectively. Three products are there. These articles are made using a single machine. 0.2 hours of machine operation is required for one school bag. Machine hours required for water bottle and geometry boxes 0.15. Fixed overhead is 7 lakh 40. If you divide by 8,000 hours, you will get OAR. 7 lakh 40 divided by 8,000 will give you overhead absorption rate. Company has decided to sell 80% capacity production in market. Rest is divided among the two undergoing social works. All school request this item in the ratio of, this is the ratio for units, ratio of units, very clear, because they are ordering items in the ratio, not value. This is for units. Company wants to set a price for the articles. What is the allocated fixed cost per unit of school bag, water bottle, and geometry box? Technically doesn't have any relevance in decision making, but still they want to distribute. How will you distribute? By calculating OAR. So let's do OAR is equal to, OAR is equal to, OAR is equal to budgeted overheads by budgeted machine hours, budgeted overheads by budgeted machine hours, 7 lakh 40,000 divided by 8,000, 740 by 8,000, 92.5. Then cost for school bag 92.5 into how much time it takes for one school bag? Point, point 0.2 hours. 92.5 into point 0.2, 18.5 per hour. Then the second one is cost of, the second item is cost of water bottle 92.5 into 0.15, 13 point. Then cost of box equal to 92.5 into point, point 1 only, no, 9.25. So the right answer is 18.5, 13.875, and 9.25. Next, if the prices are 200, 160, and 100, what is the overall break-even point? Now, to calculate break-even point, I'll have to calculate three contribution and do composite contribution per unit. Like we did composite PVR, here we'll have to do composite contribution per unit. So next, particulars in three products. Particulars in three products. Bag, bottle, and box. Bag, bottle, and box. The selling price is given in the MCQ: 200, 160, and 100. 200, 160, and 100. 200, 160, and 100. Variable cost is 100, 80, and 40. 100, 80, and 40. Contribution per unit is 100, 80, and 60. Below this, composite contribution per unit is equal to 100 into 100 into, so what is the sales mix given? 2 is to 3 is to 5, 2 by 10, 80 into 3 by 10, 60 into 5 by 10, 2 is to 3 is to 5. How much you get? 74 per unit. Now I can calculate break even point, only one contribution. 74 is the contribution. Fixed cost by contribution per unit. Fixed cost by contribution per unit. Any doubts on 74? Any doubts on the number 74 here? Break even point is equal to fixed cost by contribution per unit. Seven lakh 40 by 74. 10,000 units. Break even point is 10,000 units. Any doubts on this? Let's look at the, is it 1000? Check 7 lakh 40 by, not sure, maybe there's an error, I don't know. Is the fixed cost 74,000? No, just give me a minute. What they've done for school supply, okay, they allocated it. Okay, they have done it a little differently. I'll explain what they've ended up doing. Uh, from that 7 lakh 40,000, if you read the question, somewhere it has mentioned that 80% capacity production is for market and rest is divided among the two undergoing social works. So the 80% is for market supply, balance 20% is only for the school supply. In that 20%, there are two social works they are doing. So one social work they have indicated initially. So out of the overall fixed cost, only 10% they are allocating for this three products. Only 10% they are allocating for these three products. So let's just change it. 7 lakh 40 into 10%. Into 10%. 1000 units. Only 10% will get allocated for this project. Find out the maximum number of units that can be given at the prices given in question number 2. Maximum number of units, distribute that units 1000. Distribute the units and tell me in the ratio of 2 is to 3 is to 5. 2 is to 3 is to 5. 200, 200, 300 and 500. What is the maximum units that can be supplied to the schools of each article? Now listen, I have around 8,000 hours. I have around 8,000 hours. In the 8,000 hours, 80% is for market supply. Balance 20% is equally distributed for the two charitable work. The two charitable workers, last year it decided to produce and supply special quality bags at no price as a social responsibility. So one without price I supply 10% and balance 10% I do it for the school supply. So of the 8,000 hours, only 800 hours I can use for school supply. Only 800 hours I can use it for school supply. Now write hours available for, hours available for school supply, 8,000 into 10%. Hours available for school supply 800 hours. Let us assume one set, one set contains, let us assume one set contains, we have three product, we are going to manufacture them together in a proportion of 2 is to 3 is to 5. Our proportion is 2 is to 3 is to 5. So one set contains two bags, three bottles, and 5 boxes. Time taken per set. What is the time taken per bag? Point 2. Bottle, point 1.5 boxes. Multiply all of this. This much is the time taken per set. Time taken per set. 2 into point 0.2, 3 into 0.15, 5 into point 0.1. All put together, tell me the time taken. 1 point. Number of sets that can be manufactured. Number of sets that can be manufactured. 800 by 1.35. 800 by 1.35. 592.59. Multiply that with 2, 3 and 5. One of the option you will find. 592.59. 1185 1777 2962. Multiply with 2, 3 and 5. Any doubts on this? Clear? Last requirement. What should be the correct price as per the management's decision? Now, what is management's decision? Management has few questions. They need the answer. They assign the task to their team. Team made rough calculation, but as there were too many people, okay, somewhere they would have given management. Let me read it from the beginning. I did not read the question. Where did have they given the management angle? Where is the third para? Management wants to add another dimension. It approached charitable and offered them to supply, okay, at cost. At cost. They want to supply at cost. What is cost? Is variable cost plus fixed cost. Variable cost plus fixed cost. Variable cost is 100, 80 and 40. Fixed cost you calculated in the first working note, which was 18.5. So 100 plus 18.5, 118.5. Then the second one is plus 13.875. Third one is plus 9.25. Variable cost plus fixed cost. Which option will be the right one? Question 5. 100 plus 18.5, 118.5. Then the second one is 80 plus 13.875, 93.875. And the last one is 40 plus 9.25, 49 point. Which one? 93 point. Any doubts on this? Any doubts on this part? Clear? So this is in case you have multiple products. In case you have multiple products, you have to do something called as composite PVR or composite contribution per unit. Clear? Any doubts on this? Done. Okay, let's take a break of 15 minutes. Okay, let's proceed. Let's come to question 9. It's on a topic called plant merger. I'll take you through itself. Two manufacturing company which have the following operating details decided to merge. Particulars: Taylor and Vaughan. Capacity utilization, sales, variable cost, fixed cost. Assuming the proposal is implemented, break-even sales of the merged plant, profitability of the merged plant, sales turnover of the merged plant, and when the merged plant is operating at a capacity to earn a profit of 75 lakh, how much increase in selling price is required to sustain an increase of 5% in fixed overhead. So few requirements are there. The only thing is, like previous question where we had two products, here we have two manufacturing plants and they are going to merge together. When they merge together, I have to prepare a merged marginal costing statement. And once we prepare a merged marginal costing statement, we can keep answering whatever they've asked in the question. Break even sales, profitability, everything can be done. But to prepare the merged statement, the capacity utilization has to be same for both the manufacturing plant. Reason is, once merger passes through, after the merger passes through, both will operate at same capacity utilization. So what we are going to do is, we are going to convert the given statement to 100%, add up the 200% number, get the merged plant marginal costing statement, and then end up answering whatever they've asked. Working note 1, marginal costing income statement. Marginal costing income statement. Marginal costing income statement. Particulars, totally 6 columns. First is company Taylor, two sub columns, 90% and 100%. Then company Vaughan, 60% and 100%. Overall 100%. Overall we'll do it at 100%. Sales less variable cost, contribution less fixed cost, profit. Let's write the numbers. 540, 396, 144, 80, 64. These are individual numbers at 90% capacity utilization. At 90% capacity utilization, now we'll have to convert into 100%. 540 is 90%, so 100% is how much? 600. Variable cost is 440. Contribution 160. Fixed cost will not increase, remain same 80. Profit is 80. Fixed cost will not go up, profit is 80. Then comes company Vaughan, 300, 225, 75, 50 and 25. 300, 225, 75, 50 and 25. What is the sales at 100%? 500. Variable cost 375. Contribution is 125. Fixed cost remain 50. Profit is 75. And now put the total of 200% statements, because once the merger happens, they'll operate at the same level. So assuming they operate at 100%, we are doing a statement. 1100. 1100. Variable cost total is how much? 815. Contribution, fixed cost. Now problem is over. I'm not doing to do anything beyond this. I just wanted the overall statement to be done. We are done with the overall statement. Now with this, if they ask PV ratio, calculate PV ratio. If they ask break even point, calculate break even point. Everything with this. So let's understand requirement. First is break even sales. How will I get break even sales? Is fixed cost divided by PV ratio. PV ratio is total contribution, 285 by 1100. Once you get the break even point, capacity utilization. 1100 is equal to 100%. If your break even is 400, 400 is equal to question mark. You will have to calculate that. Then what is the profitability if it operates at 80%? If you operate at 80%, sales is 880 lakh. You can do another statement for 80%, or you can use the formula sales into PVR is contribution minus fixed cost is profit. Everything from the master equation. Third one, sales turnover to earn a profit of 75. Profit plus fixed cost is contribution divided by PVR. Clear? Any doubts on this? And last one is, if you're today earning a profit of 75 lakh, and what should be the increase in selling price so as to sustain an increase of what? 5% in fixed overhead. If fixed overheads go up, profit will go down. I want to sustain means let the fixed overhead go up. I will increase the selling price and maintain the same profit. I'll maintain the same profit. Clear? Any doubts on this? With this, my multiple scenario discussion gets, or what is multiple scenarios? There can be multiple products where the sales mix is given for value, or the sales mix is given for units. Value means you will have to do composite PVR. Units means you will have to do composite contribution per unit. Is it only break even point? No, it can be anything. They can even say sales to achieve desired profit. If they give desired profit plus fixed cost by contribution, composite contribution or composite PVR. Anything can be done. It can be, the formula is not only for break even point, it can be for any of the situation which we saw here. The only thing is it needs contribution, it needs PVR. So PVR, composite PVR, here composite contribution. Clear? Any doubts on this? Next comes the next concept called indifference point. Let's go through this question first. Okay, I have an option to buy two machines N or M to manufacture some industrial component. Each have the capacity to produce same quality, identical, but they are being manufactured by different manufacturers. Whenever we have two options, an item can come called as indifference point. Here this says calculate sales level in units where both are equally profitable. Equally profitable means indifference point. Indifference point means level of sales, level of production at which two alternative give same result. We saw indifference point even in financial management where same level of EBIT at which same EPS, here same profit or same cost. For indifference point we have a formula. Let's write the formula first and then I do the question. Indifference point is equal to change in fixed cost divided by change in VC per unit or contribution per unit or PVR or VCR. Denominator can be any of this. Change in fixed cost divided by change in variable cost per unit, contribution per unit, profit volume ratio, variable cost ratio. If you divide by variable cost ratio or profit volume ratio, you'll get the answer in rupees. If you divide by contribution per unit or VC per unit, you'll get the answer in units. Clear? Let's do this income marginal costing statement for the two machine. Particulars and 4 columns. We'll do per unit as well here. Particulars, two machines are there, machine M and machine N. machine M, machine N, per unit total, per unit and total, sales less variable cost, contribution less fixed cost, profit. We have per unit information, so we are using that as well here. Machine M, it has a capacity to produce 50,000, the fixed cost being 1,50,000, right? Fixed cost is 1,50,000. Fixed cost is 1,50,000. Profit is 2,25,000. Reverse working contribution 3,75,000. 50,000 units, divide by 50,000. Divide by 50,000. 7.5. Divide by 50,000. 7.5. Clear? I'll write the above one. It will not make any difference. I'll write it little later. Next, product N. Same number of components that of machine M. Fixed cost is 60,000 less than that of machine M, and it gives a profit of 1,60,000. Profit is 1,60,000. Fixed cost is 60,000 less. Contribution per unit is 5. I'm not writing the above one. I can write it if I want, but it doesn't make difference. This is sufficient. Okay. Now, two requirements in the question. First requirement is break-even sales in value for each machine. They've asked for break-even sales. Break-even sales is nothing but fixed cost by contribution per unit. You will get it in units. Multiply with 100 rupees. Multiply with 100 rupees. So, break-even point. Break-even point. Fixed cost by contribution per unit. First is machine M. 1,50,000 divided by 7.5. 1,50,000 by 7.5. 20,000 units are 20,000 units are rupees 20 lakh. 100 rupees is the selling price. Then the next machine, BP of machine N, 90,000 divided by 5. 18,000 are 18 lakh. This is break even point. Then they have said sales at which both machines are equally profitable. Equally profitable is technically called indifference point. Equally profitable is indifference point. Equally profitable, we are going to use the formula change in fixed cost 90 and 150 difference divided by change in contribution per unit. You can even do VC per unit. We are going to do contribution per unit. I can even do PVR, VCR, anything can be done. If you divide by PVR or VCR, you will get the answer in rupees. If you divide by contribution per unit, you will get the answer in units. Next, indifference point. Or write the term sales at which both models are equally profitable is equal to change in fixed cost by change in contribution per unit. Change in fixed cost by change in contribution per unit. What is the difference in fixed cost between the two alternative? Difference in contribution per unit. That's all. 60,000 by 2.5. How much? They've asked sales level in units. So units is done if they ask value into 100. Any doubts on this? Clear? This is another concept which we need to be aware of, indifference point concept. Next comes a concept called shutdown point. Go through the question. Okay. Mr. X has 2 lakh investment in his business firm. He wants a 15% return on his money. From an analysis, he finds that variable cost is 60%, fixed cost is 80,000. What sales volume, volume means value here because we do not have per unit information, must be obtained to what? Break even. Let's close it. Break even point is equal to fixed cost by PVR. Fixed cost by PVR 80,000 divided by 40%. 80,000 divided by 40%, 2 lakh. 80,000 divided by 40%, 2 lakh. Then they're saying, I want a return of 15% on investment. Return is nothing but profit. I want a profit of 15% on my investment. What is the investment made? 2 lakh. Now, right. Profit is equal to 15% of investment. Profit is equal to 15% of investment. 30,000. I want a profit of 30,000. What should I do? The same thing. Master formula. Profit plus fixed cost will give you contribution. Divide by PVR, you will get the sales. So sales to get right. Sales to achieve profit of 30,000. Sales to achieve profit of 30,000 is equal to profit plus fixed cost by PVR. Fixed cost is how much? PVR is 40%. Clear? Okay. Next thing is Mr. X estimates that even if he closed the doors of his business, he will incur 25,000 as expenses per year. At what level of sales would he be better off by locking his business up? Would he be better off by locking his business up? Now, what they are trying to say is the business may do well, may not do well. Sometimes what will happen is like COVID situation and all, companies will temporarily close down. There's a permanent close down and temporary close down. Temporary close down is called shutdown analysis. Now write the formula first. Shutdown point is equal to, shutdown point is equal to, then I'll explain the formula. Shutdown point is equal to fixed cost during operation minus fixed cost during shutdown minus additional fixed cost to resume operation whole divided by contribution per unit or PVR. Whole divided by contribution per unit or PVR. Fixed cost during operation minus fixed cost during shutdown minus additional fixed cost to resume operation whole divided by contribution per unit or PVR. Contribution per unit or PVR. Now, what shutdown point basically says is that every organization will have a high fixed cost. Once you shut it down, also you will incur some fixed cost. So, the difference, the numerator is technically called avoidable fixed cost. How much fixed cost can I avoid by shutting it down? How much fixed cost can I avoid? At least that much I want to recover. Break even means all fixed cost to be recovered. Here I just want to recover the avoidable fixed cost, the avoidable fixed cost. Now in the question, how much is the fixed cost when you're operating? 80,000. If you shut it down also, you will incur some fixed cost. It says you will continue to incur 25,000. Some question will say your fixed cost will go down by 25,000 when you shut it down, and they have not given this number. When I start my operation again, how much extra fixed cost is not given. Additional fixed cost to resume operation is not given. Divided by what is the PVR? This is called shutdown point. At least this much sales I should do. PV break even 2 lakh. You need not break even, but at least 137,500 you have to do. Any sales below 137,500, shut down the factory. Any sales below 137,500. So we should lock the business in case sales go below 137,500. Below 137,500, no point in running the business. Go below 137,500. Clear? Any doubts on this? Below 137,500, shut down the business. Okay. Next comes something called as BEP with differential fixed cost. Now, till now we learned BEP is fixed cost by contribution per unit or PVR. Practical world, the fixed cost number does not remain constant. When I say does not remain constant, if you have 20 students, this room is sufficient. If I have 40 students, this room may not be sufficient. I want to take another building. If I take another building, my fixed cost will go up. So fixed cost will remain same till some level, and thereafter it can change. How does that impact analysis? Let's see. Let's see question 12. Yamuna Limited manufactures a product currently utilizing 80% capacity with a turnover of 8 lakh at 25 per unit. Cost data are as under: material cost 7.5, labor cost 6.5, 6.25, semi variable cost including the variable cost is 1 lakh 80, fixed cost 90,000 if you do till 80%, but an additional 20,000 will be incurred beyond this level. The fixed cost itself, you will see two different numbers. Beyond this, you will incur an additional 20,000. They've asked us to calculate break even point, number of units to earn a profit of 8% on sales, and activity level needed to earn a profit of 95,000. Three requirements, all that is fine. Let's first get two numbers: VC per unit and total fixed cost. VC per unit and total fixed cost. How many units is the company selling today? How many units are they selling today? Tell me the number. 32,000. 8 lakh divided by 25. 8 lakh divided by 25. It is 32,000 units which are getting sold today. 32,000 units. Till 32,000 units, my fixed cost is going to be different. Beyond 32,000, my fixed cost is going to be different. When we have two different fixed cost number, how do we analyze is what you're going to see in this question. Let's start. Working note 1. Computation of VC per unit and total fixed cost. VC per unit and total fixed cost. VC per unit is equal to 7.5, 6.25, 3.75. Semi variable cost has a variable cost of 3.75. 7.5, 6.25 and 3.75. 17.5. Clear? Total fixed cost is equal. Total fixed cost up to 32,000 units. Up to 32,000 units, I have a different fixed cost number, and beyond I'll have a different fixed cost number. Up to 32,000 units. Total fixed cost up to 32,000 units. Now up to 32,000 units, let's understand it. My fixed cost is 90,000. Tell me how much is the fixed cost in this. Semi-variable will also have a fixed component. Semi-variable will also have a fixed component. Of the 1 lakh 80, 32,000 into 3.75 is variable. 32,000 into 3.75 is variable, balance is fixed. How much is the fixed component? So fixed cost is 90,000 plus 60,000, 1 lakh 50. The problem is the next one. Total fixed cost beyond 32,000 units. In this 150, extra 20,000 will be incurred. Extra 20,000 will be incurred. Extra 20,000 will be incurred. Clear? Working note to computation of break-even point. Particulars in 2 columns. Up to 80% capacity, beyond 80% capacity. Up to 80%, beyond 80%. We will see this as 2 separate question. It is not a single problem. Visualize this as 2 separate question itself. One question fixed cost is 1 lakh 50. Another question fixed cost is 1 lakh 70. Break even point is fixed cost by contribution per unit. For one problem it's 1 lakh 50. For one problem it is 1 lakh 70. Point number 1, total fixed cost 1 lakh 50, 1 lakh 70, 150 and 170. Contribution per unit. What is the selling price? 25 minus 17.5. Divide and call it as tentative break even point. Why tentative? I'll explain. Fixed cost by contribution per unit. Fixed cost by contribution per unit. 20,000. 20,000 and other one is, now it is like a chain reaction. What is chain reaction is, my BP 20,000 is okay, but if BP is 22,667, fixed cost will not be 170, fixed cost will become 150. Fixed cost will become 150 because till 32,000 units, fixed cost is what? Till 32,000 units, fixed cost is 1 lakh 50. Beyond 32,000 units, fixed cost is 1 lakh 70. So what concept says is, now write final BP 20,000 is okay because it fits in between 0 to 80% capacity. This is invalid. This is not a right answer. I need the answer to be below 32, above 32. I can get first one 30,000, second one 40,000, both are right. First one 30 is also right, second 40 is also right. I need the answer to be below 32 and above 32. Sometimes first one you got 40,000, second one you got 20,000, just a rare scenario, will not happen. Both are invalid. Both are invalid. My answer is very clear. I need the number to be below 32,000 and above 32,000. If you get it, it is valid. If you don't get it, it is invalid. Next, working note 3. Sales to earn profit of 8% on sales. Again, same heading, up to 80%, beyond 80%. Sales to earn a profit of 8% on sales. I need the answer to be below 32, above 32. Sales less variable cost, contribution less fixed cost, Profit. I don't know the number of units. Selling price is known. So sales is 25x, 25x. Sales is 25x and 25x. 17.5x, 17.5x. Only rule is finally I need an answer below 32 and above 32. 7.5x and 7.5x. Fixed cost is different. Fixed cost is different. What is the fixed cost? 150, 170. 7.5x minus 150 is 8% of 25x. 8% of 25x. Get the answer to x. X is the number of units. This is a tentative answer. May become valid, may become invalid. Below 32, above 32. Below 32 and above 32 we want. The number of units will be 1,50,000 divided by 5.5. 27,273. Valid. This is okay. 27,273 is okay. 7.5. 8% of 25x is 2x. Goes to the other side. 1,50,000 divided by 5.5 and 1,70,000 divided by 5.5. 30,909 invalid. This is wrong. Only one answer is right. 27,273. I need the answer to be below 32 and above 32. Below 32 and above 32. Any doubts on this? Same thing repeat again. Profit. Next part says I want profit of how much? Equate this to 95,000. Instead of 8%, equate it to 95,000. Equate it to 95,000. We want a profit of 95,000. Equate the number to 95,000. Invalid. I need the answer to be below 32. 35. Valid. Second answer is valid. The first answer is invalid. 35, 333 is valid. 32, 667 is invalid. Clear? Any doubts on this? Can you proceed? Go through 13. Go through the question and give me two numbers, VC per unit and TFC number. Calculate and give me the VC per unit and total fixed cost number. Thereafter, I'll discuss it. Variable cost per unit and total fixed cost number. Read it carefully and give me these two numbers. Variable cost per unit and total fixed cost. They have given data of last year. In 2016, tell me what will be the variable cost per unit. Tell me the number, final number. What is the variable cost per unit? 220, 180 plus 225. Fine. Fixed cost number. Fixed cost number of this year. Sorry, 70. Okay. Whenever you do fixed cost, be little cautious. Fixed cost is 60. Don't add 10%. Don't add 10%. First convert the 60. Last year, what was the production? So 60 into 1,20,000 is the last year number. And add 10% on top of it. Add 10% on top of total fixed cost. Add 10% on top of total fixed cost. Then what is the issue? I'll explain the issue as we proceed. Now write first. VC per unit. VC per unit is equal to VC per unit is equal to per unit is equal to 180 plus 25%. Any change in variable cost means change in variable cost per unit. Total fixed cost is equal to last year fixed cost is 1,20,000 into 60 and then add 10% change. If you do 60 plus 10% and then multiply with 1,50,000, you will get a wrong answer. 79 lakh 20,000. Okay. Now the problem here is this fixed cost is not changing. The change is happening on variable cost. Now what is the change in variable cost? Last year to current year change is not a problem. The problem is I have some opening stock. If opening stock was not there, I have no problem, because whatever opening stock is there on these units, I will earn 300 minus 180. On the opening stock units, I'll earn 300 minus 180. And whatever I produce in the current year and sell, I will earn 300 minus 225. I have some units from the last year. On these units, I will earn 300 rupees minus 180 per packet. Minus 180 per packet. On the units which I sell in the current year, I will be incurring 300 minus 225. Fixed cost last year is of no use, because this year fixed cost is only one number. So the formula is fixed cost by contribution per unit. But the issue is contribution per unit can be different. If you sell the last year production, you get a different contribution. You sell the current year production, you get a different contribution. Last year production 300 minus 180. This year production 300 minus 225. It starts with a term called shelf life of 1 year. Shelf life of 1 year means first I'll sell the last year production, then only I'll sell the current year production. Now write at break even point. At break even point, total fixed cost is equal to total contribution. Total fixed cost is equal to total contribution. 79 lakh 20,000 is equal to first 20,000 units I will earn 120 rupees. 300 minus 180. First 20,000 units I will sell that. Last year whatever opening stock of 20,000 packet, I will sell that and earn into 120. Then extra units into 75. What is 75? Is 300 minus 225. Tell me what is the extra units now. And finally you will get the break even point. 20,000 of last year you will sell first, and then you will sell the extra units. Then sell the extra units. Extra units is how much? Then total units is 93,600. Extra is 73,600. Extra is 73,600. Break even point is 73,600 plus 20,000. 93,600 you have to sell. If I sell 93,600, I'll break even. I'll be selling more units, but at 93,600 we will break even. At 93,600 we will break even. In that 20,000 units will come from the last year. I earn 120 rupees on that. Balance will come from the current year. On that I will be earning only 75 rupees. 300 minus 225. Any doubts on this? Clear? Now we are kind of done with major segment of the chapter. Now we have certain what to say questions where we are going to do something called as decision making area. The problems which we are going to do could be discussed under marginal costing, could be discussed under some other chapter also. Some of the concepts of marginal costing will focus and then try to get the answer. Let's come to 14. Go through the question. Okay, let's read from the beginning. JC Limited has a production capacity of 80,000 units per year. Presently, the company produces only 60,000 units. So I have some spare capacity of 20,000 units. Its cost structure is as under: material cost, labor cost, variable overhead. Fixed cost is 3 lakh per annum. Present selling price is 20. The company received an offer from a Japanese company to supply how many units? 20,000 units. I have to supply 20,000 units at a price of 14 per unit with a shipping cost of 8,000. On the basis of changes in profit, advise to the company whether the offer should be accepted or not. Now, my offer is very simple. I've got an offer for 20,000 units. I do have extra capacity for this. I do have extra capacity. If you do not have capacity, then you have to lose the existing sale, which is called opportunity cost. Here I do have capacity. I have got an order for 20,000 units, and let's calculate how much profit will come from this order. Now, right, profit from export order is equal to profit from export order is equal to from export order is equal to 20,000 units into what is the selling price? 14 minus 20,000 into what is the variable cost? 12. No extra fixed cost. So fixed cost will not come in the calculation. We are not going to incur any extra fixed cost. So 20,000 into 12, and one more cost we have to incur. How much is the profit we make? Profit will increase by 32,000. Extra profit of 32,000 this order will give me. Profit will increase by 32,000, and hence we should accept the export order. We should accept the export order. Profit will go up by what? 32,000 rupees. I should go ahead and accept the export order. Clear? What will happen if it's a local customer? What is the problem if it's a local customer? They are saying, will there be any change in the analysis? Okay, shipping cost is one part, but other than shipping, what is the issue? Shipping may still be there. I will not accept for a local order because if other customers get to know about it, my local selling price can get impacted because in the local market I'm selling it at 20 rupees per unit. I cannot suddenly accept an order if I'm sure that this is a special order, others will not get to know about it, it's okay. Otherwise, local orders at a lower price is not advisable because my existing sales can get impacted. So, local order will not be accepted as the lower selling price as the lower selling price can impact the sales of the existing or can impact the existing sales. Clear? Next they are saying if this customer wants not 30,000 units, he is saying give me 30,000 units at a price of 14. Part supply not accepted. Part supply means I have spare capacity of 20,000. I cannot supply part, and shipping cost is treated as variable, means for 20,000 units it was 8,000 rupees. For 30,000 units the shipping cost will increase. Analyze the impact if the order is accepted. See, if you accept the order, one thing you need to do is you have to compromise the sale of the existing 60,000 you have been selling, that will go down to 50,000 because I have a capacity of only 80,000. So if I lose the existing sales, I lose the contribution from the existing sale. I lose the contribution from earlier. All this issue was not there. I had spare capacity. If in this room I can accommodate, let's assume 20 more students and existing students are not impacted, I can do it. But if I want extra 30 students and I have to say no to the existing student, then there is an impact on my profit from the existing customer. So next, evaluation of order of 30,000 units. Particulars calculation amount. Particulars calculation amount. 30,000 units. Sales 30,000 into 14 rupees. 30,000 into 14 rupees less variable cost 3 lakh 60. Variable cost is 3 lakh 60. Shipping cost. Shipping cost. See, 20,000 units, shipping cost is 8,000 rupees. It's a variable cost. Variable cost will go up with the units. Variable cost will go up with the units. How much? 12,000 less opportunity cost. This is the most important part. Opportunity cost. Less opportunity cost. What is opportunity cost here is, earlier I was selling 80,000 units. I had a capacity of 80. I was selling 60,000 units. Now in this 80, 30,000 you are going to do export order, which means another 50,000 only you can sell. So 10,000 units I lose, and on these 10,000 units I was earning 20 rupees minus 12 rupees. I was earning 20 rupees minus 12 rupees on the 10,000 units which I cannot sell now. I cannot sell it in the domestic market because capacity is not there. So opportunity cost in bracket loss of sale of 10,000 units. 10,000 units into 20 minus 12. 20 minus 12. 20 minus 12. How much? 80,000. Relevant are profit from export order. This is the profit I get from export order now. Mostly we should reject this profit from export order. When I had spare capacity, no problem, but now mostly it will get rejected. How much? Negative 32. So I will not accept the export order when I do not have capacity. Part supply not possible, I cannot supply. If part supply is possible, 20,000 is okay. But beyond 20,000, I don't want to lose existing sale. Existing sale is a highly profitable one. I don't want to lose the existing sale and then supply it. Clear? Any doubts on this? Fixed cost, where do you want to consider? How will I consider? Tell me. Fixed cost is irrelevant. No, apportionment is fine. Doesn't impact the decision. No, we are doing decision making. So fixed cost number is not going to change just because we are accepting the export order. Then you'll have to do the total statement. You'll have to do the total profit statement. Export you have to do, domestic you have to do, put the total profit and then do the decision making. You'll get the same conclusion. Any doubts on this? Go through 15. Go through it and you try doing it. I don't have much to explain. You do it. I'll discuss it in maybe sometime. I'll start doing it in the screen in some time. You do it. I'm doing it in the screen. You check later. You do it and then check. Break even point fixed cost by contribution per unit. Fixed cost is 36 lakh. CPU is 130. 600 minus 470. You get it in units. Multiply with the price. You'll get the answer in rupees. Printed material, they've done PVR. Rounding of impact is there in the answer. 1 crore 6615 I get. Printed material is 1 crore 6612. The gap is rounding off. That gap is purely rounding off gap. 27,692 can be rounded off to 693, 690. That's okay. Any doubts on the break even point? Any doubts on the break even point? And profit or loss if you sell 35,000 is 35,000 units into contribution per unit minus fixed cost. 9 lakh 50,000. Any doubts in this? Any doubts? It's fairly simple, straightforward question. Nothing much is there. Any doubts in this? Can you proceed? Go through 16 at a very good problem, a slightly lengthier one. Go through the question. Go through the question and then we start doing it. Okay. PQR Limited manufactures three product X, Y, and Z. Output for the current year is 250 of X, 280 of Y, 320 of Z. Selling price of X is 1.25 times of Z. Y can be sold at double of Z, and Z will be sold at a profit of 20% on its marginal cost. Marginal cost means on its variable cost. On its variable cost. So first thing we'll find out the selling price of Z. With that we'll find the selling price of X. With that we'll find the selling price of Y. Other information: material cost, wage cost, raw material is same, wages is paid at the rate of 4 per labor hour, overhead cost is 50 to 80, out of which 1 per labor hour is variable, rest is fixed. In the next year sales will increase by 12 and 15, Y will decline, overhead cost is 55, variable cost remain unchanged, other cost will remain same, no opening, no closing stock. Prepare a budget showing the current position and the position for the next year, clearly indicating product wise contribution and profit for the company as a whole. Product wise contribution, profit for the company as a whole. Let's first prepare the format and then we start filling it. Budget showing the current position. Budget showing the current position. Particulars, totally 8 columns. 3 products with 2 sub columns. Particulars, 3 products with 2 sub columns. Per unit total. The 3 products are product X, product Y, and product Z. Per unit and total and overall total. Sales less variable cost, contribution less fixed cost, profit. Sales less variable cost, contribution less fixed cost, and profit. Okay, now coming to this requirement. First, I'll have to find out what is the variable cost of Z. Once I find the variable cost of Z, that plus 20% is the selling price. That plus 20% is the selling price. Now, if you look at here, wages is 16, 24, 16. Wages are paid at the rate of 4 per labor hour. Wages are paid at the rate of 4 per labor hour, which means this is 4 hours, this is 6 hours, and this is 4 hours. And in that, 1 per labor hour is the variable cost. 1 per labor hour is the variable cost. So variable overhead is technically 4, 6, and 4. Variable overhead is 4, 6, and 4. Variable overhead is going to be 4, 6, and 4 because it is 1 per labor hour, and number of labor hours is 16 divided by 4 rupees, 24 divided by 4 rupees, and 16 divided by 4 rupees. So 4 hours into 1 rupee, 6 hours into 1 rupee, 4 hours into 1 rupee. Let's write the variable cost here. Variable cost. Product X is 20, 16, and 4. 20, 16, and 4. 20 rupees, 16 rupees, and 4 rupees. Product Y is 20, 24, and 6 rupees. 20, 24, and 6 rupees. 6 rupees will make it 50. And product Z is 20, 16, and 4. 20, 16, and 4. 40. Now, selling price of Z is 20% on its marginal cost. 20% on its marginal cost. So, this is 40 plus 20%. 48. 48 is the selling price. If Z is 48, X and Y something they have given in the question. What is X they have mentioned? 1.25 times. So 48 into 1.25. 60. And Y what they have mentioned? 2 times 96. Please complete the statement now. Now it is more of a formality. You know the number of units. Multiply with the number of units and close it. X is 2,50,000 units. So 60 into 2,50,000, 1 crore 50 lakhs. 40 into 2,50,000, 1 crore. Contribution is 50 lakh. Next one is 96 into 2,80,000. 2 crore 6880. 50 into 2,80,000, 1 crore 40 lakh, and 1 crore 28 lakh 80,000. Z is 3,20,000 units. One crore 53 lakh 60,000. 40 into 3 lakh 20,000. 1 crore 28. Contribution is, and you will get the overall total. The total numbers have to be there. What are the total numbers? 1 crore 50, 268 80, 153 60. 5 crore 72 lakh 40,000. We have to find out fixed cost. First complete till this. Any doubts in this? Any doubts till this? Numbers are little time consuming one, but otherwise there's no major difficulty as such. Any doubts in this? Clear? Can you proceed? Okay, now coming to the fixed cost, they have said overhead cost is 52 lakh 80. In this, I have to remove the variable. What is variable? 4 into 2 lakh 50,000, 6 into 2 lakh 80,000, 4 into 3 lakh 20,000. The variable component is 464 into the number of units. Balance is the fixed component. Balance is the fixed component. So come down. Fixed cost is equal to 52 lakh 80,000 minus 4 into 2 lakh 50,000, 4 into 2 lakh 50,000, 6 into 2 lakh 80,000 and 4 into 3 lakh 20,000. What's the fixed cost? 13 lakh 20,000 and profit is balancing figure 1 crore 91 lakh 20,000. I'm not going to do the revised one. I'll discuss it, but exactly same statement we have to do. Revised one, we have to do the exact same statement. This statement, whatever we have prepared, we have to prepare an exact same statement. Any doubts on this? Now, in the revised one, what they have said is there is going to be sales of X will go down, increase by 12%, so number of units will change. Z number of units will change. Y will go down. Overhead cost is 5508. In that you remove the variable component, you will again get the fixed component balancing figure. No change in selling price, anything else. So exact same statement, number of units will change and fixed cost may or may not change. I don't know. You'll have to do the calculation because 55 lakh 8,000 minus the 3 variable cost will give you the fixed component. Any doubts on this? Clear? Go through 17. Okay. PQR Limited manufactures a product in batches of 2000 units. Following costs are incurred for every batch: material cost, labor cost, overhead absorption cost, variable in nature, expected rejection rate, scrap value per rejected unit. So, what will we do with rejection is what we are going to see here. Expected rejection rate, scrap value per rejected unit, selling price per good unit is 250, total available hours per month is 3000, fixed overheads is 125, batches manufactured per month is 10, which means one batch is going to take 300 hours. One batch is going to take 300 hours, assuming The entire machine hours is used for 10 batches. We are going to take one batch 300. They want contribution per good unit after adjusting what? Rejected units. After adjusting rejected units. Working note 1. Computation of contribution per batch. Contribution per batch. Particulars calculation amount. Contribution per batch. Sales. Sales. Now listen. One batch is 2000 units. In the 2000 units, 3% will be rejection, which will give me lesser value, and normal units will give me higher value. Of the 2000 units, rejection is how much? How many units is rejection? 60. And good units? So 2000 into 97% into 250 plus 2000 into 3% into 75. This is what every batch will give me. 2000 into 97% into 250. Put together how much you will get? 4,89,500. This is basically I earn from 1940 units, including the scrap, everything, less material cost. Material cost per batches 2,40,000. We are doing just one batch. Labor cost 1,65,000. Read carefully and tell me the variable overhead. Variable overhead. Variable overhead will be how much? 120 into 3000 by 10. 3000 by 10. 36,000. Contribution per batch. Deduct all of this, you'll get contribution per batch. Contribution per batch. 50,500. I have taken the scrap sale value in the calculation. Not sure what IC has done. Ideally, this is what they should do. 50,500. Any doubts on this? Number of good units per batch. Sorry? Okay, 48,500. 48,500. Number of good units per batch 2000 into 97%. 2000 into 97%. 1940. And once you divide, you'll get contribution per good unit. 48,500 by 1940. You earn 25 rupees per good unit. Every batch we will earn 25 rupees per good unit. Clear? Question has asked for what is the overall profit. Overall profit is very simple. 48,500 is for one batch. We have how many batches? 10 batches. So total contribution 48,500 into 10 batches. 4,85,000 less fixed cost profit, less fixed cost profit Fixed cost is how much? 125. Profit is 360. 25 rupees and profit is 360. Any doubts on this? Clear? I'll close this also. With this segment will get over. Let me see. Yeah, let's close this also. Go through this question. Okay, let's read it. SW manufactures linen bed covers. Present cost data are as below. Variable cost of manufacturing per unit 200. Variable cost of selling and distribution 100. So variable cost is 300. Fixed cost is 16 lakh. Selling price is 800 and I make a profit of 8 lakh rupees. Management could sense a stage of stagnation or deterioration in future sales because of a new entrant. SW has approached to one marketing consulting company for the study of the CVP. Firm suggested three alternatives to fuel the sales growth. Reduce selling price by 10%, 12.5% and 15%. Sales units will increase by 15, 20 and 25. So we need to see which is better. 10% fall, 12.5% fall, 15% fall and units will go up. First thing we need to find out is how many units are sold today. How many units are sold today? Now right, units sold is equal to profit plus fixed cost by contribution per unit. Profit plus fixed cost by contribution per unit. Units sold is equal to profit plus fixed cost by contribution per unit. Today, 8 lakh plus 16 lakh divided by 800 minus 300. 800 minus 300. This will give you the units sold today. This number will give you the units sold today. What's the unit sold? Now we need to do three statements. I will do only this statement. The first statement where selling price has gone down by 10, others the same calculation. 4,800 units we are selling today at a price of 800. We are going to bring down the price and see the impact. Let's do an evaluation of alternative 1. Particulars per unit total. Only one alternative we will analyze. Selling price less variable cost contribution per unit less fixed cost and profit. Selling price in the first alternative 800 minus 10%, 720. 800 minus 10%, 720. Variable cost continues to be 300. Contribution is 420. Contribution is 420. And units, earlier was 4,800 units. Units will go up by what number? 15%. How much is that? Now you multiply 5520 into 720. 39 lakh, 74 400. 300 into 5520, 16 lakh, 56,000. 20, 23 18 400. Fixed cost continues to be 16 lakh. Profit is, so profit is going down only in the first alternative. Like this, you'll have to evaluate all the three. So first alternative, profit goes down to 718. Second also goes down. Third also goes down. So final conclusion is you should continue with the existing itself, because all the three profit is going down. And in case the company still wants to accept something because they want to do more sale, then go ahead with alternative one, because lowest impact is there. Clear? With this, my major segment of marginal costing got over. I have two more segments which we'll do it after the break. We resume by 10:30. Okay, let's proceed now. We are done with the six segments of marginal costing. Two major segment is pending. One is marginal versus absorption, a small discussion around that, and then an important area called limiting factor. First, go through question 19, then I'll explain the concept. Go through 19. RN Limited is a manufacturing company producing single product. Following information is available relating to current financial year. If we operate at 100%, sales is 88 lakh. Production cost is 3520, 100% is 4,400 units, and fixed cost is 880. 1760, fixed cost is 1320. So we technically have four types of cost, which is what they have given: variable production cost, fixed production cost, variable non-production cost, fixed non-production cost. And we have two methods of valuation. One is called absorption costing, second is called marginal costing. Fixed costs are incurred evenly throughout the year, and actual fixed costs are the same as budgeted. At 50% activity level, fixed production cost and fixed selling and distribution cost remain same, and other data varies proportionately. They're saying fixed cost, whether you do 50%, 100%, everything will remain same. Normal level of activity for the year is 4,400. No stock at the beginning. In the first quarter, 1210 units were produced, 880 were sold. You are required to compute the profit for the quarter using absorption costing and then marginal costing. First, do working note on profit statement under absorption costing. Profit statement under absorption costing. Particulars calculation amount. Particulars calculation amount under absorption costing. variable production cost. Variable production cost. The question can give names like direct material, direct labor, else they may say only one name, variable production. Variable production cost is 35 lakh 20,000 for 4,400 units. So divide and tell me per unit is how much? 3520 by 4,400. 800. 800 into 1,210. We have produced 1,210 units. 800 into 1,210. 9 lakh 68,000. Fixed production cost. Fixed production cost. Now see here, it says 8 lakh 80 for a year. We are doing the calculation for a quarter. So 880 divided by 4 is 220, but we don't write 220. We don't write that. What we do is again do 880 divide by 4,400. That's called overhead absorption rate. So leave some space and write overhead absorption rate is equal to 8 lakh 80 by 4,400. Leave some 10 12 lines and write the OAR. 8 lakh 80 by 4,400. How much? This is called overhead absorption analysis, 200 per unit. Like variable, it was not overheads analysis, but here this is a overhead absorption rate. 200 rupees is the absorption rate. 200 into 1210. 200 into 1210. What will happen to balance? It's only 2 lakh 20. Why are we writing 242? We'll understand in some time. 200 into 1210. Cost of production in bracket 1210 units. 1210 units, 12 lakh 10,000. 1210 units, 12 lakh 10,000. Add opening stock 0, less closing stock 1210 into 1,000 rupees. Not 1210, sorry. Closing stock is, what is the sales? 880 units. So closing stock is how much? 330 units. COGS is 880 units. Closing stock is 330 units. Closing stock is 330 units. 330 into 1,000 rupees. Fixed cost number which we have written in the top is technically wrong, but what will happen I'll explain as we proceed. 8 lakh 80. We should ideally write fixed cost as 880 divided by 4. Quarterly analysis 880 divided by 4. But instead of writing that, we wrote 2 lakh 42. Clear? Next is variable selling cost. Tell me the per unit cost. Variable selling cost 17 lakh 60 by 4,400. 17 lakh 60 by 4,400. 400 into unit sold is 880. It's only on unit sold. Into 880. 3 lakh. Fixed selling cost. No need to calculate per unit and all here. No need to do per unit. Directly divide by 4. Quarterly analysis. Fixed selling cost 13 lakh 20. Why is this distinction? You'll understand in some time. 13 lakh 20 divided by 4. 3 lakh 30,000. Cost of sales. Cost of sales. How much the cost of sales? Sorry? Now wait. The reason for not writing 2 lakh 20 is, if you write 2 lakh 20 here, the COP number will be different. COP different, per unit will not be 1,000 then. The per unit number will not be 1,000. Today 12 lakh 10,000 divided by 1,210, you get 1,000 rupees. If you write the exact fixed cost, you will not get 1,000 per unit. Then what should I do? The actual fixed cost is only 2 lakh 20, but we wrote 2 lakh 42. Actual is only 2 lakh 20 right here. Over absorption of fixed overhead, 2 lakh 20 and 2 lakh 42. Cost is only 220, but we wrote 242. Right, negative 22 here so that cost goes down. Negative 22 here so that cost goes down. If you write 220 in the fixed production cost, COP will go down, cost per unit will go down, FG valuation will go wrong. That is why above COP we go with absorption logic, and once the COS is calculated, you do under or over absorption adjustment. This question over absorption, some question under absorption can also happen. Revised cost of sales. Revised cost of sales, profit and then sales. Revised cost of sales, 15 lakh 40. Revised cost of sales, 1540. What is the selling price per unit? 88 lakh divide by 4400 into 880. Get the sales number. 17 lakh 60,000. Profit is 220. Profit is 220. Clear? This is margin absorption costing, where all production cost is considered for inventory valuation. Then we do marginal costing, which will give a different profit. And then some question may ask even for a reconciliation. Any doubts still on this? Only thing is, above COP you have to write absorption number and then do an adjustment called under or over absorption. Working note 2, profit statement under marginal costing. Profit statement under marginal costing, particulars calculation amount. Sales less variable cost, contribution less fixed cost, profit. Sales less variable cost, contribution less fixed cost, profit. Little bit of changes will be there in the calculation. Sales number is same, 2000 into 880. Variable cost, note 1. Computation of variable cost. Computation of variable cost. Now, what we are going to do is we are going to calculate the variable cost. There are two variable costs. One is production cost and second is non-production cost. Both we have to consider. Variable production cost. Variable production cost, 3520 by 4400 into 1210 into 1210. Variable production cost, 9 lakh 68,000. This is for 1210 units. We have sold only 880 units. Add opening stock here itself. Add opening stock 0, less closing stock. Less closing stock. 330 units into 800 rupees. That's the only difference. There it was 1000 rupees, here it's 800 rupees. There fixed cost was also considered for inventory valuation. Here only variable production cost is considered for inventory valuation. There it was 1000 rupees per unit. We did inventory valuation 330 into 1000. Here only 800 rupees. Only 800. The 200 will not come, which is a fixed production cost. This will lead to difference in profit, and then the difference in profit is because difference of closing stock. Tell me the closing stock value. 2 lakh. Variable COGS. Variable COGS. Variable COGS. Variable COGS. 7 lakh. 7 lakh 4,000. Then variable selling overhead. Fixed cost itself does not come into analysis as of now. Variable selling overhead. Variable selling overhead. Variable selling overhead. Whatever was the number, variable selling overhead is 1760 divided by 4400 into 880 units. How much? 3 lakh. Total variable cost. Total variable cost. Production, non-production, all put together. The difference is closing stock valuation. Here closing stock is 264. There the closing stock is 3 lakh 30. Both will lead to variation in profit. Your marginal costing profit will be different now. Deduct 1056. 1056. Deduct 1056. 7 lakh 4,000. Deduct 1056. 7 lakh 4,000. Fixed cost, no concept of absorption, all that is not there. 2 lakh 20 of fixed. Production cost is 2 lakh 20, 8 lakh 80 by 4, and 3 lakh 30 of sales. 220, 330. No concept of under recovery, over recovery, none of that. Directly just write 2 lakh 20, 3 lakh 30. There we had to write 242 in the top. Then we had to write below negative 22. All that is not needed. Directly 2 lakh 20 and 3 lakh 30 was the profit we make. 1 lakh 54,000. How much is the difference in profit between the two methods? Same will be the difference in stock value also. Stock value difference will also be 66,000. Because closing stock value is different, that is why this problem is happening. Otherwise, this issue will not happen. Clear? Any doubts on this? Done? Okay, the last segment is on an area called limiting factor. Uh, let's go through this and I'll explain. Go through 20. Okay. Division Z is a profit center which produces four products A, B, C, and D. Particulars, four products. Product A, profitable product, market price 150, variable cost 130. Product B, profitable. Product C, profitable. Product D, profitable. All the four are profitable products. If a product is profitable, I should ideally go ahead and meet the demand. In the practical world, there is something called as limiting factor. What is limiting factor is? The first limiting factor is always the demand from the external market. So many products I don't produce more units because demand is not there. So here they have given the demand. If this is the demand, I then need to check. I need to check whether do I have adequate capacity. What is adequate capacity? Men, material, machine and money. Four factors of production. Do we have adequate men, material, machine, money? If you have adequate, go ahead and meet the full demand. If you do not have adequate, then you have to do pick and choose. How do you pick and choose is what this question is all about. Identify the production pattern if the available labor hours are 20,000 and 30,000. So only limiting factor possible here is labor. There can be labor hours, machine hours, raw material, anything can be limiting factor. Here the only possibility is labor hours. So let's first check whether do we have adequate labor hours or not. Working note 1, identification of limiting factor. Identification of limiting factor of limiting factor. Labor hours needed is equal to labor hours needed is equal to 2800 units into 3 hours. I'm checking whether I can meet the entire demand. 2800 into 3, 2500 into 4, 2300 units into 2 hours, 1600 units into 3 hours. All put together, how many hours we need? $27,000. They have given two situations. One situation they are saying 20,000 hours. Second situation they are saying 30,000 hours. If 30,000 hours is available, production pattern is full demand we will meet. 2800 of A, 2500 of B, 2300 of C and 1600 of D. We are going to meet the entire demand. So production pattern, labor hours is 30,000. If you have 30,000 hours, A equal to 2800 units, B equal to 2500 units, C equal to 2300 units, D equal to 1600 units. We will go ahead and meet the entire demand. No customer, I'm going to say no. If capacity is available, go ahead and meet the entire demand. Clear? Next, production pattern. If labor hours is 20,000 hours. If it's 20,000, I have to pick and choose. I have to say prioritize maybe product A or B or C or D. I'll have to do a prioritization. I have to decide which is the better product. For that, we do something called a statement of ranking, right? Note 1, statement of ranking. Statement of ranking. Particulars and 4 products. We have to decide which is a better product. To decide which is a better product, we have to do a statement of ranking. Particulars and 4 products. Selling price less variable cost, contribution per unit. First we will get this and then there is some more analysis to be done. Selling price, variable cost, contribution per unit. 150. You quickly copy from the question. Clear? Okay. Once this number is done, ranking is not based on this. Ranking depends on what is the limiting factor. What is the limiting factor here? Labor hours, right? Labor hours per unit. Labor hours per unit. Labor hours per unit. 3, 4, 2, 3. Contribution per labor hour. Contribution per labor hour. 20 divided by 3. 46 by 4. 50 by 2. 45 by 3. And a ranking based on this. Whichever earns me maximum contribution per labor hour, that is the best product. Whichever gives me maximum contribution per labor hour. Maximum contribution per labor hour. Which is the rank one? Product C, then D, then B, then A. We don't go by individual contribution per unit, we go by contribution per limiting factor, whatever is the limiting factor. Note 2, statement of allocation. What is statement, or you can call it as production pattern. Four columns. Product. Okay, 5 columns. Units, hours per unit, hours consumed, and last column is contribution. Product, units, hours per unit, hours consumed, and contribution. Which is the rank one product? What is the demand of C? 2000. Product C 2300. 2300. Hours per unit is 2. 4600 consumed. 2300 into 2, 4600 consumed. Our objective is that hours consumed total should not exceed 20,000. 20,000 is the outer limit. This will give me contribution of 2300 into 50 rupees per unit, or 4600 into 25 rupees per hour. You can do per hour or per unit, both are same only. 2300 into 50, 1 lakh 15,000. 2300 units into 50 or 4600 hours into 25. Any doubts on this? Which is the next rank? D. What is the demand of D? Participate 1600. Hours per unit. D. This will consume 4800. And this will give me 1600 into 45. The hours consumed cannot exceed 20,000. If it touches 20,000, we have to put a stop. What is the contribution here? 72,000. Next product. B. What's the demand? 2,500. Before you write this, check the total. If you are exceeding 20,000, you cannot write this. You cannot exceed 20,000. You have to keep doing that check. 2,500 into 4, 10,000. We are reaching 19,400. We have not touched the total of 20,000. This will earn me 2,500 into 46. How much? 1 lakh 15,000. Clear? Next rank is A. Now A full demand obviously is not possible, so I'm not writing the units. I go to hours consumed and write 20,000 minus 4,600 minus 4,800 minus 10,000. The hours consumed will be balancing figure. Tell me how many hours you can consume for A. 20,000 minus 4,600 minus 4,800 minus 10,000. 600. Last product, it is not necessarily that last product. Sometimes third also fully not possible. 600. What is the hours per unit? 3. Units is balancing figure. 600 by 3. Units is balancing figure. 600 by 3. And contribution is 200 into 20 rupees. The contribution column was not needed in this question. Some other question it will be needed. That's why I've shown that column also. Question has just asked for production pattern. Total contribution less fixed cost profit in case they ask a profit statement. Any doubts in this? Clear? Can you proceed? So allocation will happen based on the ranking. Ranking will happen based on contribution per unit of limiting factor. Contribution per unit of limiting factor. Any doubts in this? Go through 21. Okay, Moon Limited produces product X, Y, and Z and has decided to analyze its production mix in respect of these three products. Direct material, variable overhead, department A, department B. Rate per hour for department A is 4 and department B is 8. Annual production at present is this. Estimated selling price and estimate I have got it from the sales department is you can increase the sales of X, you can increase the sales of Y, you can increase the sales of Z. I get a surprise. There is a constraint on the supply of labor in department A and its manpower cannot be increased beyond its present level. What is the best possible product mix? Now, here last question said 20,000 available, 30,000 available. Here the availability first you have to calculate. What is availability is department A into what you are producing today. Department A into what you are producing today is the availability today. This requirement will obviously go up. So department A is a limiting factor. I will have to do a statement of ranking based on contribution per hour of department A. Contribution per hour of department A. And then I have to do an allocation. What will happen in allocation is you are having extra demand for the three product. You will produce the rank 1 product more by reducing the existing sale of the rank 3 product. Whichever becomes rank 3, you'll have to reduce the sales of the existing sales itself will go down because capacity is not there. So if I have to increase X, I have to reduce Y, or I have to reduce Z, or increase Z, reduce X, something we will have to do because they are asking us to do a best possible product mix and also calculate what contribution from the best possible product mix. Contribution is that last column. Note, let's start working note 1. Statement of ranking. Statement of ranking. First, available labor hours. Available labor hours is equal to, in bracket department A, available labor hours is equal to. Now let's understand what is available labor hours is. 10,000 units into 6 hours, 12,000 units into 10 hours, 20,000 units into 5. I am not going to write requirement and all because I very clearly know that this is a limiting factor. Last question I wanted to check whether it is a limiting factor or not. So here write 10,000 into 6 plus 12,000 into 10 plus 20,000 into 5. This is the available labor hours. 2 lakh. My requirement will obviously be more than 2 lakh 80. I need not do the calculation itself. Particulars in 3 products. Particulars in 3 products. Sales less variable cost, contribution per unit, department A labor hour per unit, contribution per labor hour, ranking. Only department A. We are not bothered about department B. Department A is the problem. Contribution per labor hour of department A and then ranking. Selling price is given in the question. What are the selling price? P12 400 240. Variable cost you'll have to put a total 160, 8 rupees, 6 into 4 rupees, 6 into 8 rupees. Labor cost hours they have given into 4 rupees into 8 rupees. 160 of material cost, 8 rupees of variable overhead, 6 hours into 4 rupees and 6 hours into 8 rupees. Put all the total 24, 48, 240, 160 plus 8 plus 6 into 4, 6 into 8, 120 plus 20 plus 10 into 4, 40 and 15 into 8, 300. Third product 80 plus 12 plus 5 into 4 and 11 into 8. 200 rupees. I don't want to spend much time on this analysis. Variable cost is 200, 240, 300 and 200. Contribution per unit is how much? 72. I will only focus on department A because that is the limiting factor. If department A was the limiting factor, department B. If both were limiting factor, A plus B. So denominator is department A labor hours 6, 10, 5. 6, 10 and 5. 6, 10 and 5. Contribution per labor hour is 12. Ranking is rank 1, rank 2 and rank 3. We don't go by individual contribution. If you go by individual contribution, Y would have been rank 1. We go by contribution per labor hour. Next, working note 2, statement of allocation. Same 5 columns, product, units, hours per unit, hours consumed, contribution. Hours cannot exceed 2,80,000. 2,80,000 is the outer limit. Product, units, hours per unit, hours consumed and contribution. 280 is the outer limit. 280 is the outer limit. Which is the rank one? X. X, I will now meet 12,000 units demand. I'll go ahead and meet the demand of 12,000, higher demand. How will I meet higher demand? By compromising rank 3 product. By compromising rank 3 product, I will meet extra demand of rank 1 product. So 12,000 units, 6 hours, 12,000 into 6, 72,000. 72,000. We have to ensure hours consumed do not exceed 280. That's the outer limit. Which is the next rank? Y, 16,000, 10. This is still fine. Third product, obviously fully not possible. Third product is not going to be possible fully. 16,000 into 10, 160. Contribution is 16,000 into 100. Clear? X, Y, which is the next rank? Z. I'm not writing the units here. Fully demand is not possible. Number of hours balancing figure and then we get the units. I'm not writing the units directly. Number of hours and then we'll get the units. So hours consumed is 280 minus 72,000 minus 160,000. How much? 48,000. 48,000. Hours per unit is how much for this product? Right? 5. 48,000 divided by 5. So Z, today we are selling some 20,000. We are bringing that down significantly. Z, we are bringing it down and giving it to X and Y. We are bringing Z down. Put a total. Total will give you the total contribution also, which is asked in the question. Question has asked for total contribution. Last question did not ask. How much? 28 lakh 48,000. Clear? Any doubts on this? Very similar to the previous question. Here the 20 and 30,000 number was not given directly, and to increase sale of one product we are compromising the sale of the other product. We are compromising the sale of the other product. Any doubts on this? Go through 22. I'll read the question and then I'll explain. X Limited is a manufacturer of garments. For the first 3 months, commencing on 1st April 22, production will be constrained by direct labor. Very clearly mentioned. It will have a limiting factor called direct labor. It's estimated that only 12,000 hours of direct labor will be available in each month. For market reason, production of either of the two garments must be at least 25% of the production of the other. There are two products, shirts and shorts. What they are saying is, if you prioritize shirts, if you manufacture 10 units of shirts, 2.5 units of shorts need to be manufactured, 25% of the production of the other product. Estimated cost and revenue per garment is as follows: sales, raw material, the limiting factor is direct labor. The limiting factor is direct labor. From the month of July 22, from July 22, there is no problem. Labor will no longer be a constraint. Company expects to be able to sell 15,000 shirts, 20,000 shorts in July. No opening stock. Other information is given. Calculate the shirts and shorts to be produced per month in the first quarter. In the first quarter, to maximize company's profit. So in the first quarter, I have to tell how many shirts and how many shorts. Thereafter, this part I am not going to do. Sales budget and production budget is budgetary control area. Sales budget, they have given the sales figure and it will keep growing at the rate of 10%. Production is equal to sales plus closing stock minus opening stock, which is something anyway we will discuss in budgetary control. Here, let's first do a statement of ranking, whether shirts is our priority or shorts is our priority. The limiting factor is labor. The limiting factor is labor. Working note 1, statement of ranking. Statement of ranking. Particulars, shirts and shorts. Selling price less variable cost. Contribution per unit. Labor hour per unit. Contribution per labor hour. And ranking. Selling price, less variable cost, contribution per unit, labor hours per unit, contribution per labor hour, and ranking. Selling prices 60, 44. Add up all the variable cost, fabric, dyes, direct labor. 3 items are there. 38. Contribution is 22. 12, 4 and 4. 22 and 24. 22 and 24. Labor hours per unit is direct labor at 8 per hour, 8 rupees and 4 rupees per hour is 8 rupees. So 8 divided by 8, 8 divided by 8, 1 hour, and 4 divided by 8, half hour. Only half an hour it takes for shorts and 1 hour for shirts. $22 and 48. 24 divided by 0.5, and ranking is rank 1 and rank 2. Now, allocation I cannot do it like the way we have been doing. Problem here is, have they told what is the demand of shirts and shorts? Anywhere for the first 3 months, not the later. Later is no constraining factor. They have not given the demand information itself. If the demand information was given, priority 1 is shorts, priority 2 is shirts. Only one information they have told. Production of either of them has to be 25% of the other one. So what we are going to do is, shorts is my priority. Now, right, let us assume let us assume x x to be the number of shots, x to be the number of shots, and 0.25x 0.25x to be the number of shirts. Shorts is my priority, but shirts I have to at least do 25%. I have to do at least 25%. So x is the number of shorts and 0.25x is the number of shirts. Now what I know is x into half an hour, 0.25x into 1 hour is equal to 12,000 hours. I have 12,000 hours. I don't know the number of units and all. X into zero point 0.5 and 0.25x into 1 is equal to 12,000 hours per month. This will give me the number of shots, and shirts automatically we will get. So then write x into 0.5, 0.25x into 1 hour is equal to 12,000. Get the answer to x. Get the answer to x. How many units? 16,000 shots. Number of shirts is 25% of this. 16,000 and 4,000. 16,000 and 4,000. Clear? Any doubts in this? Can you proceed? Other one we are not doing it. You will have to do a statement like this and a production budget. All this is budgetary control area. The limiting factor is only till the first time period, then later there's no limiting factor. Go through 23. Okay, a company manufactures four products. Annual demand for product, selling price, and variable cost is given. Demand, selling price, material cost, labor cost, variable overhead. Variable overhead is absorbed on a machine hour basis at the rate of 1.20 per machine hour. Fixed overheads 46. Production capacity is 8 lakh 15,000 machine hours. So only possible limiting factor is machine hours here, 8 lakh 15,000. PQR can be bought at 21, 24 and 48. This is a very critical information. What they are saying is they've given product P, Q, R. Let's assume my rank 1 becomes S, rank 2 becomes R, rank 3 becomes Q, whatever ranking you do. And ultimately, when you do manufacturing, you will not be able to meet some demand in the other situation. Here, demand will 100% be met. Why will it be met? In case I am not having capacity, I will buy at 21.36, sell it at 23.88. Buy at 21.36, sell it at 23.88. Or buy at 24, sell at 28.68. Buy at 48, sell at 55.08. But what otherwise can be done is, instead of buying, can you tell me the total of this three? Total of the three? 15.6. So if you can manufacture and then sell 15.623, huge profit. If you buy and sell, still profit is there. So this is not a question to decide whether we will sell or not. This is a question to decide how much we will manufacture and how much we will purchase from outside. How much we will manufacture and how much we will purchase from outside. We would want to purchase as less as possible and purchase only those products where the savings in manufacturing is very less. So here ranking will happen based on savings in manufacturing and not based on contribution per unit or contribution per labor hour. The calculation will happen based on savings. S, I cannot buy it from outside, so I'll meet the demand of S. S, I'll go ahead and meet the demand. PQR, we are going to do something called as ranking based on savings per labor hour or per machine hour. Savings per machine hour. Whichever gives me more saving, produce that first. S to 100% has to be produced. After that, produce next product, and next product. Whichever gives lower saving, maybe you buy it from outside. You can buy it from outside. Working note 1, statement of ranking. Statement of ranking. Product S, product S will be manufactured first. Product S will be manufactured first, as the same cannot be bought from outside. As the same cannot be bought from outside. Just give me a minute. There's some net issue. Okay. As the same cannot be bought from outside. I cannot buy this from outside, so I'll manufacture this first. Other products would be ranked based on saving per machine hour. Saving per machine hour, not contribution. Because sales is 100% going to happen. Only thing is, can I make it and sell and earn more, or it is less? That is the only thing we have to do. Saving per machine hour. Particulars in three products. Product P, product Q, and product R. P, Q, and R. Variable manufacturing cost. Our manufacturing cost. Put the total and tell me the manufacturing cost. P, Q, and R. P was 15.6. Q is 18.72. R is 30.48 plus 6.72 plus 2.4. How much? 39.6. Cost of purchase. Cost of purchase. My priority will not be to buy. My priority will only to be manufacture. If I purchase, it is at 21.36, 24, 48. Saving in manufacturing. If you manufacture, how much you will save? Saving in manufacturing. Saving in manufacturing. Doing manufacturing will save us money. How much is the saving? How much? 5.76. 24 minus 18.72. 5.28. 48 minus 39.6. Ranking has undergone a change. Ranking is based on savings here. Machine hour per unit and saving per machine hour, and then ranking. Machine hour per unit, saving per machine hour, and then ranking. Machine hour per unit, how will you calculate? How will we calculate machine hour per unit? They have given variable overhead absorbed at the rate of 1.20 per machine hour. Absorbed at the rate of 1.20 per machine hour. 1.44 divided by 1.2, 1.44 divided by 1.2, 2.4 divided by 1.2. 1.2 is the recovery rate and overall cost is 1.44. So machine hour per unit 1.44 by 1.2. 5.76 by 1.2. 5.28 by 1.2. 8.4 by 2. 4.8. 4.4. Technically, this is rank 2, this is rank 3, and this is rank 4. Rank 1 is already there. This is my rank 2. Rank 1 is the product S. Rank 1 is the product S. P is rank 2, Q is rank 3, and R is rank 4. Any doubts in this? Clear? Now I have to do a statement of allocation. After no contribution calculation, statement of allocation, then final profit statement. Because here allocation does not mean sale will not happen. We are going to sell all the units, just that some units we manufacture, some units we buy and sell. Next, statement of allocation. Statement of allocation. Product units, hours per unit and hours consumed. Product units, hours per unit and hours consumed. Overall hours cannot exceed 8,15,000. That's the outer limit. 8,15,000. First priority is yes. Then we have the other priority. Product S 99,000. You keep doing it. Refer the screen if you want. Keep doing it. Refer the screen if you want. do the allocation step. Refer the screen once you're done. Let me know if you have any doubts there. In other situation, if we are not able to manufacture, you cannot meet the demand. Here, that is not the scenario. We will meet the demand. How it is going to happen, we'll understand as we proceed. Any doubts on this? This is my allocation. Or some units I'll buy it from outside and sell. Only some units I'll buy it from outside. Others, so anyway, I manufacture. Or some units I'll have to buy it from outside. Any doubts on this? Clear? You are required to calculate the best product mix and profitability statement. Now write profitability statement. Profitability statement. Particulars for products in total. For products in total. Units sold. Units sold. Units sold. Units sold will be whatever the question is saying. 1 lakh 20, I'll meet it fully. 1 lakh 86, I'll meet it fully. 1 lakh 71,000, I'll meet it fully. 99,000, total is not needed. Only value will write total. Units sold. Units produced. 1 lakh 20, 186, 134, 800, 99,000. That product R alone, we are not able to make it fully. P made fully, Q made fully, S made fully. Units purchased. This alone, I have to buy something from outside because I do not have adequate capacity. I have to buy from outside. Clear? Any doubts on this? Contribution 1 lakh 20,000. Find out the difference between now selling price and cost price. Product P selling price minus cost of making. Selling price is 23.88. Cost of making was 15.6. 8.28. 1 lakh 20,000 into 8.28. You can write the numbers. I'm kind of done. 1 lakh 20,000 into 8.28. Second product, what is the contribution? 28.68 minus all the cost. Sorry, 9.96. Calculate, no? 28.68, 9.96. Third product, what is the contribution? 55.08 minus 30.48, 6.72, 2.4, 15 point. Okay, you've been listen mode. I don't think you will be able to do. Listen, here alone, another 36,200 units. Here my profit is purchase price and selling price difference. Purchase price and selling price difference, because these units I'm buying it from outside and selling it. Whatever I make, I can earn 15 rupees. But whatever I buy, I will earn 55.08 minus 48. Minus 48. Purpose was to make it internally so that you can earn more. Purpose was to make it internally so that we can earn more. But product R alone, that extra 36,200 units, you have to buy it from outside. You have to buy it from outside. Same way you will do S, put a total, less fixed cost, profit. I don't want to spend time. Lot of calculation will be needed. Any doubts on the concept here? Here R alone, two contribution you have to calculate. One is cost price and selling price difference, and second is purchase price and selling price difference, because some units you are buying and selling, some units are making and selling. If you look at final statement will look like this: from units produced, from units sold, you get the overall number, deduct fixed cost and get the profit. Any doubts in this? In case subcontracting option is available or purchase option is available, meeting the demand is certain. Only thing which is uncertain is, can I make it and sell, or I buy it and sell? That depends on which gives me more savings in manufacturing and which gives me less savings in. Not depend on contribution per unit. We are not bothered about. Till I came to profitability statement, I never discussed what is the selling price itself. Till we came to profitability statement, we did not discuss on the selling price, because selling price does not really matter. What matters here for us is very simple. We are only bothered about savings in manufacturing. Savings in manufacturing. Clear? Any doubts on this? Okay. Last question. Go through this. 24. Okay. ABC Limited is a well-known company for producing baby care product. Company produces and sells two variant of organic shampoo for children, Baby Rose and Baby Lily. Sales and cost data is given below. Current demand and sales, production capacity, selling price per bottle, direct material cost, other variable cost. Fixed cost amount to 5 lakh and 4 lakh 50,000. Production manager has informed that 1 lakh liters of material is available. So the limiting factor could be raw material. 1 lakh liters of material is available. This needs 8 liters. This needs 10 liters. 8 liters and 10 liters. A dealer has approached the company and proposed to purchase both the product at the existing selling price, which are to be produced by utilizing the remaining unused material. However, has insisted that all bottle must be packed with an eco-friendly packaging, which will result in additional cost of 10 per bottle for the company. Presently, the company is not using eco-friendly material. Prepare a detailed statement showing the overall contribution and profit of the company after acceptance of what? Dealer's proposal. Now, what happened here is, I have capacity. I'm already selling this. I'm not going to touch this. Already, whatever you're selling, we are not going to touch this. Because what dealer is saying is, can you use the unused raw material? Can you use the unused raw material and produce the two products for me and give it to me. So what we are going to do is we are first going to decide what is the ranking. Is Rose a better product or Lily a better product? We will decide it. Only difference here is there is an extra 10 rupee per bottle for the dealer. Once we decide which is better, then we will do a statement of allocation. In that, first 4,000 of baby rose will be done, 3,000 of lily will be done, and extra whatever is available, I will give it to rank 1 and rank 2 product. Extra availability will only go to rank 1 and rank 2 product. Working note 1, statement of ranking. Statement of ranking. Particulars and two products. Selling price. Here the limiting factor is raw material. Dealer has told the same price, he may tell a lower price also, but here he has told the same price. What is the selling price dealer is saying? 600, 750. In the variable cost, extra 10 rupees for eco-friendly packing for both the products. Extra 10 rupees because dealer wants us with that eco-friendly packing. Extra 10 rupees. 440, 160 plus 270 plus 10 rupees. 560. 440 and 560. Contribution per unit is 160 and 190. Raw material per unit is 160 by 28 liters and 200 by 20 10 liters. Rank 1 and rank 2. Rose is my rank 1, Lily is rank 2. This contribution 160 and 190 is only in case you give it to dealer. Outside you will earn extra 10 rupees because eco-friendly packing is not needed. As of now we are not doing any eco-friendly packing. So there we will earn extra 10 rupees. Any doubts on this? Working note to statement of allocation. Product, units, raw material per unit, raw material consumed, contribution. It's not labor related question, raw material related question. Product, units, raw material per unit, raw material consumed and contribution. Now we totally have 1 lakh liters of raw material. We will have to start allocating, but before that, normal demand, whatever is happening today, that will continue to be there. Only extra I can use. So first write baby rose, normal demand, 4,000 units, normal demand 4,000 units, 8, 32,000 liters consumed. 4,000 into 8, 32,000 liters consumed. And normal demand we are going to earn 170 rupees, not 160, extra 10 rupees. Eco-friendly packing is not needed. So 160 will go up by 10 rupees. So today we are earning 4,000 into 170. This will continue to be there. 6 lakh 80. Next, baby lily. Again, normal demand. 3,000 units. 10. 3,000 into 200 rupees. Extra 10 rupees. Extra 10 rupees. Now, beyond this, whatever is available, which is what I will go ahead and give it to the rank one. What was the rank one we had? Rows. Now, there also one limitation is there. The limitation is extra you can do only 3,500 max because your capacity is only 7,500. Production capacity is only 7,500. So, extra maximum I can do is only 3,500. Extra 3,500. From 4,000 I can do another 3,500 and give it to the dealer. Give it to the dealer. Why give it to the dealer? Because that is my rank one. So rows is what I will prioritize first. Give it to the dealer. Earn 160 rupees. So next write rows. Dealer demand. Dealer demand. 7,500 minus 4,000. We have to ensure raw material consumed do not exceed 1 lakh. 1 lakh is the available capacity. 1 lakh is the available capacity. It's a very good problem. 7,500 minus 4,000, 3,500 into 8, how much? 20. Put together only 90,000. Still we can do the other product. Put together only 9. But these units will not earn you 170 rupees. They'll earn you only 160 rupees. 10 rupees less. Eco-friendly packing. 3,500 into 160. 5 lakh 60,000. 3,500 into 160. Any doubts on this? And last is, this is balancing figure. Extra 10,000 liters is there. Only 10,000 liters is there. Use that 10,000 liters. Dealer is ready to buy any number of units. He is saying whatever is available, you give it to me, I'll take it. I had some limitation on rose capacity. We have used rose fully. Lily, we are not using it fully because raw material is not available. And this will give me only 190. Tell me the total of the last column. 20 lakh. This is the maximum contribution I can earn. 20 lakh 30,000. Any doubts on this? Clear? And if they want product wise, you'll have to do fixed cost, deduct product wise, and then do the statement. That is okay. Any doubts on this? Clear? With this, my discussion on marginal costing gets over. We have extensively discussed the area. Whatever is here, MCQ part alone, spend little bit more time. A lot of MCQs are there in the beginning. As well in the concept book, there are MCQs. So just spend some time on that. Clear? Okay. We'll take a break of 15 minutes and then resume. Okay, let's continue with the discussion. So we are done with first chapter, which is marginal costing. Now I move to activity based costing. Fairly simple chapter, but frequently tested area. Every exam, one question keeps coming in. We have 3 4 variant of question. First question we will do it fully. Second question onwards, I'll discuss only the critical adjustment which needs to be discussed. Let's go through question one fully. Go through the problem first. Go through the question. Go through question one. Okay. ABC Limited is a multi-product company manufacturing three products. Budgeted cost is as follows: three products. The budgeted direct labor hour rate is 10 per hour. Budgeted material cost is 2 per kg. Production overheads is budgeted at 99,450. Absorbed to product using the direct labor hour rate. So earlier we are following something called as a direct labor hour rate method. ABC now wants to shift to an absorption costing system. Sorry, following an absorption costing shifts to ABC. In ABC, these are the three main costs which they have analyzed along with cost driver. So ABC question, they have asked us to calculate cost per unit and total cost under absorption costing method, then activity based costing method, and what are the reasons for different product cost. It's a calculation heavy area. Let's start. Working note 1. Working note 1. Computation of OAR. Computation of overhead absorption rate under absorption costing method. Totally 4 steps we will do. Step by step we will do this. 5 working notes will be needed. OAR under absorption costing method. Particulars calculation amount. Particulars calculation amount. Budgeted overheads. Suitable base. Budgeted suitable base. OAR. Budgeted overhead suitable base, budgeted suitable base, and OAR. The budgeted overhead number is 99,450. Production overheads were budgeted at 99,450. Suitable base. The suitable base can either be machine hours or labor hours under traditional method. What is the basis they have said? Direct labor hours. Basis is DLH, direct labor hours. Direct labor hours. What is budgeted suitable basis? Multiplication. 4,000 units into 30 minutes. Into 30 minutes. 3,000 units into 45 minutes. And 1,600 into 60 minutes. Whole divided by 60 to convert into number of hours. This is the number of hours we are planning operations for. Tell me the number. And OAR is division 99,450 by 5,850. How much? 17 per DLH. 17 per direct labor hour. 17 per direct labor hour. Clear? Any doubts on this? Can you proceed? Working note 2. Computation of unit cost and total cost under absorption costing method. Unit cost and total cost under absorption costing method. Particulars and three products. Particulars and three products. Direct material, direct labor, production overhead. Direct material, direct labor, and production overhead. Direct material cost is 2 rupees per kg. 2 rupees per kg. 4 into 2. 6 into 2. And 3 into 2. 2 rupees per kg. And direct labor is 10 rupees per hour. Direct labor is 10 rupees per hour. Budgeted direct labor hour rate was 10 per hour. So 10 into 30 minutes by 60, 30 by 60, 10 into 45 by 60, 10 into 60 by 60, half an hour, 0.75 hour and 1 hour, 10 into 0.5 hour, 10 into 0.75 hour and 10 into 1 hour. Production overhead almost the same thing, but it is now 17 rupees. Production overhead is 17 rupees per labor hour. Your overhead fact labor cost was 10 rupees per hour. This is 17. 17 into half an hour, 17 into 0.75 and 17 into 1 hour. Cost per unit, number of units, total cost. Cost per unit, number of units and total cost. That's all. Very simple approach. This is traditional method. Multiply with the number of units and you'll get the total cost. Let me know if there are any doubts here. Unit cost and total cost under absorption costing method. Clear? Any doubts in this? Working note 3, computation of cost driver rate under ABC. Cost driver rate under ABC, 5 columns. Activity, total cost, cost driver name, cost driver quantity and cost driver rate. Activity, total cost, cost driver name, cost driver quantity and cost driver rate. So what happens in ABC is we are going to have separate rate for separate activity. There it was only one recovery rate, 17 rupees per labor hour. Traditional method, 17 rupees per labor hour. Here we will have different rates for different activity. The activities are given in the question. What are the activities they've talked about? Material handling cost is 29,100. Storage cost 31,200. Electricity 39,150 and the basis is also given. Weight, second one is number of batches, third one is number of machine operations. Weight of material handled, number of batches and number of machine operations. These are the three activities and the CD driver for that is given. We will come back to CD quantity in some time. Working note 4. Apportionment of overheads. We do this together only. Apportionment of overheads. Particulars. Number of products into 2 columns for every product. So 3 products are there. Totally 7 columns. Particulars. First product, 2 sub columns. Product A, CDQ amount product B CDQ and amount, and product C CDQ and amount. Copy paste whatever is the activity here. Material handling, storage cost, electricity, whatever is the activity there, you have to copy paste here. Material handling, storage cost, and electricity. Copy paste whatever activity is there. Now I have to write CDQ. Material handling, weight of material handled. For every product, we are going to write the weight. What is the weight? Is 4,000 units into 4 kg. 4,000 units into 4 kg. 16,000 kg. Similarly, the second product, 3,000 into 6, 18,000. 1,600 into 3, 4,800. Whatever is the weight of material handled, we have written that. Storage cost, number of batches. For number of batches, they have given the information directly. For complete production batches is 10, 5 and 15. 10, 5 and 15. So directly 10 batches, 5 batches, 15 batches. 10, 5 and 15. 10, 5 and 15. Electricity, number of machine operation. Number of machine operation per unit. For 1 unit, 6 operations, 3 operations and 2 operations. 6 operations, 3 operations and 2 operations per unit. It is per unit number. So 4,000 into 6, 3,000 into 3 and 1,600 into 2. Now what you need to do is put the total of the CDQ. 16,000 plus 18,000 plus 4,800. This will come here. 16 plus 18 plus 4,800. 38,000. Similarly, 10 plus 5 plus 15. And similarly, 24,000 plus 9,000 plus 3,200. How much? 36,200. Now CD rate is like overhead absorption rate. What is CD rate? Is like overhead absorption rate. Column 2 by column 4. CD rate is like overhead absorption rate. Divide and get the rate. 29,100 by 38,800. 0.75. 31,200 divide by 30. 1,040. 39,150 divide by 36,200. 1.4 decimal will take 0.0815. 1.0815. Like we had one recovery rate 17 rupees, here we have three recovery rate 0.75, 1,040 and 1.0815. Any doubts in this? Clear? Now what you need to do is multiply. Take this rate in the calculator, 0.75 into 16,000 equal to 16,000 equal to, don't press any other key, 16,000 equal to 18,000 equal to 4,800 equal to, I'll repeat, 0.75 into 16,000 equal to 18,000 equal to 4,800 equal to, take the next rate, 1,040 into 10 equal to I equal to and 15 equal to, the next rate 1.0815 into 24,000 equal to 9,000 equal to, we'll round off here, 9734, and 3,200 equal to, and put the total of the overhead cost. Getting the overhead cost is a very time consuming exercise. You have to recover every item separately. Put the total. Let me know in case you get any total difference. 48,356. The total of the three product will be 99,450. I'm getting 451, 1 rupee rounding off difference. 99,450 was the overhead. We had to break it like this to the various product. Any doubts on this? Every product you have to get the CDQ. Every activity get the CDR and keep multiplying. After this, number of units, and overhead cost per unit. We'll keep it as 4 decimal. Number of units 4,000, 3,000, 1,600. 12.089, 9.478, 14.1631, 14.1631. Clear? There are only three activities like this. There can be any number of activities in the question. Any doubts in this? Once this is done, we have to repeat the working note 2 again. Working note 2 again. Computation of unit cost and total cost under ABC. Unit cost and total cost under activity based costing. Repeat it again. Under activity based costing. Where only thing which will change is overhead cost. Overhead cost will undergo a change. Material labor remains same. ABC makes it more accurate distribution of overhead. The purpose of ABC is to do an accurate distribution of overhead. Accurate distribution of overhead. Production overhead, whatever we got earlier, 12.089, 9.478, 14.1631. This is what ABC is all about these 5 steps is what we have to do with certain changes here and there in every question. Some adjustment here and there will keep coming in. Broadly, this is what we need to do. Any doubts in this? Clear? Can you proceed? Any doubts in this? And the question may ask, what is the reason for difference? The reason for difference is very simple. ABC has multiple absorption bases, and in case of your traditional method, we have only single driver, either labor hours or machine hours. Go through question 2. Okay. SMD manufactures 4 products A, B, C, and D using the same production and process facility. Conventional method of costing wants to shift to activity based costing. 4 products are there. The direct labor cost is given. Machine hour rate, that is the overhead absorption rate, is also given in the question. Production are absorbed on machine hour basis. For ABC method, some cost relating to setting up, inspection, some percentage they have given. Cost related to material handling, some percentage. Statement showing the unit cost and total cost under absorption costing method. Unit cost and total cost under activity based costing method. What is the total overhead expenses? Have they given the total overhead expense? Is the total overhead expense given? No. So my working note 1, which is our OAR calculation, we will do that working note to calculate total overheads. Why total overheads? Because once I calculate that, I'll bifurcate like this under the ABC method. Under the ABC method, we will do this bifurcation. Working note 1, computation of overall overheads, computation of total overheads, computation of total overheads. Same format, budgeted overhead suitable base and OAR, particulars calculation amount, budgeted suitable base and OAR. Now, I will fill it in the reverse order. We'll fill this in the reverse order. The OAR given in the question. Let's participate, please. 280 per machine hour. Basis is machine hours. Let's calculate the machine hours for all the 4 products put together. Machine hours is the basis. And the recovery rate is given in the question, 280 per hour. Machine hours we have to calculate 1500 into T plus 2500 into 2 plus 10,000 into 6 plus 6,000 into 4. 93? and in the reverse order 93,500 into 280. Please do second step only for the first product. Format remains same, but only for one product, product A alone. You do it and then refer the screen. Only product A. I don't want any other product. Same format, only product A. Do product A alone. Refer the screen after you're done. Only product A. Do only product A. Clear? Any doubts on this? Working note 3. Computation of CDR under ABC. CDR under ABC, 5 columns: activity, total cost, cost driver name, cost driver quantity, and cost driver rate. I'm not going to do for all the products, so we are going to do this step separately and the other step separately. Normally, I do it together to add up the CDQ. In exam, you do it together so that you can add up the CDQ. In class, I'm going to do 3 separately and 4 separately. We are going to do only one product calculation: activity, total cost, CD name, CD quantity, and CD rate. The question has said cost relating to setting up, inspection, bear the equal percentage, cost relating to machinery 20%, cost related to material handling 50%. So totally 4 cost I see. One is setting up, second is inspection, third is machinery related cost, fourth is material handling cost. Let's write them first. Setting up, inspection, machinery related, and material handling. Setting up, inspection, machinery related, and material handling. Overall is 2 crore 61 lakh 80,000. You have to bifurcate into these 4. Now, what it says is, again, let's read it. Cost relating to setting up and inspection is equal percentage. What percentage we don't know. Machinery is 20%. Machinery is 20% of the production overhead. Machinery is 2 crore 61 lakh 80,000. That is why we calculated that into 20%. Into 20%. 50. 2 crore 61 lakh 80,000 into 20%. 5236. Material handling, something they mentioned. 5236, half of that. 26 lakh. Now from 2 crore 6180, remove these two. Balances equal setting up, equal inspection. Remove these two items from 2 crore 61 lakh 80,000. Remove these two items. Balances equal from 2 crore 61 lakh 80,000. Remove these two items. 1 crore 83 lakh 26,000 equal. 1 crore 83 lakh 26,000 by 2 equal. 91, 9163. Clear? Equal amount. Now look at the question and tell me setting up what can be the driver. Number of setups, inspection, number of inspection, machinery, machine hours, material handling, and please put the total. We would have ideally done the next working note and then put the total, but here TK. I don't want to do all the products. Setting up setups total 1225, inspections total 2000, machinery related machine hours we already have the number 93,500 in the first working note 93,500, material handling 15, 20, 100 and 85 and get the CD rate. Clear? Now we'll apportion the overhead only one product. We'll do only product A. Other products we are not doing. Working note 4. Apportionment of overheads. Technically, you will need 9 columns. We will open only 3 columns. Only one product we are doing. 9 columns you will need. Every product 2 sub columns. Apportionment of overheads. Product A CDQ amount. CDQ and amount. Copy paste whatever items are there in the earlier working note. Copy paste earlier working note items. Copy paste the earlier working note items. It is a slightly calculation heavy area. You complete it and then refer the screen. Setting up number of setups into 7480 for the product A. You do it and then refer the screen. Almost the same working note only. Just that we are doing it only one product. Once you are done, check and let me know in case any errors are there. overhead cost per unit. In case you get anything different, let me know. And then substitute this in working note to get the cost per unit under ABC. That's your last working note. We'll have to substitute this in working note 2. Any doubts on this? Any doubts on this? Let's do that. Computation of unit cost and total cost under ABC. Under ABC, overhead cost alone will change. Any doubts on this? Any doubts on the apportionment of overheads? Setting up, number of setups into 7480, inspection into 4581, machinery into 56, and material handling into 11,900. Unit cost and total cost under activity based costing. Activity based costing. Production overhead will change. Please complete it. Production overhead will change. Any doubts on this? A fairly simple thing. The only thing here was the overall overheads was not given, so you had to do a working note to get the overall overheads and then bifurcate based on the percentages given in the question. They have given certain percentages, bifurcate based on the percentages given in the question. Any doubts on this? Clear? Go through three. Go through the question. A slightly lengthier one. Okay, let's read it. Home Mart is the latest trending brand offering home improvement appliance with the broadest selection of product with highly competitive price. The sale is increasing year by year with huge multiple. Current year also the sales reached triple the last year. Reason being company having good customer support where it provides after sale assistance over phone per item sold. So it cost one per item sold to the company. One per item sold to the company. Some support cost, customer support, 1 rupee per item. It is enhanced to 49 lakh 15,000, making a huge impact on the total support cost. All the company's appliances have been categorized into fan, decor, and furniture. Revenue is given, cost of goods sold is given. In business, there is a saying the packaging sells first time. Smooth return of cartons, the company has to incur some cost of 5 lakh 76,000. Some more information relating to each of the product line is item sold, number of deliveries, number of purchase order placed, hours of self stocking time. Somewhere this is activity, total cost, cost driver name, cost driver quantity, cost driver name and cost driver quantity. They have given all that. First is total support cost and its percentage to COGS. Earlier they were doing it on the basis of COGS, total support cost and its percentage to the COGS. Like machine hours, labor hours, it is on COGS. Then operating income. What is operating income? Is EBIT. Operating income is EBIT as a percentage of revenue for each of the product line. They have given three product line. We'll first do only one product line. We do mostly will be able to tick the answer. Then CDR calculation. Then operating income under the activity based costing. Again, one product we do, we may get the answer. And operating income as a percentage of revenue. As a percentage of revenue. Working note 1. OAR under computation of OAR under traditional method or existing method. Existing method is COGS based. Existing method, particulars calculation amount, budgeted overhead suitable base, call it as budgeted support cost. The name is different, that's all. Budgeted support cost, suitable base, budgeted suitable base, and OAR. Budgeted support cost, suitable base, budgeted suitable base, and OAR. Now, let's understand what are the support costs we have. We have delivery related cost, we have ordering related cost, we have shelf stocking. Also, we have this 1 rupee per item sold customer support cost. 1 rupee per item. This is last year cost, no use to me. I will calculate with this. 1 per item sold. 1 per item sold. And there's another cost called returning of the material. Some smooth return of the carton. We are incurring some 5 lakh 76,000. Totally 5 costs are there. 3 costs in the table. 1 rupee per item sold in that para and 5 lakh 76,000. Let's write all of them. 1 crore 20 lakh 96,000 plus 7488 plus 8294 400 plus 5 lakh 76,000. This is return cost. And add up all the item sold into 1 rupee. Item sold into 1 rupee. 1 rupee per item sold. Add up the item. 1209 600, 105 98 400, 29 37 600. Huge expense. 1 rupee per item sold. How much? 1 crore 47. Tell me final total of all of this. 4 crore 32 lakh. Earlier what we were doing is we used to distribute. The question says percentage to the COGS. Percentage to the COGS. So maybe the distribution was done on the basis of COGS, where all the support costs are allocated on the basis of COGS. So suitable basis COGS. Add up the COGS of 3 product. It's given in the para. COGS of 3 product. In the third para it is there. It's good question. Just that time consumption will be more because of the values. The values are huge. Divide and get the OAR. 4 crore 32 lakhs. divide by 14 crore 40 lakh into 100 to express in percentage, into 100 to express in percentage, 30%. Earlier, very simple method, revenue less COGS gross profit, support cost is 30% of COGS and operating profit. So part 1 is done. Total support cost is 4 crore 32 lakh and percentage to the COGS is 30%. Percentage to the COGS is 30%. Any doubts in this? We normally do cost calculation here, working note 2, profitability statement. Only one product, particulars on the first product. Particulars, first product, fancy fans. What we were doing earlier is taking the support cost as 30% of COGS. No analysis of what category of cost and all. Revenue less COGS, revenue less COGS, gross profit less support cost, operating profit, and operating profit percentage. Revenue less COGS, gross profit less support cost, operating profit and operating profit percentage. What is the revenue of the first product? 3 crore 80 lakh 88,000. 3 crore 80 lakh 88,000. 3 crore 80 lakh 88,000. COGS, this will give you GP. How much? Chapter is very simple. Time consumption will be there. Support cost is 2 crore 88 lakh into 30%. 30% of COGS. 2 crore 88 lakh into 30%. 86 lakh 40. 6 lakh 48,000 and 648 by sales. 648 by sales. 1.70 percentage. 1.70 percentage. Any doubts on this? So with this 1.70 itself, we'll be able to close it. But in case you are not able to do with one calculation, you have to do the second product also, third product also. MCQ with 1.70 itself, I close. I don't do the other products. 1.7, 7.17 and 3.3 will be the answer. Next is working note 3. Computation of cost driver rate. Activity total cost, cost driver name, cost driver quantity and cost driver rate. Activity total cost, cost driver name, cost driver quantity and cost driver rate. Totally 5 activities are there. 3 are in the table, 2 are in the para. 3 activities, let's copy paste. Delivery, ordering, shelf stocking, customer support, product return. Delivery, ordering, shelf stocking, customer support and product return. I think copy paste from the question. Everything is directly given. 1 crore 20 number of deliveries 6,300. Everything is given. You copy paste and then refer the screen. The product return is related to only one product, fancy fans, that para talks about. So that will go only to fancy fans. And others we will distribute 1,920, 2,400, 480, and 1 rupee. Any doubts in this? Any doubts in this? If you look at product return, it says for smooth returning of cartons, the company has to incur certain carrier costs, and this is related to fancy fans. Point line number 3 says, following the saying, the company has the policy of taking back the carton of the product sold relating to fancy fans, to reduce the packaging cost. Any doubts in this? Tell me which of this is right. The third one, question number 3. Look at the numbers in your notebook and tell me which is right. Either it's A or B. Which one is right? Check and tell. Yeah, guys, please tell me. 1,920 per delivery, 2,400 per purchase order, 480 per stocking hour, and 1 rupee per item sold. Any doubts on this? Any doubts on this part? Now we will distribute the overheads for one product, fancy fan, and then calculate its operating income. Any doubts on this? Next, apportionment of overhead. Apportionment of overheads. Of overheads. Particulars, whatever is the product name, fancy fans, CDQ, and amount. Fancy fans, CDQ, and amount. CDQ and amount. A slightly time consuming question. Copy paste the activities. Every working note, this is very clear that you will only copy paste whatever activities you write there. Delivery, ordering, shelf stocking, customer support, and product return. Delivery, ordering, shelf stocking, customer support, and product return. Deliveries, number of deliveries based. How many deliveries are there for fancy fans? 600, 600 into 1920. Ordering, How many orders are there? 720. This is what the numbers will be. 600 into 1920, 720 into 2400, 1080 into 480, 1209 600 into 1, and 5,76,000 directly goes to this product. Directly goes to this product. Any doubts on this? It is time consumption area. We can't help it. Tell me the total of all of this. Total support cost 600 into 1920, 720 into 2400, 1080 into 480, 1209 600 into 1, 5,76,000, 51 lakh 84,000. And now we have to do a income statement, and based on the income statement I'll get operating income and operating income as a percentage. Any doubts on 5184? Any doubts in this? Clear? Next, last working note, profitability statement. Profitability statement. Support cost will change. GP, everything will remain same. Support cost will undergo a change. Quickly close this. Please do it, do it. Unless you practice, you will not get comfort. You do it. After the first question is done, everything else is just a formality. Forty-one lakh 4,000, 10.78%. That helps me in ticking the option. I need not do the other product. Exam also no need to do the other product. If you try doing every product, it will take away a lot of time. One product itself gives me the conclusion here. They have given the question in such a manner that with one product you can arrive at the conclusion. Clear? Can you proceed? Okay, go through four. One adjustment alone needs to be explained here. Go through this. Again, it's a very good problem. Okay, GST Limited is a multi-product company. Production and cost detail of its two products are given below. Quantity produced, material cost, labor hours, purchase requisition, production run, quality inspection. Wage rate is 14.5 and we are using a single overhead recovery rate based on DLH. Overhead incurred by the company is as follows and labor hours worked is 72,000. Here if you see this two products put together is only 1400, whereas here it is 72,000, which means there are more products in the company. We don't know how many products are there. There could be 10, 15, 20 products. They have given data for two products. Now I want to shift to ABC. ABC is where some challenge will come. Below para will be useful for ABC. We are required to calculate cost of P and Q using traditional method and then the ABC method. Let's first quickly close the traditional method. Working note 1, computation of OAR. Computation of OAR. OAR under absorption costing method. Overhead absorption rate under absorption costing method. Particulars calculation amount, budgeted overhead, suitable base, budgeted suitable base and OAR. Quickly write. Budgeted overhead, suitable base and OAR. The format driven chapter, straight away you will have to keep doing it in the same format. Budgeted overhead is add up all the expenses 45,000, 162, 27, 36. Add up all the total 2 lakh 70,000. Suitable basis DLH, suitable basis direct labor hours. Budgeted suitable basis 72,000. Normally it will be total of 2 or 3 product, but here no total, directly 72,000 and my recovery rate is 3.75 per DLH. Next, unit cost and total cost. Only one product we will do. Unit cost and total cost. Particulars product P. Particulars product P. Unit cost and total cost under absorption costing method. Absorption costing method. Now listen, whatever data they have given is for overall cost. So here you will do overall cost, divide by number of units and get cost per unit. Earlier question we wrote per unit, multiplied with the number of units and got total cost. So first is direct material 72,000. 72,000. 72,000. Direct labor is 800 hours. 800 hours into 14.5. How much? And overhead is 800 into 3.75. 3,000. Total cost, number of units and cost per unit. Total cost, number of units and cost per unit. 86,600. 86,600. How many units are there? 9,000. 9.622 per unit. 9.622 per unit. Clear? This is traditional method. Working note 3, computation of cost driver rate. Here some challenges will come. Cost driver rate, activity, total cost driver name, cost driver quantity, and cost driver rate. Activity, total cost driver name, cost driver quantity, and cost driver rate. Some challenges we will face here, and once that is tackled, I think the problem is over. Activity, total cost, CD name, CD quantity, and CD rate. CD quantity and CD rate. Coming to the information, what I get to know here is the three activities are quality control, setting up of machine, and store receiving. These are the three activities, right? Quality control, setting up of machine, store receiving. I'll come to total cost in a minute. The driver for that is also given here. Requisition is related to stores, setting up is related to setting up, and quality is related to quality. So quality control, quality test, setting up, production setup, store receiving, requisition raised. All these numbers are directly given. The challenge you'll understand. Number of quality tests 720, no totaling and all 7200, 5760. So the problem for us is I do not find a cost called quality control cost. I find a cost called technical staff, machinery operation, machinery maintenance, wages and salary of store staff. Whereas I want quality control, setting up of machine, and store receiving. They have given something else and I am in need of something else. So they are not mapping. We have to first find out what is quality control cost, what is setting up of machine cost, and what is store receiving cost. Come down below this. Note 1, computation of cost. Particulars in 3 columns. Particulars, quality control, setting up, and store receiving. Somewhere I want these 3 costs: quality control, setting up, and store receiving. Question has ended up giving something else. I want these 3 costs. Once that is done, problem is over. First cost is technical staff. Technical staff. Now listen. Technical staff salary should be distributed among machine maintenance, setting up, and quality control. Machine maintenance, setting up, and quality control. And then whatever you do to maintenance will be distributed in the ratio of 2:3 between stores and production setup activities. Some information they have given. Now come down below the table. Below the table, how much is the technical staff salary? 45,000. Break it into 3, whatever 3 they have given in the question. The 3 activities they have given is machine maintenance, 9,000, 1:2:2, setting up 18,000, and machine operation 18,000. Now this is okay. This is okay because I have these two activity. This you further break it into two. Further you break it into two. 9, 18 and 18. Maintenance is further broken down between two activities. What are the two activities they've said? Stores and production. Stores, production in the ratio of 2 is to 3. Stores and production in the ratio of 2 is to 3. Stores and production in the ratio of 2 is to 3. Now let's understand the net impact. What is net impact is stores will go to an activity called store receiving. Stores will go to an activity called store receiving. Production will go to an activity called setting up for production. Production will go to setting up. So this 3,600 right here, 3,600 store receiving, production 5,400 and another 18,000. Another 18,000. This is quality control. This is a typing. This is quality control. Maintenance, setting up and quality control. Quality control is 18,000. Quality control is 18,000. Any doubts in this? We have to bifurcate the 45,000. I'll repeat, this is the most important adjustment. 45,000 between maintenance, setting up and quality control. Maintenance further between stores and production. Between stores and production. Any doubts in this? Technical staff part is distributed. Others are fairly simple. Any doubts on technical staff part? What's the next expense? Machine operation 2 is to 3. 2 is to 3. Stores and production. Stores and production 2 is to 3. 1,62,000 into 2 by 5. 1,62,000 into 3 by 5. 2 is to 3. Any doubts on this? Clear? What's the next item? Machine maintenance again 2 is to 3. Machine maintenance again 2 is to 3. 27,000 into 3 by 5. 27,000 into 3 by 5. Into 2 by 5. $10,800. Store staff salary will go to stores activity of stores staff. And now put the total. The question did not give the way we wanted, so we had to do a redistribution. We had to do a redistribution. Redistribution. Once this is done, we'll end the step. That's all. We'll not do the balance part. That itself is sufficient. Last one is, I'll repeat again here what happened is in this question, they did not give the overhead cost for the activities which we want. They ended up giving it for something else. So what we had to do is we had to do a redistribution. After doing the redistribution, we can then go ahead and then complete apportionment of overheads, other steps you can do. Any doubts on this? Clear? Okay, I still have three more questions. I'm not going to solve these questions. I'll discuss the important adjustment alone because solving again will take away good amount of time. Go through five. Go through question five. Okay, I'll start reading it. It's exactly similar to the first question with a small extra adjustment. Baby Soft is a global brand created by Bioorganic Limited. Company manufactures three range of beauty soap. The budgeted cost and production cost is given. Production 4,000, 3,000, 2,000. Raw material, we have multiple raw material. Oil is there, butter is there, water is there, chemical is there, labor cost is there. Follows an absorption costing system and absorbs its production using direct labor hours, which were budgeted to be 1,98,000. The three major costs is forklifting, supervising, and utility. Exactly similar to the first question we did. In the first question, the three costs they had given was material handling, storage, and electricity. Here it is forklifting, supervising, and utility. Basis is given, everything is done. Prepare a statement showing the unit cost and total cost under absorption costing. Product cost using ABC approach. Everything is fine. Only one discussion I want to do. First is if you do traditional method, you will do OAR calculation. OAR is 1,98,000 divided by budgeted direct labor hours. What is budgeted direct labor hours? 4,000 into 30 minutes, 3,000 into 40 minutes, 2,000 into 60 minutes. You will get the OAR. Then cost per unit, raw material cost 60 ml. I'll just discuss the first product into 200 by 100. 60 ml into 200 by 100. 20 gram into 200 by 100. 30 ml into 15 by 100. 10 gram into 30 by 100. Labor cost 30 minutes into 10 and overhead cost 30 minutes into whatever rate you have decided. So that is fairly simple. When I come to ABC, the three costs are forklifting, supervising, utility. Supervising based on DLH, we have already calculated DLH. Utility based on number of machine operation. How will you do number of machine operation is 5, 5, 6 into the number of units. The main point is what is weight of material lifted? How will I get weight of material lifted? Because the same adjustment we had there, we had raw material 4 kg, 4 kg, 6 kg. We did the multiplication. How do I get weight of material lifted? They're saying consider mass of 1 liter of oil and filtered water to be equivalent of 0.80 kg and 1 kg respectively. Mass of output produced is equivalent to mass of input material taken together. Mass of input material taken together. Now, if I go back to first question, how much was the weight? Very simple. 4 kg, 6 kg, 3 kg. 4 kg, 6 kg and 3 kg. Now weight is total of all of this. Weight is total of all of this. 60 ml plus 20 gram plus 30 ml plus 10 gram. Weight is 60 ml, 20 gram, 30 ml, 10 gram. Ml and grams can't be added. I'll have to convert into grams. I'll have to convert into grams, for which the question has said mass of 1 liter of essential oil and filtered water is equivalent to 0.80 kg and 1 kg respectively. 0.80 kg and 1 kg respectively. Now write alone this. Question number 5. Question 5. Write alone this. Weight of weight of gold product is equal to weight of gold product is equal to weight of gold product is equal to 60 ml of oil. I'll have to convert into grams. 60 ml of oil I'll have to convert into grams. Butter okay. Water I have to convert into grams. Chemical okay. So how do I convert? They said 1 liter of oil is equal to 0.80 kg. 1 liter of oil is equal to 0.80 kg. Oil is 60 ml into zero point 0.8 into zero point 0.8. 60 ml into zero point 0.8. I'm converting into kgs. 1 liter 0.80 kgs. 1 liter is point. We'll do that later. 60 ml into zero point 0.8. I'm writing it in grams only as of now. 60 ml into zero point 0.8. Butter is 20 grams. Butter is 20 grams. Water is 30 grams. Ml and gram is same for water. For water, they've said 1 liter of water is equal to 1 kg. Oil 1 liter is equal to 0.8 kg and water 1 liter is equal to 1 kg and chemical is 10 gram. Tell me the total of all of this. 108 grams. Then weight of pearl product. Pearl product 55 ml into zero point 0.8. 55 ml into zero point 0.8. 20 grams. 30 grams. 12 grams. Water ml and grams are same. For water ml and grams are same. One not 6. Do the third one. You do the third one and then check. How much? Clear? Finally, overall weight is equal to 108 grams into 108 grams into how many units of the first product? 4,000. This in the previous question they gave 4 kg. We directly did 4 kg. Here we had to do 108 grams calculation. That's the only difference. Into 4,000 plus 106 into 3,000. Put a total, finally divide by 1,000 to get into kilograms. balance part I'm not doing it. So you will calculate the CDR and then complete the question. So this is the only important adjustment which is there. Others are straightforward, same thing. You can repeat this question at home so that you revise whatever we have done in question 1, 2, 3, 4. Any doubts in this? Clear? Go through 6. Okay. Sales department of A Limited is analyzing the customer profitability for its product. It has decided to analyze the profitability of its 5 new customer using ABC method. It buys product at the rate of 5,400, sells at the rate of 6,480. The difference is my GP 6,480 and 5,400. But some customer, my selling price is lower than that. This is I give some discount to the customer. So first item is unit sold. Second is list selling price. When you multiply these two, this is the sales at the MRP level. Sales at the MRP level. From there, I deduct discount. So revenues at the list price. I deduct the discount which I give to every customer, and I get the after this deduction I will get the net revenues. I'll get the net revenues. So first is this, second is the discount I give, third is my cost of goods sold. What is cost of goods sold is 5,400 into the number of units sold. 5,400 into number of units. After this, you have to deduct support cost, for which the CDR is given directly in the question. The CDR is given directly in the question. So what you will do, 4,500 per purchase order, 15 into 4,500, 25 into 4,500, 30 into 4,500, 25 into 4,500, 30 into 4,000. 3,600 per customer visit. This into 3,600. 7.50 per delivery kilometer. Per delivery kilometer. What is per delivery kilometers? Number of deliveries into kilometer traveled per delivery. Number of deliveries into kilometer traveled per delivery into 7 rupees 50 paise. 22.50 into per case sold, and 13,500 into some urgent delivery which you have made. If you made some urgent delivery, into the number of urgent delivery, and this will give me profit. This will give me the profit customer wise. Here what they can make it more complicated is they can ask you to calculate this. They have given the CD rates. Our job is just to do the multiplication, deduct it and get the profit number. Deduct it and get the profit number. Clear? Able to understand this? So here I keep deducting all of this and get the operating income customer wise. Any doubts in this? So one is revenue at the list price, deduct discount, deduct cost of goods sold, and various support cost as given in the question. Important part is delivery cost, where you will have to do 7.50 per delivery kilometer. What is delivery kilometers? Number of deliveries into kilometer traveled per delivery. Number of deliveries into kilometer traveled per delivery. Any doubts in this? Last question, go through 7. Okay. MST Limited has collected the following data for its two activities. It calculates cost rate based on cost driver capacity, based on the cost driver capacity. So capacity is given here. 60 lakh divided by 60,000 will give me the OAR or CDR. So 60 lakh divided by 60,000 is 100. 90 lakh divided by 10,000 is 900. Now the problem here is when you do it on the basis of the capacity and not actual utilization, there can be under recovery or over recovery. There can be an under recovery, which is the second part. Calculate the cost of unused capacity of each activity. How will I calculate the cost allocated to each product? Product M, let's just discuss M. 10,000 hours into 100 rupees, 3,500 inspection into 900 rupees. 10,000 into 100, 3,500 into 900. The problem is I have 60,000 kWh and actual utilization is only 45,000. Actual is only 45,000. So we have wasted 15,000 into 100. We have wasted 15,000 into 100. No customer would be paying for that because we have not used that capacity. Whatever capacity we used, we recovered at the rate of 100 per kilowatt hour. Unused is 15,000 into 100, and in this case the unused is 1000 into 900. 1000 into 900. So that will be your unused capacity. Leftover number is unused capacity. 60 lakh minus 45,000 and 90 lakh minus 81,000. The balance is unused capacity, which no customer would be making the payment. Any doubts on this? With this, we are done with two chapters. I'm done with marginal costing and I'm done with activity based costing. Marginal costing is 12 marks. ABC is very, very critical. Question keep coming in exam. Every attempt you see, you will see a 10-mark question coming from ABC till now. And we have only 4-5 different types of question. First question we did and some add on. Marginal costing, at least anything different can come. But here there will be a base question. Then they may add saying that overhead figure is not given. You do reverse working, or you may have to do redistribution, or you may have to do an income statement, or you may have to calculate the weight differently, or you may have to calculate the unused capacity. Some adjustments like that can happen, but predominantly whatever we have discussed will take you 10 marks as far as ABC is concerned. Only thing is time consumption. When you do an exam question, it will be a time consuming question. Clear? Any doubts on this? With this, we are done with 22 marks. I'll continue in the next session with cost sheet, budgetary control. We will try to cover block 1 and block 2 fully. Block 3 is theory based. Block 4 we will see in case time permits, we'll do it. I'll end with this then. Thank you guys. Good morning friends. Okay, let's continue with the discussion. Previous session we are done with two chapters. One is marginal costing and activity based costing. Today I'm going to start with cost sheet chapter. Before I start with the question, let's quickly see the format of cost sheet. The format of cost sheet starts with your direct expenses, that is direct material, direct labor and direct expenses. Direct material, we have opening stock of raw material, add purchases, any incidental expenses, less closing stock of raw material, and then you get direct labor, direct expense, we get it as prime cost. After prime cost, we add factory overheads, gross works cost, add opening WIP, less closing WIP, net works cost. Then we have 5 line items which comes. One is called quality control cost, which is related to your NEQC activities, research and development cost, primary packaging. Primary packaging is to preserve the quality. There's something called a secondary packaging, which is for redistribution and attracting the customer. So primary packaging will come. Admin overhead relating to production, credit for recoveries or scrap, we get cost of production, add opening FG, less closing FG. Closing FG can be valued under two methods. One is FIFO method and second is weighted average cost method. FIFO method, cost of production by units produced into closing stock units, and average cost method is cost of production plus the value of opening stock divided by opening stock units plus the units produced into closing stock units. That is as far as your COP is concerned. COGS, then selling and distribution overheads, general and administrative overhead, cost of sales, profit and sales. Now in the cost sheet, there can be certain items which are ambiguous in nature. Ambiguous is because ICI classifies certain items. So just go through this list alone. This is a list of ambiguous item and where we classify them. They are debatable. They can go another classification also. Just go through this list. Ambiguous items and classification. Royalty says direct expense. That's okay. Power and fuel can be a direct expense, can be a factory overhead. Sometimes ICI does take it as factory overhead, so it's an ambiguous item. Majorly, ICI would have taken as direct expense. Molds and patterns, direct expense. Job charges. Job charges is if any work is done by an outsider, we call it as job work. They classify it as direct expense. Repair and maintenance for vehicle used by director, not a very difficult item, that's okay. General and administrative overhead. Insurance premium for stock of raw material. If stock has reached the factory, it's factory overhead. Raw material in transit. Transit means it's yet to come to the factory. In transit means it is incidental expense on purchase, will form part of direct material. Salary to production control manager. Production control manager, assumption is he is taking care of administration of the factory. So AOH relating to production. Lease rent of production asset can be factory overhead, can be direct expense. Special drawings, direct expense. Higher charges of occupancy, both are same. Lease rent of production asset is also same. Higher charges of equipment is also same. There's no different meaning, because lease rent is you pay rent on your asset. Higher charges means you're paying higher charges. Both are same only, but one place ICI has taken as direct expense, one place they've taken it as factory overhead. Carriage on return. What is carriage on return? Is some material came into the factory, you're returning the material. Returning the material. When you purchase any raw material, freight on that is incidental expense. When you sell finished product, the freight on that is called carriage outwards, and it is classified under selling and distribution. But this is carriage on return, will go as factory overhead. Expenses for participation in industrial exhibition, assuming it is for sale activity. Warehousing, assuming for sale activity. Utility, direct expense. So these are ambiguous items for classification. This you should revise day before exam so that you can go through this and then reproduce in case it comes in exam. Let's start with question 1. Go through the question. Okay, few items have been given in the question. We are required to prepare the cost sheet of the firm. Following information is related to manufacturing concern. Some production data is there, stock is there, and sold 14,153 units. Let's start. Cost sheet of manufacturing concern for the year ended 31st March 2019. Of manufacturing concern for the year ended 31st March 2019. Particulars amount. This is a starting question just to get started with, a fairly simple one. Particulars amount. Direct material, underline that, direct material. opening stock of raw material, opening stock of raw material, opening stock of raw material, 2,28,000. Opening stock is 228. What's the next item? Purchase of raw material, how much? 4225. Paid inwards, freight inwards will come, which is 1 lakh, less closing stock of raw material. Closing stock of raw material, which is 3 lakh 5,000. Only four items are there. Anything else there? Okay, listen. There's an item called sale of scrap of material. Now, scrap normally goes to an item called as your credit for recoveries are scrap. But in case question specifically uses the word sale of scrap, separate line item. Scrap arising out of manufacturing process, separate line item. Scrap of processed product, separate line item. Scrap of material, scrap of raw material, scrap arising out of material, that will go in the direct material expense itself. There itself you will deduct it because you did not use the material itself. So that item alone will go directly to direct material. So less sale of scrap of material, scrap of material negative 8,000, scrap of material negative 8,000. Five line items are there, 42 lakh 40,000, 42 lakh 40,000. Direct material 4240. Direct labor, direct labor. There's only one item, 1256 plus. They have given some outstanding. Outstanding also needs to be added. 1256 plus outstanding 1 lakh 50, 14 lakh 6,000. 1256 plus 150, 1406. Direct wages 1406. Direct expenses. Any item there, direct expense? Zero. Prime cost. Prime cost 56 lakh 46,000. Prime cost is 5646, 5646. Then we have factory overheads, which is 20% of prime cost. Factory overhead in bracket 5646 into 20%, into 20%, 11 lakh 29 200. Gross works cost 67 75 200. Gross works cost 67 75 200. 67 75 200. Add opening WIP 192 500, less closing WIP 140 700. Negative net works cost 68 lakh 27,000. After net works cost, we have five line items which are there. We'll have to write them. First question, I'm writing everything. Primary packing cost, primary packing cost not there. Quality control cost, research and development cost, admin overhead relating to production, that is there in the question. Admin overhead relating to production. How much is admin overhead relating to production? Less credit for recovery slash scrap. Credit for recoveries or scrap 0. Credit for recoveries or scrap is 0. Cost of production 70 lakh. Cost of production 70 lakh. Moment we come to cost of production, if we have information on units, we'll write the units also. Cost of production 70 lakh in bracket. How many units have been produced? 14,000. 14,000 units. Add opening work in progress. Opening FG. Sorry, opening FG. How many units of opening FG? 1217 units. Write the units in bracket if available. 608,500. Less closings FG. Cost of goods sold. Less closing FG. Cost of goods sold. Now, cost of goods sold. The units sold by the company is 14,153 units. 14,153 units. Leave some 7 8 lines and come down. Production plus opening stock units. Production plus opening stock units is equal to sales plus closing stock units. Debit side is equal to credit side. This will give us the units. Production plus opening stock units is equal to sales plus closing stock units. Sales plus closing stock units. Production plus opening stock units is equal to sales plus closing stock units. 14,000 plus 1217, 14,153 plus closing stock. Closing stock units you will get here. 1,064 units. 1,064 units. Now we can value the closing stock under two methods, FIFO method and weighted average method. Nothing is given, so we are following either of the method. Value of closing stock, I'm doing weighted average. Value of closing stock. Cost of production means you have to use COP, that's all. It doesn't mean it has to be FIFO method. Value of closing stock, COP plus opening FG divided by units produced plus opening stock units. Both method will give same answer here. Wouldn't make difference even if you do FIFO into closing stock units. Into closing stock units. COP we calculated is 70 lakh. Opening FG is 608 500. Units produced is 14,000. Opening stock units is 1217. Closing stock is 1,064. Let me know the value here. What's the value you get for closing stock? 5 lakh 32,000. 5 lakh 32,000. How much you get? 70 lakh 76 500. 70 lakh 76 500. COGS is 70 76 500. Cost of goods sold 70 lakh 76,500. Any doubts on the COGS number? 70 lakh 76,500. Then we do not have any. Okay, we have distribution expense, selling and distribution overhead. If per unit is given, it is on units sold. Selling and distribution overhead 14,153 into 16, 2 lakh 26,448. Cost of sales, cost of sales 73 2,948. Profit balancing figure, sales, sales is 14,153 into 618, 87 46 554, 14 43 606. Any doubts on this? Clear? Can you proceed? Any doubts? This is a starting question, basic question for us to get started with. Any doubts? Go through question 2. Go through the question. Okay. If fire occurs in the factory premises on 31st October, accounting records have been destroyed. Certain records were kept in another building. With that, we got some information. We are required to find out finished goods inventory as on October 31. That is closing FG, closing WIP, and closing raw material. The three things needs to be found out for us to get a insurance compensation kind of thing here. And they have given some information. Let's put it in the cost sheet format. Automatically, answer will come. Let's start. Question 2. Particulars, amount, particulars, amount, direct material, direct material, opening raw material, opening raw material. How much is the opening raw material? 20,000. Add purchases, add purchases, purchases is 2,50,000 less closing raw material. This is what we are trying to find. We'll see it. Closing raw material. Then we have direct labor. How much is the direct labor? 2,22,250. Direct labor 222 250. Direct expenses nil. Prime cost 3 lakh 97,750. Reverse working direct material balancing figure 397,750 minus 222 250 1 lakh 75 500 175 500. Now closing raw materials balance from 397 750 I deduct 222 250 I get 175 500. Closing raw materials balancing figure how much? Negative 9, basically 94 500. It comes as negative in the table 94 500. Any doubts on this? Then factory overheads, we have only one item. Indirect manufacturing cost is factory overheads, which is what? 40% of 40% into 222 250 into 40% 88 900. We get gross work cost 486 650. Gross works cost 486 650. Add opening WIP less closing WIP, net works cost. Add opening WIP less closing WIP, net works cost. How much is the opening WIP? 40,000. Closing we don't know. Net works cost. So two things I don't know as of now. Do we have any of those five line items? Quality control, primary packing, research and development. So net works cost, otherwise called as cost of production. Add opening FG less closing FG, cost of goods sold. Add opening FG less closing FG, cost of goods sold. Cost of goods sold. Question has said that the GP margin is 30%. Gross margin based on revenue is 30%, which means COGS is 70% of sale. COGS is 70% of sale. So cost of goods sold is 7,50,000 into 70%. 7,50,000 into 70%. 5,25,000. And opening FG is available, which is 37,750. Opening FG is 37,750. COGS is 5,25,000. We are stuck now still because I don't know networks cost, I don't know closing FG, so missing figures are too many here as of now. One more item is given in the question. They've given an item called what? Cost of available for sale. What is cost of goods available for sale? Is what can be sold by the company. Technically, cost of production plus opening FG. So, right, cost of goods available for sale. Right, cost of goods available for sale is equal to cost of production plus opening FG. What can be sold by the company? Cost of goods available for sale 555, 775 is equal to cost of production plus 37 750 plus 37 750. 518025. Cost of production plus opening FG 5,18,025. Now please tell me the two balancing figures. Closing WIP's balancing figure 486 plus 40 minus something is 518. negative 8625. This is the balancing figure. And again, closing FG's balancing figure 518 plus 37,750 minus some number is 525. 3775. 30,775. Any doubts on this? Clear? 30,775. Done. Go through question 3. Okay. Another heading says reverse working. XYZ a manufacturing company. They have given opening raw material, closing raw material, opening WIP, closing WIP, consumables, stores and spares. Where will consumables, stores and spares go? Quickly tell me the classification. Factory overheads, research and development, separate line item, quality control, separate line item, packing cost secondary, selling and distribution overhead, lease rent of production asset, factory overhead. This was there as part of that ambiguous item. Factory overhead, administrative expense, general and administrative overhead, selling and distribution expenses. Finished goods opening is not there, only closing is there. If opening is not there, that problem is not there. FIFO method weighted average problem is not there. Defective unit is 4%. Realizes 61. Where will this go? Credit for recoveries are scrap. Closing stock is valued at cost of production. Just delete this word. It is of no use. Unnecessary confusion. Just remove this. Because anyway, administrative expense is not part of COGS here because they have given general and administrative overhead. If they had given admin overhead relating to production, then that's a different story. Calculate the value of material purchase. Prepare the cost sheet. We'll prepare the cost sheet. Automatically, the value of material purchase will come. Let's start cost sheet. Cost sheet of XYZ for the month of September 2019 of XYZ for the month of September 2019. Direct material, opening raw material, opening raw material 2,42,000. Add purchases. This is the item we have to calculate. Less closing raw material 2,92,000. Direct labor, direct labor how much? Okay, we'll have to calculate this. Let's see later. Direct labor, direct expenses. Any direct expense you see. This lease rent of production asset can be taken anywhere. I'm not sure what they've ended up doing, but I'll just see that ambiguous item classification. In the ambiguous item classification, we have taken lease rent of production asset to be a, it says lease rent of production asset factory overhead, but it can go anywhere. Okay, that's a debatable issue. So no direct expense zero. Prime cost, factory overheads, underline that, lease rent of production asset. I think I say would have taken as direct expense. They've taken here only. I thought it will be direct expense, but okay. Lease rent of production asset. Lease rent of production asset 2 lakh. One more item is there. Consumables. Consumables how much? 3 lakh 50 put together. 5 lakh 50. Gross works cost. We don't know the figure. Add opening WIP. Add opening WIP. How much is the opening WIP? 2 lakhs. Less closing WIP. 5 lakhs. Net works cost we don't know. In the 5 line items, lot of items are there in the question. First item we have is quality control cost. Yeah, whatever, quality control, research and quality control is 2 lakh. Research and development cost. Research and development cost is 2 lakh 50. Quality control, research and development. Primary packaging is not there. I'm not writing. Admin overhead relating to production not there. Less credit for recovery scrap. Credit for recoveries are scrap. The defective production is 4% of targeted production. Targeted production is 1 lakh unit. 4% of targeted production. Targeted production is 1 lakh unit. So this is 1 lakh into 4% into 61. Cost of production in bracket 96,000 units. 96,000 units. How 96 is 1 lakh minus 4%. Value we don't know. Lot of things are missing here. Cost of production 96,000 units. Add opening FG 0 units. Value is 0. Less closing FG. How many units? Value we don't know. Cost of goods sold in bracket. I have produced 96,000. Closing stock is 5,000. So COGS is 91,000 units. Value for 91,000 is 7826. Now we are going to get all the information. Listen, this 91 is a subpart of 96 because there is no opening stock. There is no opening stock. In case there is an opening stock, then units sold could be from opening stock, could be from current year production. But as of now, when opening stock is not there, this 91,000 is a subset of 96,000. To put it simply, here you can say, or below right, computation of, leave some space, some 10 lines, computation of cost of production. 91,000 units is equal to 7826. 96,000 units is question mark. It's a subpart of 91 is a subpart of 96 here. units equal to question mark. Eighty-two 56. Closing FG, this side 5,000 units equal to question mark. Or balancing figure, whatever way you say. 4 lakh 30,000. 4 lakh 30,000. Clear? Any doubts on this? 91 is a subpart of 96. Go in the reverse order. Tell me this question mark, networks cost. From 80 to 56, reverse order. Add back 244 and deduct 250 and 2 lakh. 80 lakh. Again reverse order. 80 lakh 50,000. Reverse order. Get the gross works cost. In the reverse order, what is negative is added, what is positive is subtracted. That's how reverse working happen. 80 50 plus 5 lakh minus 2 lakh. What's the number you get? 83 lakh 50,000. Prime cost figure. Reverse order. My main concept was that 96,000 and 91,000 understanding. 78 lakh. 78 lakh. And question has said direct labor is half of cost of material consumed. So come down and write direct material plus direct labor is equal to 78 lakh. Direct material plus direct labor is 78 lakh. Direct material plus direct labor 78 lakh, and direct labor is half of direct material. Direct labor is 1 by 2 of the cost of raw material consumed. 0.5 direct material 78 lakh. $52 lakhs. Direct labor will be half of this 26 lakh. Direct material 52, direct labor half. Any doubts on this? Clear? So I go up here, outer column 52 lakh, direct labor 26 lakh, purchases balancing figure. In the reverse working, what is, and always be little cautious in reverse working. After you're done, do the forward calculation again just to be doubly sure on the numbers. What is the purchases balancing figure? 52 lakh 50,000. Once you have returned 242 plus 5250 minus 292, are we getting 52? Plus 26, are we getting 78? Plus 550, are we getting 8350? Just do the forward working. Once you are done with reverse working, to be doubly sure on the numbers, do the forward working. 52 lakh 50,000. Any doubts on this? Clear? Can we proceed? After COGS, we have few items: general and administrative overhead. General and administrative overhead 2,24,000. General and administrative overhead 2,24,000. Selling and distribution overhead, underline two items are there. Inner column we'll have to do selling and distribution overhead. Selling and distribution overhead. What are the two items? Secondary packing 91,000 units into 2. Inner column 91,000 into 2, and the other item is selling and distribution expenses 4,13,000, 5,95,000, cost of sales, profit and sales, cost of sales, profit and sales 7826 plus 224, 595, 86 lakh 45,000 was the sales figure. How many units are there? 91,000 into 110, 91,000 into 110, 1 crore 10,000. Balancing figure 13 lakh 65,000. Any doubts on this? Any doubts on this? Balancing figure 1365. Any doubts on this part? Clear? Go through 4. A very important concept. Okay. Following is extracted from the books of Neela and Co. Output 1,000 units, raw material, factory overhead, selling overhead, wages, office overhead, rate of profit. Manufacturer wants to produce 1,500 units next year. Material cost will increase by 20, labor by 10, 50% is fixed, 50% variable. Rate of profit, prepare a cost sheet and estimate for the next year. It's a very simple question, but a very important concept. Let's start. Cost sheet. Particulars and 4 columns. Current year 2 sub columns. Next year 2 sub columns. Particulars, current year, next year. Calculation amount, current year in bracket 1,000 units, next year in bracket 1,500 units. A very important concept, you should be aware, but still it's a very important one. First item is direct material. Direct material. What is the expense of the previous year? 20 lakh. 20 lakh. Material cost will increase by how much? 20%. Material cost will increase by 20%. Next year, what will be the expense? The important part is break this 20 lakh as 1,000 units into something. 1,000 units into something is 20 lakh. Break this. 1,000 units into something is 20 lakh. What will that item be? 1,000 units into 2,000. Any change in variable cost, material is a variable cost, is a change in cost per unit. So 2,000 plus 20% into 1,500. Many students directly do 20 lakh plus 20%. That is wrong. 2,000 plus 20% into 1,500. 20 lakh and 36 lakh. 20 lakhs and 36 lakhs. 2000 plus 20% into 1500. Direct labor, same way, the given figure is 12 lakh. Breakup is 1000 units into 1200. 1000 units into 1200. Next year, 1200 plus 1200 plus was the increase. 10% into 1500. 19 lakh 80,000. Prime cost. I'm not writing direct expense, it's not there. Prime cost. Prime cost 32 lakhs and 55 lakh 80,000. 32 and 55 80. Factory overheads they have given fixed and variable. We'll write together separately each of them. It will make a difference. Variable factory overhead, fixed factory overhead. Variable factory overhead and fixed factory overhead. Variable factory overhead and fixed factory overhead. How much is the factory overhead figure? 8 lakh. Sorry, 8 lakh is the overall number. In that variable is 4 lakh. Fixed is 4 lakh. Variable, write the breakup. 1000 units. Variable always I need per unit number. Fixed I don't need per unit number. I'm not writing any breakup. 1000 units into 400 and fixed factory overhead 4 lakh as it is. Any change they have mentioned? No. This side 1500 then. 1500 into 400. Till the expense will go up. 1500 into 400. 4 lakh as it is. 6 lakh and 4 lakh. Very important, powerful concept. 6 lakh and 4 lakh. Gross work GWC, NWC, COP, COGS all are same here. We used this extensively in working capital also. That is where cost sheet understanding is very critical for your FM working capital also. 65 lakh, 80,000. Variable cost I need per unit number. Fixed cost I don't need per unit number. What's the next item? Administrative overhead or office overhead. Office overhead is fixed in nature. So I'm not writing any breakup here. Any increase in office overhead? No. Same 4 lakh. Then selling overhead 1 lakh, and question very clearly says selling expense per unit will be reduced. So anyway I have to do per unit calculation. Selling expense per unit will be reduced. So selling overhead is 1 lakh, breakup 1000 units into something. 1000 units into some number. How much? 100 will go down by 100 will go down by 20%. 20% multiplied with 1500. Cost of sales, profit and sales. Cost of sales, profit and sales. Be very clear, any change in variable cost means a change in variable cost per unit. Any change in fixed cost means change in total fixed cost. Forty-five and 71. Profit margin is given in the question. How much is the profit margin? On sales, if it is on sales, write sales in bracket 100. If it is on sales, write sales in bracket 100. Profit is 25, cost is 75. If it's on cost, cost is 100. So 75 equal to 45 lakh, 25 equal to question mark. Same profit margin, 71 lakh, 25 equal to question mark. A very powerful and an important concept. How do we give effect to changes in cost structure? Any change in variable cost means change in variable cost per unit. Any change in fixed cost means change in total fixed cost. And if problem is silent, this is the nature. Material cost is variable, labor cost is variable, direct expense is variable, administrative overhead is fixed, selling overhead is variable, factory overhead you have to take assumption. Factory, this is the general rule. General rule in case problem is silent. Clear? Any doubts on this? Now, question 5, we are not going to do cost sheet because it has some 40 items of classification. What I want you to do, either do it in the book itself or in your notebook. Go through every item and just write where you will write. For example, raw material purchase, hyphen direct material. Hyphen direct material. Where will you classify these item? Quickly. Maximum I'll give is 8 to 10 minutes. Keep writing them. You can write it in the book itself or write it in your notebook. That's your wish. Write the classification. Where will the item be classified? complete the classification quickly. Okay, I'll start the discussion. Raw material purchased, direct material. GST paid eligible for input credit will not come as an expense because it's eligible for input credit. Freight inward, direct material. Wages paid to factory worker, assuming they are direct worker, direct wages. Contribution for PF and ESI is also direct wages. Production bonus is also direct wages. Royalty for production will go as direct expense. Power and fuel, debatable, can be factory overhead, can be direct expense, depends on materiality in the practical world. Molds and patterns is basically something which is incurred for manufacturing of the product. So this is a direct expense. Only thing is, it says life is equivalent to 2 years. So when you write the amount, you will write half of this because this is a 2 year expense. When you do the problem with numbers, this will become half of that. Job charges paid to job workers, direct expense. Stores and spares consumed is factory overheads. Depreciation in factory building is factory overheads. Office building will go as general and administrative overhead. Plant and machinery is factory overhead. Delivery vehicle is selling and distribution overhead. Salary paid to supervisor. Now, what supervisor we don't know, assuming is a factory supervisor. I take it as factory overheads. Assuming is a factory supervisor, I take it as factory overheads. Repairs and maintenance for plant and machinery, factory overheads. Sales office, selling and distribution. Vehicle used by director vehicle usages, general and administrative overhead. Insurance premium for plant and machinery, factory overhead. Factory building, factory overhead. Stock of raw material is also a factory overhead. If insurance premium is paid for stock in transit, that will go under direct material. Expenses for quality control, separate line item. Quality control staff salary paid is separate line item. Research and development, separate line item. Pollution control, factory overhead. Pollution would be happening at the factory, so it will go under factory. Quality control is different, pollution control is different. Pollution control, factory overhead. Administration of factory work, administrative overhead relating to production. Production control manager, this was one of the ambiguous item. Production control is assuming is going to administer the factory work. Administration overhead relating to factory. uh, Finance and accounts will go as selling and distribution, sorry, general and administrative. Sales and marketing will go as selling and distribution. General manager will go as general and administration. Primary packing, separate line item. Redistribution is selling and distribution. Interest and finance is normally not there in costing, but it says usage of what, non equity. Usage of non equity is a separate line item. After you write general, after you write selling and distribution overhead, next line item will be called interest and finance charges, because the concept says if it is related to non-equity fund, the concept is if it's related to equity fund, it will not come. Reward for providers of money, reward paid to providers of capital will not come, but in case it is related to debt which is non-equity funds, it will be considered in cost sheet as a separate line item below selling and distribution. You will have to keep revising the concept from the concept book, and thereafter there automatically you will get the answer. It will be below selling and distribution overhead. Then fee paid to auditor, general and administration, legal advisor, general and administration, independent director, general and administration. Performance bonus will go as selling and distribution. Opening raw material, opening WIP, opening FG, closing raw material, closing WIP, closing FG. And amount realized by scrap will be separate line item. Credit for recoveries are scrap. Clear? Any doubts in this? Go through question 6. Measures Ariba Private Limited has a normal production capacity of 36,000 units of toys per annum. Direct material, direct labor, factory overhead, fixed, variable, semi-variable, admin overhead, selling. Each unit of raw material yields a scrap. Scrap of raw material, each unit of raw material yields a scrap. Factory worked at 50% capacity for the first 3 months and 80% capacity for the remaining 9 months. So we will do the calculation 3 months separately, 9 months separately, because first 3 months you have worked at 50% capacity and remaining you have worked at 80% capacity. Prepare a cost sheet showing prime cost, works cost, COP and COS, and they also want us to fix the selling price so that I earn an overall profit of 876 600. So particulars, first 3 months separate calculation, next 9 months and the overall total. Cost sheet, cost sheet, particulars, 3 months, first 3 months, next 9 months and total. First 3 months, next 9 months and total. First three, next nine and total. First, we will write the production itself. Production. Once that is there, then we'll keep calculating everything. Production. The annual capacity is 36,000, which means monthly capacity is 3,000. Monthly capacity is 3,000. First 3 months we have operated at what capacity? 50%. Then we have operated at 80%. So 3,000 into 50% into 3 months. This whatever I write in bracket, that's your wish. If it's not mandatory to write, if you need calculation, write it. Else, anyway, printed material will have that. 4,500, 21,600, and 26,100. 3,000 into 50%, 3 months. 3,000 into 80%, 9 months. Any doubts on this? Direct material, underline that. Two items will come. Material cost is 40 per unit, but there is something called a scrap which is going to happen. There's something called as scrap of material, scrap of raw material, material scrap, all that will be deducted in direct material. So below direct material cost 4,500 into 40, less scrap of material, net raw material cost. Scrap of raw material, scrap of raw material. How much the scrap of raw material? 5. So 4,500 into 5, 22,500. 21,600 into 5, 1 lakh 8,000. Put together 130, 500, and we deduct this. Net raw material cost 157 500, 756, and 913 500. Net raw material cost. Clear? Net raw material cost. The next item, direct labor, but little caution is needed. Direct labor. Direct labor. How much per unit? Now listen. It's 30 per unit. Listen. 4,500 into 30 or 45,000 into 3. Minimum I have to pay 45,000 into 3 or 4,000, so 48,000 into 3. Minimum is 48,000. In case if 4,500 into 30 is more, no problem. But if it's less, then you have to pay 48,000 into 3. Minimum 48,000. Subject to a minimum of 48,000 per month. Multiply whichever is higher. Tell me the figure. 4,500 into 30 or 48,000 into 3, whichever is higher. 1,44,000. This side 21,600 into 30 or 48,000 into 9, whichever is higher. 6,48,000. 144,648. Put a total prime cost. Prime cost 3,01,500. 14 lakh 4,000. Overall total is 17 lakh 5,500. Overall total is 17,05,500. Factory overheads, underline that. Three items are there: fixed, variable, semi-variable. All of that will need some explanation. Fixed, variable, and semi-variable. Factory overhead, fixed, variable, and semi-variable. Fixed is 3,60,000 per annum, so 3,60,000 into 3 by 12, 3,60,000 into 9 by 12. 90,000, 2,70,000, overall 3,60,000. Variable is also okay, 10 per unit. 10 per unit. 4,500 into 10, 21,600 into 10. Semi-variable. Now understand the table. 1,08,000 per annum if it's 50% capacity, and then there are some changes. Leave some 8-9 lines. Semi-variable cost. Semi-variable cost. Capacity and annual cost, 2 columns. Capacity, annual cost. Capacity and annual cost. Up to 50% capacity, the cost is 1,08,000. Up to 50% capacity, cost is 1,08,000. If I increase capacity, they says 46,800 for every 20% increase in capacity or any part thereof. Any part means even 1% extra. So 51 to 70%. 51 to 70% capacity, 1,08,000 extra 46,800. 154,800. 71 to 90% plus 46,800. 201,600. 91 to technically 100. 201,600 plus 46,800. This is my annual cost. This is the yearly cost. We are doing 3 months and 9 months calculation. We'll take figures from this 3 months and 9 months calculation. Any doubts on the semi variable cost? Every 20% capacity increase, we incur extra 46,800. Now go back to this table. Semi variable cost, 50% capacity, 1,08,000 into 3 by 12, and 80% capacity, 201,600. 201,600 into 9 by 12, 151, 178, 200. Semi variable cost changes based on the capacity utilization. Again, a very important adjustment. Put a total. GWC, NWC, COP, and I think no FG also, COGS, everything the same only. GWC, NWC, COP, and COGS. 4,63,500 was the other one. 34. 20 lakh. 41. 200. Overall total then. 04, 700. 25, 04, 700. 463, 500. 20, 41, 200. 25, 04, 700. Any doubts on this? GWC, NWC, COP, COGS. After this we have after this item we have admin overhead, 5,18,400 per annum into 3 by 12, 129,600, 9 by 12. Selling overhead. Selling overhead is given as 8 per unit. All these are self-explanatory. Cost of sales, profit and sales. $629,100. How much? 26? 2,800. 32, 31, 900. Sales for first 3 months is given. They have said selling price for first 3 months is 145. Selling price for the first 3 months is 145. 4,500 into 145, 652, 500, 23, 400, and overall profit is given, which is they say what should be the selling price for the remaining 9 months so that I can make an overall profit of 876, 600. So this profit is balancing figure. This profit is balancing figure, and then you add and get the sales figure. That will give you the selling price. Sales is 3456, which is 21,600 into some price. 21,600 into some price. 3456, 21,600 into some price. What is the price? 160. Good adjustment was on the semi variable cost. Any doubts on this? And labor also, some minimum condition was there. That was also a good adjustment. Any doubts? Go through 7. Keep going through the question. Okay. IC Limited manufactures two types of phone cover. One is plastic phone cover, another is silicon phone cover. Cost data relating to manufacturing of both the phone covers is they have given all the figures, but the only problem is they have given it for both the products together. Material cost, wages cost, production overhead. Other data, material cost per unit of silicon phone cover is twice that of the plastic phone cover. Wages per unit of plastic phone cover is 60% of those of silicon phone cover. Production overhead is same for both the type. Administration overhead is 50% of production overhead. Selling cost and selling price is 8 and 140. Number of units of silicon phone cover sold 90. Production of silicon phone cover 1 lakh and 3 lakh. You are required to prepare a cost sheet for silicon phone cover showing cost and profit at a per unit level as well as at a total level. So we are required to do cost sheet for silicon phone cover. Let's start. Cost sheet of silicon phone cover, particulars per unit and total, particulars per unit and total, direct material, leave some 10 lines. Note 1, analysis of direct material cost. Analysis of direct material cost. You can leave some 10, 12 lines. Now, the direct material cost is 1 crore rupee. But the problem is this is the cost for silicon phone cover as well as plastic phone cover. So, right, 1 crore, direct material 1 crore, split into silicon, plastic, silicon and plastic, silicon and plastic, silicon and plastic. How many units of silicon we have manufactured? 1 lakh units. Sorry, silicon is, yeah, 1 lakh. Plastic is 3 lakh. The raw material cost of silicon is twice that of plastic phone cover. So the raw material cost here is A and this is 2A. When I multiply it together, 2 lakh A plus 3 lakh A is equal to 1 crore. A is the cost of a plastic phone cover. A is the cost of plastic phone cover. Cost of plastic phone cover. How much is the answer to A? How much? 20. So silicon will be 40. Silicon is going to be 40. Plastic is 20. Plastic is 20. 1 lakh into 2A plus 3 lakh into A, you end up getting 1 crore value. So direct material cost per unit is 40 here. And this is 40 lakh. 40 and 40 lakh. We are doing the statement for silicon phone cover. How we got 40 is 5 lakh A is equal to 1 crore. 20 rupees is for plastic. 20 into 2 is 40. Any doubts on this? Next, analysis of direct labor. Direct labor cost is direct labor cost is 56 lakh split into silicon, plastic. Silicon is 1 lakh, plastic is 3 lakh. Silicon is 1 lakh and plastic is 3 lakh. And the question has said wages per unit of plastic phone cover is 60% that of silicon phone cover. Plastic is 60% that of silicon. Let's take silicon as A now and plastic is 0.6A. Plastic is 0.6A. This is A, other one is 0.6A. A is directly the cost of the silicon phone cover. How much? 20. Direct labor 20, 20 lakhs. Direct labor 20 and 20 lakhs. 1 lakh plus 180 A is equal to 56 lakh. Any doubts on this? Direct expense is not there. Prime cost 60 and 60 lakh. Factory overhead is easy. Factory overhead in bracket. Factory overhead 32 lakh divided by 4 lakh because it is the same for both. Production overhead per unit is same for both type of phone covers. So 32 lakh divided by 1 lakh plus 3 lakh divided by 1 lakh plus 3 lakh. Factory overhead 32 lakh divided by 4 lakh. gross works cost slash net works cost. Factory overhead same for both the products. So we directly divide it by the number of units. Direct division by number of units. 1 lakh plus 3 lakh, 4 lakh units. Any doubts on this? After net works cost, we have one of the 5 line items. What is the item we have? One of the 5 line items is there. Admin overhead relating to production, because very clear, administration overhead being part of COP. So admin overhead relating to production 50% of 8. Cost of production in bracket 1 lakh units. There is some closing stock in the question. 72, 72 lakh, 72 and 72 lakhs. Cost of production 72. Add opening FG 0 less closing FG. Cost of goods sold. How many units have been sold by the company? 90,000, which means closing is 10,000. Everything we write only 72 here. No subtraction technically. Per unit is 72 only. 72 into 10,000, 7 lakh 20. And now onwards 90,000 units. Now onwards the table is for 90,000. Now onwards the table is for 90,000. Earlier the table was for 1 lakh units. Now onwards the table is for 90,000. Important is how you bifurcate the cost. After COGS, what is the item we have? Selling cost, selling and distribution overhead. How much? 8 per unit into 90,000 now onwards. 80 and 72 lakh. Profit sales. Question specifically asked per unit, so we are doing per unit as well as total. Profit and sales. Question specifically asked for the per unit numbers. What is the selling price? 140. Profit is 60. Clear? 1 crore 15 lakh 20,000. Bifurcation of cost. The important adjustment is how you bifurcate the cost which is given. Material cost, labor cost. How do you bifurcate is the most critical part here. Any doubts on this? Clear? Okay, let's take a break of 15 minutes. Let's proceed now. Go through 8. Okay, let's read it. M Limited is producing a single product, may expand into product diversification in next 1 to 2 years. It's a labor intensive company. Majority of processes are done manually. Employee cost is a major cost element. Company conventionally uses two parameter. Earning per man shift. What is earning per man shift is how much an employee is earning per shift to measure the cost paid to an employee for a shift of 8 hours, and output per man shift, how much he is producing in an employee in an output of 6 hours, 8 hours. The chief manager has emailed you few information related to the last one. The email contains: we have produced 2,34,000 tons. Expenditure: raw material, power, diesel, wages, gratuity, hiring charges, cars, reimbursement, some GST, maintenance cost, AMC cost. They have asked through an MCQ based question. We'll first prepare the question and then automatically answer all these requirements. Working note 1, cost sheet, particulars, amount, direct material, direct material, no breakup needed. They have given the figure. How much is direct material? 50 lakh. Direct labor breakup will be needed here. Two items are there. Direct labor. What's the first item? Wages and salary. 6 crore, 40 lakhs. And then we have gratuity and leave encashment. Gratuity and leave encashment 6420. 7 crore 4 lakh 20,000. Gratuity and leave encashment 7 crore 4 lakh 20,000. Direct expenses, multiple items are there. Direct expenses, power and diesel both have been taken as direct expenses. You can argue and even take it as factory overhead. Anyway, MCQ base, if I change the classification, answer may not match, and automatically I can change the classification later. Power cost 13,000 into 8, 1 lakh 4,000. Diesel cost 2,000 into 93, 1 lakh 86,000. And hiring charges. This was part of that ambiguous list. Hiring charges for this machinery 30 lakh. All put together, how much? 32 lakh 90,000. Put a total prime cost 50 lakh 7 crore 4 lakh 20,000. 7 crore 87 10. 787 10. Factory overheads. Only one item is there, I think, factory overheads. What is the factory overhead here? There's one item. The last third item, AMC cost of CCTV installed at weighing bridge and factory premises. Weighing bridge and factory premises. Weighing bridge is not a factory overhead, but factory premises will be a factory overhead. AMC cost of the CCTV installed at the factory premises 18,000. 18,000. Outer column directly 18,000. Gross work GWC, NWC, COP and COGS. 787.28. GWC, NWC, COP, COGS. Next, admin overheads. Multiple items are there. Admin overheads. What is the first item for admin overheads? Hiring charges for cars used for official purpose, 66,000. Then reimbursement of diesel cost, 22,000. Reimbursement of diesel cost, 22,000. GST on RCM basis. The sum they've said GST on hiring of charges attract GST at the rate of 5% under reverse charge mechanism. Under reverse charge mechanism. So what is GST on reverse charge mechanism? It's on the hiring charges and on the diesel. And on the diesel, I have to pay GST to the other party, 88,000 into 5%. On diesel also you'll have to pay it 92,400. 88,000 plus 5%, 92,400. Selling and distribution over it. Selling and distribution over it. We have multiple items. What is the first item? Maintenance cost of weighing bridge. Weighing bridge purpose is to do the weight calculation when you are dispatching. So it's a selling and distribution over it, 12,000. Maintenance cost of weighing bridge. AMC cost of CCTV, 8,000. And sales manager expenses, 36,000. Put together 56. Cost of sales. Cost of sales, 7 crore 88 lakhs 76,400. Clear? Any doubts on this? Can you proceed? What is the amount of prime cost incurred during the last month? Look at the answer. Prime cost is 7 crore 87 lakh 10,000. Total and per shift cost of production. First tell me the total cost of production. 7 crore 8 cost of production 87.28 per shift. If you want, I'll have to divide by the number of shift. How many shift is 1,800 into 26 days? 1,800 into 20. So many shifts have happened. So divide by 46,800. 787. 46,800 is the number of shift. 787.28 by 46,800. 1682.22. Administrative cost incurred during the month. Administration cost 92,400. Selling and distribution. And what is cost of sales? 56 and 788, 76,400. EMS and OMS. EMS is earnings per man shift. What is earnings per man shift is? Wages cost. Divide this by 46,800. Divide this by 46,800. Earnings per man shift. 1000. I have two answers. Then output per man shift is they have produced 2,34,000. Divide by 46,800. 234 by 46,800. 5. So every question has asked two requirements, but they're very smartly given the choices where one answer alone will not help. You'll have to do the other one also, then only you'll be able to choose it. Otherwise, many questions we saw where one is done, we would be able to choose the answer. But here the answers have been given very smartly, so you'll have to do both the calculation and then answer it. Any doubts on this? Go through 9. It's a lightly lengthy question and a very good problem. Okay, let's read it. ABC Limited is engaged in producing electronic equipment. It has furnished the following detail. Opening stock units are given. Normally, raw material units are not given, but they've given units. There's some purpose. Purchases units are given. Closing stock units are given. This will help me in telling how much raw material I've consumed. WIP also they've given units. Closing WIP also they've given units. So this will somewhere help us in doing tracking of units and we'll be able to get the production. Employees' wages and allowance will go to which category? Direct wages. Primary packing cost per unit, so I'll need the number of units. Primary packing cost per unit, number of units we will track and then write it. R&D expenses and quality control separate line item. Guard salary, something is given below, they have mentioned something below. Director salary will go as admin overhead. Consumable stores will go as factory overhead. Product inspection, ideally factory overhead. Product inspection will be factory overhead. Rearrangement design of factory machine, factory overheads. Admin overhead relating to production, separate line item. Selling expense separate, that is selling and distribution overhead. Royalty paid for production, direct expense. Cost of website for online sale, selling and distribution. Gift and snacks will also be selling and distribution. GST in bracket credit allowed, so credit allowed, let's ignore it. AMC cost of CCTV, again they have given some breakup saying that you distribute in the ratio of 6 is to 2 is to 2. Hiring of cars for transportation, they have mentioned it is for selling and distribution purpose. Audit and legal fees will be administration. Secondary packing per unit, this will go selling and distribution. Then guard salary 7 is to 2 is to 1. Hiring of cars is only for selling and distribution. AMC cost is 6 is to 2 is to 2. Company paid EPF of 12% over basic pay. EPF of 12% over basic pay. Guards will not receive any incentive or EPF. Lucky draw is conducted. Lucky draw will go selling and distribution over it. Sponsors a television program, again selling and distribution. Hiring of cars attract GST. GST at 5% like the last question, but diesel cost is not separately given. And scrap of direct material is also there. There is a scrap of direct material. Entire finished goods was sold at a profit margin of 25%. Let's start cost sheet. Particulars and not amount and amount, particulars, units and amount. I'll have to track the units here. Units and amount. Only one amount column, will directly write it in the outer column itself. Units and amount. Or keep it as particulars, amount. Unit, give me a minute. You have two amount columns, no choice. Units, amount. Units, amount. One inner column and outer column, but units I have to track. Direct material, opening raw material, units and inner column amount. Units is 10,000, amount is 5 crore. Then purchases 4,90,000, 4,90,000, 25 crore 20 lakh, less closing stock 17,500, 85 lakh, 17,500 and 85 lakh, less scrap of raw material. Only one thing, I'm not sure whether this 5 crore is right or 50 lakh, because looking at the figure it could be 50 lakh, but in case there is any variation we'll see later, because 17,500 is only 85 lakh. Ideally that 10,000 should be 50 lakh rupees. Let me just check it in case I added one zero. They have taken 5 crore only. Scrap of raw material, how many units? 2,000 into 350. 2,000 into 350. 7 lakh. Raw material consumed. Write the units and one amount in the outer column. Units and amount in the outer column. Units is 4 lakh 82, sorry, not 82 500, 4 lakh 8,500. Five crore 2520 minus 85 lakh minus 7 lakh. How much you get? 29 crore 28 lakhs. Numbers are big, we can't help it. Next, direct wages. Directly in the outer column, it's, listen, it says 5 crore 50 lakh 50,000 and it uses the word wages, allowances, etc. And here they have said EPF of 12% over basic pay. This 12% will not come here because it includes everything. Then where will this 12% come? On the director salary, guard salary, it should ideally come, but the question is said guard is not paid EPF. This 12% is not for direct employee wages because there it is, everything is included. Everything is included. So directly 5 crore 50 lakh 50,000. Direct expenses. I think we have only one line item. What is the direct expense? Royalty paid for production. Direct expense, royalty paid 3 crore 10 lakh 50,000. If you have multiple items, inner column and then outer column. Prime cost, right, number of units 4 lakh 80,500. We'll keep tracking the number of units. 4 lakh 80,500, outer column figure. 37 crores 89 lakh. It will become time consuming because of the values are big. 37 crore 89 lakh. Factory overheads, we have lot of items. Factory overhead was the first item in factory overhead. Guard salary, in bracket, guard salary, it is they have given 20 lakh into some ratio we have to distribute. 7 by 2, 7 is to 2, 7 is to 2 is to 1, 7 by 10, 14 lakh. Balance will come later. Guard salary was the next item. You keep putting a tick whatever item we have written. Stores, consumable stores is 3 crore 42 lakh. Product inspection, product inspection is 22 lakh. Then we have rearrangement, rearrangement of factory 75 lakhs. Rearrangement, anything else you see? CCTV, okay, again we have to split. AMC cost of CCTV, AMC cost of CCTV 10 lakh into 6 by 10, 6 lakh. Any doubts on this? Clear? I don't need the factory overhead total now. Let's not worry about total because main time will go there only. Gross works cost. I don't want the total. I don't want the total. We'll just keep writing the items. That's all. I don't want the total. In case I have to value something, I'll copy from the question because otherwise time will get spent there only. 4 lakh 80,500. 4 lakh 80,500. Add opening WIP. Once we are done, finally we will see in the solution in case we have written everything. We will not bother about putting total. Opening WIP, tell the units and the amount. 20,000. Outer column 1 crore 20 lakh. Less closing WIP. Again units 10,000 60 lakh 50,000. Net works cost. Units is 4 lakh. Units I want, amount I don't want. 4 lakh 90,500. Amount I'm not writing, okay. Net works cost 490,500. This units will help me in calculating certain expenses. 490,500. After this we have primary packaging 140 per unit. Primary packing 490,500 into 140 into 140. That is the purpose of tracking the units. 6 crore. Putting total will again take a lot of time here. So let's not worry about the totaling. Primary packing 490,500 into 140 into 140. What's the next item? R&D expenses and quality control. They have given together and quality control. 1 crore 90 lakhs. R&D expenses 1 crore 90 lakhs. Admin overhead relating to production 3 crore 45 lakhs. 3 crore 45 lakhs. Anything else? That's all. Cost of production. Have they given opening and closing FG? Any data on opening and closing FG? Any information on opening and closing FG? COP/COGS. If I was to value, then I would have copied the COP from the solution and done the valuation. Entire output is sold is the last line. Entire output has been sold. Units 490 500 again, because somewhere I'll keep tracking the units 490 500. General and admin overhead. General and admin overhead. First we will write those two items. Guard salary 20 lakh into guard salary 7 is to 2 is to 1, 4 lakh. AMC cost of CCTV 10 lakh into 6 is to 2 is to 2, 2 by 10. AMC cost of CCTV, and then we will keep writing various items. AMC cost of CCTV 2 lakh. What are the items we have? Director salary in bracket, add the PF number. Director salary 60 lakh plus 12% PF. 60 lakh plus 12% PF. 67 20,000. Direct wages we did not add because everything was included. What's the next item we have here? Director salary done. Anything else? Selling expenses will not come. Gift and snacks will not come. Hiring of cars will not come because hiring of cars is the other. Audit and legal fees will come. Audit and legal fees. How much? 20. I don't want the outer column total and all. 25 lakh. 29. Okay, sorry, 29 lakh. We don't want the total audit and legal fees. Then selling and distribution overhead. If at all you want to put total and all, later on you do at home, but it doesn't serve any purpose. Selling and distribution overhead. First we'll write the two items, guard salary and AMC cost. Guard salary and AMC cost. Guard salary is 1 by 10 and AMC cost is 2 by 10. Guard salary 1 by 10, AMC cost 2 by 10. Apart from that, lot of items are there. Guard salary 1 by 10, AMC cost 2 by 10. Any doubts on this? Then we have, let's see from the beginning. Selling expenses 3 crore 94 lakh 50,000. Cost of website 60 lakh 75,000. Gift and snacks 30 lakh 50,000. Hiring of cars. Hiring of cars. How much? No, 25 lakh plus GST. GST on reverse charge mechanism. Hiring of cars will attract GST under RCM at 5% without credit. Without credit. 26 lakh 25,000. 25 lakh. If there was a diesel reimbursement, on that also ICA takes the GST part. 25 lakh plus 5%. Then we have secondary packaging. Secondary packing 490 500 into 20. 490 500 into 20. 98 lakh 10,000. 490 500 into 20, 98 lakh 10,000. And we have lucky draw. Add up all the amount and tell me lucky draw First price, second price, third price, cancellation price, all put together. 1 lakh plus 50,000 plus 20,000 and three cancellation prices, all put together 2 lakh. 1 lakh plus 50 plus 20 plus 3 into 10,000. Lucky draw 2 lakh. And we have some sponsorship program. Sponsorship program is once you complete all the cost, sales is 100, profit is 25, cost is 75. So this is the, we had done total till prime cost. Factory overhead we did not do total. 5 items were there. We have written all the 5 items. Totaling we have not done. Then opening WIP, closing WIP. We had 3 line items. Cost of production total we did not do. Admin overhead we have 4 items. We have written the 4 items here. Guard salary, AMC cost, director salary and audit and legal fees. And here we have 1, 2, 3, 4, 5, 6, 7, totally 8 items. Sorry, 9 items are there. 1, 2, selling expenses, cost of website, gift and snack, hiring of car, secondary packing, lucky draw, and sponsorship program. Totaling I have not done. It will just waste of time. Clear? The figures are very high, so that is what it will take a lot of time for us to do the calculation. Go through question 10. Okay. We normally club selling and distribution together only. We don't write it separately, but question specifically says administration cost, selling cost, distribution cost. Nothing for you to do. It's just a discussion. Rent paid for factory building. Where will it go? None of the three. None of the three. Let's ignore it. Salary paid to office staff. Administration cost. Fee paid to auditor. Administration. Salary paid to sales manager. Selling cost. Sales manager is selling cost. Vehicle hire charges paid for directors attending general meeting. General meeting administration cost. Wages paid to workers engaged in storing goods at sales depot. Can be selling, but for me more is distribution. Sales depot is I'm distributing my product, and there is some other place where the depot is, could be distribution. I feel it is more of distribution cost. Traveling allowance paid to sales staff. Selling. Secondary packing, this has to be distribution. Secondary packing is only for the purpose of distribution. Can be selling also if it is for attracting the customer. Secondary packing, two purposes there. One is attracting the customer, and second is to distribute the product. Distribute the product. Electricity bills for sale office. Selling cost. Depreciation on goods delivery vehicle. Distribution. Goods delivery vehicle is distribution. Bonus paid to sales staff. Selling cost. Fee paid to independent director. Administration. Only debatable item is wages paid to workers engaged in storing goods at sales depot. Is it more of a sale related cost or distribution? If depot is somewhere other place, then it becomes like a distribution cost. If depot is at the same place, then it can be a selling cost also. Let's see what they've done. Okay, they have taken it as selling cost only. They have taken it as selling cost only. Distribution only 2 items: secondary packing and depreciation on goods delivery vehicle. And the first item is ignored, which is rent paid for factory building. That's of no use. Any doubts on this? Go through 11. Again, it's a very good question. It's slightly lengthier one. Go through 11. Okay. MNP Limited have the capacity to produce 84,000 units of product every month. Prime cost per unit depends on the capacity utilization, some 10 to 100 they've given. Prime cost has a breakup of 3 is to 2 is to 1 between material cost, wages, and direct expense. In the month of January, I worked at 40% capacity. Raw material purchase figure is given. In the month of February, the company worked at 100% capacity. Again, raw material purchase figure is given. Is the policy to maintain opening stock equal to one third of closing stock of raw material. Opening stock is one third of closing stock. Factory overheads are recovered at 60% of direct wage cost. Fixed administration expense as part of the production cost is and fixed selling and distribution expenses are given during the month. 33,600 at 68.8. Variable distribution cost is 1.5. Management of the company charts out a plan for the month of February 2024 with certain information they have given. In the month of February 2024, there is a significant saving in direct material cost due to the entry of new supplier in the market and saving in per unit cost of direct wages and direct expenses due to introduction of new policy. Prepare a cost sheet for January and February. They want a cost sheet for Jan month and Feb month. Let's start. It's like that 3 month and 9 month question we did. Particulars, calculation and amount. Jan 2024 and Feb 2024. Direct material, underline that. Or before all of this, production. Let's just start with production. My capacity is 84,000 per month. 84,000 per month. January, what is the capacity utilization? 40%. So 84,000 into 40%. 33,600. And February, what is the capacity utilization? 84,000 into 40% and 84,000 into 100%. Now direct material, underline that. Opening stock of raw material, add purchases, less closing stock of raw material consumed. Raw material consumed. Opening stock, add purchases, less closing stock, raw material consumed. Now purchases figure is given directly in the question. What's the purchases figure? 8,40,000 and 1646,400. Now question has said it is the policy to maintain opening stock as one third of the closing stock. Opening stock is one third of the closing stock. I don't know the opening stock figure. I also don't know the closing stock figure. I only know purchases. I can calculate consumption. What is consumption is number of units into 44 rupees. Number of units into 44 rupees into 3 is to 2 is to 1. 3 is to 2 is to 1. Number of units into 44 rupees into 3 by 6 is the material cost, 2 by 6 is the labor cost, 1 by 6 is the direct expenses. So here 33,600 units into, in that table for 40% 44, prime cost is 44 into 3 by 6 into 3 by 6. 739,200. For February, there is some substantial saving and all they're talking about. So I'm not writing as of now directly. 739,200. Leave some 15 lines, come down. Opening stock plus purchase minus closing stock is raw material consumed. Opening stock plus purchase minus closing stock is raw material consumed. Now question says The opening stock will be one third of the closing stock. One third of the closing stock. So closing stock by 3 plus closing stock. Opening stock is one third of the closing stock. Closing stock by 3 plus 8 lakh 40 minus closing stock is equal to 739 200. Get me the closing stock figure. Closing stock by 3. Closing stock by 3. Closing stock by 3. 1 lakh 51 200. Opening stock by 3. Now, next month, it may match 84,000 into 32, may not match, because question is saying there has been a substantial saving in the material cost in the month of February 2024 due to the entry and saving in per unit of direct wages and direct expense due to introduction of new policy by the management. So, I am not sure whether I will get 84,000 into 32 or I may not get. So, what we do here, we copy paste this 151 200. 151 200. Closing stock becomes the opening stock. Closing stock becomes the opening stock. Opening stock is one third of closing stock. Hence, closing stock is three times of opening stock. 151 200 into 3. 4 lakh 53 600. 13 lakh 44 now. 40 13 lakh 44. Which I think fortunately matches this number. What is the number? Listen. It is not mandatory, okay, because there is substantial saving. 84,000 units into 32 rupees into 3 by 6. I think it matches. Just check it. If it's not matching, then it's okay. 32 into 3 by 6. If it's not matching, it's okay because it's not mandatory. It has to match. Ideally, they need not have complicated this much. They could have just left direct material as it is. We would have done 33 600 into 44 by 3 by 6 and 84,000 into 32 by 3 by 6. This is not mandatory. It is matching. It's more of a coincidence. Clear? Any doubts on this? Next, direct labor. 739 200 is equal to 3. Question mark is equal to 2. 3 is to 2 is to 1. 3 is to 2 is to 1. 3 is to 2 is to 1. Question mark equal to 2. 4 lakh 92 800. Other one. 13 lakh 44 by 3 into 2. 8 lakh. Same way with direct expenses. 739 200 equal to 3. Question mark equal to 1. Equal to 3. Question mark equal to 1. 2 lakh 46 400. 4 lakh 48,000 prime cost. Prime cost 1478 and 2680. This was one important adjustment. They need not have complicated the material part itself. Directly they could have just left it as 30 rupees and whatever number they gave. With that itself we could have calculated. Then after this, is there any factory overhead in the question? Read it carefully, see if there is any factory overhead. Yeah, I think there is a factory overhead. Factory overhead is what? 60% of 490 to 800. 60% of 490 to 800. 295, 680, 8 lakh 96 into 60%. 537, 600. 537, 600. GWC. Have they given any WIP figure? NWC. I will not write COP because one of those 5 line items is there in the question. 1478 400 plus 295 680. 1774 080. 32 25 600. Administration cost as part of production, as part of production cost, as part of production cost. So admin overhead relating to production. Admin overhead relating to production. Fixed per month they have given. So 201 600 as it is per month. 201 600 per month. Admin overhead relating to production 201 600. We get cost of production COP slash COGS. COP slash COGS 1975 680 34 27 200. Then we have lot of selling and distribution overhead. Underline and let's write one by one. Selling and distribution overhead. First is fixed expense. Fixed expense. How much the fixed expense? 1,68,000. Then the next item we have is distribution cost. Distribution cost, variable distribution cost is 1 rupee 50 paise per unit sold. 1 rupee 50 paise per unit sold. 33,600 into 1.5, 84,000 into 1.5. 33,600 into 1.5, 84,000 into 1.5. 5,400 and 1,26,000. Clear? One 1.5 and 1.5. Then we have management charts out some plan and certain expenses are incurred only for the month of February 2024. Sponsorship. Sponsorship only for the month of February 2024. How much is the sponsorship cost? 26,250 into 4. 1 lakh 5,000. Then we have high T program. High T program is 1 lakh 5,000. Special gift item. All this is only for Feb. Special gift item. 105 on a sale of how many units? 12 units. 105 by 12 into 84,000 on 12 units. 7 lakh 35,000. Lucky draw. Add up all of this. Lucky draw. all put together 2,52,000. Get cost of sales. Cost of sales 21,94,080. How much? Profit is balancing figure. Selling price is given different for the two periods. January different selling price, February different selling price. Profit is balancing figure 33,600 into what is the January selling price? And this is 84,000 into 61. Profit is how much? 117, and this is 51 lakh 24,000 minus 49 18 200. 2 lakh 5,800. Any doubts on this? Clear? So with this, cost sheet discussion gets over. One question will surely come from cost sheet and one question from activity based costing. Marginal costing, 3 4 questions can come. With this, our block 1 discussion gets over. Any doubts on this? Block 1, which is of around 30 plus marks, 31 marks, we are kind of done with the discussion. Any doubts on this? I'll take a break. We resume again at 10 o'clock with budgetary control. I'll do budgetary control post the break. Okay, let's now move to budgets and budgetary control. This chapter focuses on two things. One is called fixed versus flexible budget, and the second part is something on functional budget. Functional budget is different types of budgets we have. We initially focus on flexible budget. What is flexible budget is the budget could have been prepared for 10,000 units. In reality, we have done some 12,000 or 8,000 units. So we have to revise the budget based on the actual performance or prepare budgets for different level of activity. Here, the split between fixed variable will be very critical, and any change in fixed cost means change in total fixed cost. Any change in variable cost means change in variable cost per unit. And in case they give the cost and you have to split, then we have a formula called change in cost by change in units, which is semi-variable cost. If there is a semi-variable, change in cost by change in units. Let's come to question 1. Today we will try to complete this. Uh, I'll see in case we complete this by around 1:15, 1:30, I'll end the session. In case we are able to complete it earlier, then I may do the other chapter also. We'll see as we proceed. Let's come to question 1. Go through question 1. Okay. Action plan manufacturers normally produce 8,000 units of their product in a month in their machine shop. For the month of January, the plan was to produce 10,000 units, but due to a sudden cancellation in the middle of January, I could produce only 6,000 units. Indirect manufacturing costs are carefully planned and monitored, and the foreman is paid a 10% of the savings as bonus if the indirect manufacturing cost is less than the budgeted provision. For January, my budgeted provision is 5875. Actual is 4990. So what he did is 5875 minus 4990 into 10%. He asked for a bonus 88.5 rupees. But the problem here is this normal month expenses for 8,000 units. This is for 10,000 and reality is for 6,000. This can't be compared with this. This can't be compared with this. So we have to prepare a flexible budget for 6,000 units. And if the flexible budget cost is more than 4990, I will still have to pay bonus. And if it's less than 4990, bonus is not payable. Because do you agree with the works manager? Is the foreman entitled to any bonus? Works manager feels that bonus is not to be paid because we lost a sizable contract. The problem here is I have two budgets. One is for 8,000, one is for 10,000. And I need a budget for 6,000 units. So we'll look at both the numbers and then try to calculate it. Now, right, flexible budget. Flexible budget for 6,000 units. Flexible budget for 6,000 units. Particulars calculation amount. Variable costs. Leave some 10 lines maybe or 8 lines fixed costs. Variable cost and fixed cost. Variable cost and fixed cost. Variable and fixed. We'll go item by item. Salary of foreman. Just look at 8,000, 10,000. Don't look at reality. 8,000, 1,000 rupees. 10,000 also 1,000 rupees, which means it's a fixed cost. It's a fixed cost. So for 6,000, right? Salary of foreman, 1,000 rupees. Salary of foreman, 1,000. It's a fixed cost. 8 and 10 remain same. Next item, indirect labor, 8,720, 10,900. Divide and tell per unit number. Are you getting same number? 720 by 8,000, 0.09, 900 by 10,000, 0.09. When you get exactly same number, it is a variable cost. 0.09 is the variable cost. Indirect labor, 0.09 into 6,000. 0.09 into 6,000. 540. 0.09 into 6,000. Indirect material divide and check. 800 by 8,000, 0.1, 1,000 by 10,000, both are 0.1. So indirect material 0.1 into 6,000. 0.1 into 6,000. 600. Repairs and maintenance divide and check. Are you getting exact same number? 600 by 8,000, 0.075, and 650 by 10,000 you get 0.065. 600 by 8,000 units, 650 by 10,000 units. 600 by 8,000 units, 650 by 10,000 units. We are not getting exact same number. If we don't get exact same number, it becomes a semi variable cost. Leave some space, come down. Note 1. Note 1. Repairs and maintenance cost. Repairs and maintenance cost. Units cost. Units and cost. 8,000 units, 600. 10,000, 650. 8,000 is 600. 10,000 is 650. This is technically a semi variable cost. Below this, variable cost per unit is equal to VC per unit is equal to change in cost by change in units. That's all. This is the only concept there. Change in cost by change in units. Change in cost by change in units. 650 minus 600, 10,000 minus 8,000. 650 minus 600 by 10,000 minus 8,000. 0.025 per unit. Total variable cost, total fixed cost. Variable is 8,000 into 0.025. Balance is fixed. You can do it in any one level. I'm doing it both in the screen. Any one level you can do this. Into 0.025. Balance is fixed cost. 200 and 400, 250 and 400. Any one level is sufficient. 8,000 into 0.025, 10,000 into 0.025, any one level. Both levels are not needed. Any one level is sufficient. 200 and 400, 250 and 400. Any doubts on this? We go up and write repairs and maintenance. And in fixed also we write repairs and maintenance. Or you can write separately semi-variable cost. Anything is fine. 0.025 into 6,000. 0.025 into 6,000. How much? 150, and this is 400. 150 and 400. If you divide, you get exact same number variable, overall same number fixed, neither of them same, then it is a semi-variable cost. Next, power, divide and check. 800 by 8,000, 875 by 10,000. We are not getting exact same number. Note to power cost. Note to power cost. You do it and then refer the screen. Analyze it. Zero point zero three seven five. 0.0375. Fixed cost is 500. Any doubts on this? Take it up. In the variable power cost, 0.0375 into 6,000. How much? 225. And again in the fixed cost, power cost is 500. Any doubts on this? Then the next item is tools consumed. Divide and check. Tools consumed. Divide and check. You'll get it as variable 0.04 into 6,000. Clear? And the last three items are fixed cost. Both are same. Rates and taxes, depreciation, insurance, same. So write them in fixed cost. Rates and taxes. Rates and taxes 150. Depreciation 800. Insurance 100. Total variable cost, total fixed cost. Total variable cost, total fixed cost, and then a final total. What's the total variable cost? 1755. In the printed material, I've left semi-variable as a separate line item, but okay, we can club it also like this. Total fixed cost 2950. Overall cost. Bonus is not to be paid because 4990 we have incurred, and we should have incurred 4705. If I was to prepare a budget for 6000 units, it is only 4705. That the January budget is for 10,000, that is not comparable. Any doubts on this? So net net will say in the end that bonus is not to be paid because our actual cost is 4990 and the planned cost was 4705. Actual cost is 4990, planned cost is 4705. Go through question 2. Okay. PP limit is currently operating at 80% of the capacity, 80,000 units. For the past 2 years, the production is increasing by 10%. So this is for 80,000 units. This is for 70. This is for 60. I need only two data. I don't need three data. We will take year 2 and year 1 data to do the analysis. If I divide by 80,000 and 70,000, I get the same number. It is variable. And if the overall is same, it is fixed. Neither of them same, it is a semi variable cost. On top of that, the company is planning now for 90% capacity level. Additional information: due to increase in demand, the raw material price will go up by 10%. Any change in material cost will ideally mean change in material cost per unit. At the beginning of the current year, dispute occurred between worker and employee. Later on, they settled for 20% increase in wages. Again, we'll check whether wages is fixed or variable. If it's fixed, add 20% to the overall cost. If it's variable, you'll have to add it to per unit number. Mostly it will be variable. And other changes have been given. Profit is 25%. Flexible budget at 90% level of capacity and to calculate profit and contribution. Now I have to prepare a budget for 90%. We'll start doing it. Any change in variable cost means a change in variable cost per unit. Any change in fixed cost means a change in total fixed cost. Let's start flexible budget. Flexible budget for 90% capacity. Particulars calculation amount. Particulars calculation amount. variable costs, some 7 8 lines, fixed costs, variable cost and fixed cost, flexible budget for 90% capacity, variable cost and fixed cost. We'll go item by item. They've given three data. Ignore year three. Okay, just focus on year two and year one. Year one is 80,000 units. Divide by 80. Divide by 70. Check. Direct material. Divide by 70,000. Divide by 80,000. What number do you get? 70,000 and 80,000. 20. So variable cost. Direct material. 20 plus there is some increase. 20 plus 10% into 90,000 units. 19 lakh 80,000. 20 plus 10% into 90,000. 20 plus 10% into 90,000. Next item is direct labor. Again, divide and check. Ignore year 3 information. Just focus on year 2 and year 1 information. 8 lakh by 80,000. 7 lakh by 70,000. 10 plus how much? 20% into 90,000. 10 lakh 80,000. 10 plus 20% into 90,000. Third one you divide. Factory overhead. Factory overhead, divide and check. 3 lakh 40 by 70,000. 3 lakh 60 by 80,000. Are we getting the same number? No. And in fact, the table below very clearly says there's an increase in variable factory overhead, there's an increase in fixed factory overhead. So, note 1, factory overhead. Units cost TVC TFC. Factory overhead. Units cost, total variable cost, total fixed cost. Units cost, total variable cost, total fixed cost. Two levels I have to take. I take the last two level, that is the last 2 years, 80,000 and 3 lakh 60, 70,000, 3 lakh 40. Do change in cost by change in units. Change in cost by change in units. $80,000 minus 70,000. Change in cost by change in units. How much? 2 per unit. 80,000 into 2. 80,000 into 2, 1 lakh 60. Balances fixed cost. 70,000 into 2, 1 lakh 40. Balances fixed cost. Clear? Any doubts on this? Any one level you can take. Now let's go back to the calculation. Any doubts on 2 rupees and 2 lakh rupees? Factory overhead. Any change they have given variable factory overhead? How much increase? 5% increase into 90,000. Any change in variable cost means a change in variable cost per unit. Same way with this fixed factory overhead, what is the change? 2 lakh plus 10%. 2 lakh 20. 2 lakh plus 10%, 2 lakh 20. 2 lakh plus 10%, 2 lakh 20. Any doubts on this? Clear? Please analyze note 2, selling overheads. Selling overheads. Selling overheads. 4 per unit and 1 lakh rupees. Logic remains same. Change in cost by change in units. You do that, you will get to the number 4 per unit and 1 lakh rupees. We go back to the main calculation. Any doubts on 4 and 1 lakh? We go to the main calculation. Selling overhead. Any change in variable selling overhead? 4 plus 10% into 90,000. And this side 1 lakh plus 15%, 1 lakh 15,000. 1 lakh plus 15%, 1 lakh 15,000. Any doubts on this? Next item is admin overhead 160, 160, 160. It is fixed in nature. Admin overhead fixed in nature 1 lakh 60 plus any change 15%. That's all. Put the total, add profit, get sales, and separately calculate contribution. Contribution sales minus variable cost. Put total. That's all. Total variable cost. Total variable cost. 36 lakh 45,000. Total fixed cost 5 lakh 19,000. Total cost, add profit, total sales, and then next line item contribution. Total cost is 4164. Some profit number they have given in the question. 25% of what? Cost itself. So 4164 of the cost itself into 25%. 10 lakh 41,000. 52 lakh 5,000. Contribution is 52 lakh 5,000 minus 3645. Sales minus variable cost. 15 lakh 60,000. Any doubts in this? Contribution is 15 lakh 60,000. Clear? Can I proceed? Any doubts in this? Go through 3. Okay. If factory is currently working at 60% capacity, produces 12,000 units of a product, management is thinking to increase the capacity either to 70 or 90. 60% is 12,000, 70% question mark, 90% question mark. It's estimated that it will be able to sell all the produced units. Some changes will happen on the selling price and raw material cost, and they have given the breakup of today's cost. Today material is 200, labor is 60, factory overhead there's a fixed component and a variable component, admin and selling overhead there's a fixed component and a variable component. We are required to calculate the profits of the company at 60, 70 and 90%. Let's start. Flexible budget at 60% capacity, 70% and 90%. 60, 70 and 90% capacity. Particulars in three columns. 60% capacity, 70% capacity, 90% capacity. 60, 70 and 90. 60, 70 and 90. Number of units. We'll start with that. Number of units. 60% is 12,000. 60% is 12,000. 70% is 14,000. 18,000. Variable costs. Leave some space. Fixed costs. Let's start item by item. First is variable cost. One of the variable cost is material is variable, labor is variable, there is a variable factory overhead and there is a variable selling overhead. Material cost 12,000 into 200. 12,000 into 200, but there will be some changes at 70% and 80%. Sorry, 70 and 90. It will not be 200, some changes they have said. Raw material cost increases by 4% and 5%. Increases by 4% and 5%. 208. 4% increase. And 5% increase. 37 lakh 80,000. Labor cost. Labor cost again is variable in nature. If problem is silent, material, labor, everything is variable cost. Labor cost, how much they mentioned? 60. 12,000 into 60. 14,000 into 60. And 18,000 into 60. 12,000 into 60, 14,000 into 60 and 18,000 into 60. Clear? Next item is factory overhead. Factory overhead. Let's write the variable component here. 12,000 into 30 and fixed component in the fixed cost. Fixed is 12,000 into 30 because this is calculated on a base of 12. Normally fixed is on the full capacity, but this is calculated using 12,000 units. This is 3 lakh 60. Other one 14,000 into 30. 4 lakh 20. 18,000 into 30. And fixed factory overhead, same 360 copy paste. Same 3 lakh 60 copy paste. Fixed factory overhead, same 3 lakh 60,000 copy paste. Clear? Any doubts on this? Same 3,60,000 copy paste. They have not mentioned any change and all. You close the admin and selling over it and then refer the screen. Admin and selling over it. 288. 2,88,000. Any doubts on this? Clear? There's one more cost. What is the other cost they have incurred? Advertising cost. How much? 20,000 if you do it above 80% capacity. That's all. Total variable cost. Sales is 12,000 into originally price is 400, and in the rework scenario there is a reduction in selling price. Selling price falls by 3% and 4%. So we will go ahead with the 90% capacity level because that gives us the maximum profit. 90% capacity gives us the maximum profit. Any doubts on this? Clear? Can you proceed? Any doubts on this part? Maximum profit is made at 90% capacity. Hence, we will go ahead with that. Go through 4. Okay. Aman International School has a total of 180 students consisting of 6 sections with 30 students per section. The school is planning for some trip. A private transport operator has come forward to lease out the bus. Each bus will have a capacity of 50, excluding 2 seats reserved for the teachers. The school will employ 2 teachers, paying them 500 per teacher. So every bus will have 2 teachers, and for the teachers, we have to pay 500 per teacher. Cost per student, breakfast, lunch, tea, entrance fee, all these are technically variable cost. All these are variable cost. Other cost, rent, special permit fee, block entrance fee, all these are fixed cost. But fixed cost can change. How it can change? Rent can change based on the number of buses. Permit fee can change based on the number of buses. Teacher allowance will change based on the number of buses. Block entrance fee will remain same. Prices will remain same. A flexible budget is estimating the total cost for 60 student, 90 student, 120 student, 150 student, and 180 students. So they've asked us to do the calculation for 60 till 180. Compare the average cost at these level. What will be your conclusion regarding the break-even level if the school proposes to collect 400 per student? Let's start doing it. Flexible budget for 60. I don't want to do 90, 60, 150, and 180. Just three levels is fine. 60, 150, and 180. Others are not needed. Particulars 60 students, 150 students, 180 students. 60, 150, and 180 students. Variable costs, self explanatory. Breakfast, lunch, tea, entrance fee. You can keep writing them. Breakfast. Refer the screen if you want. These are your variable cost. Let me know if there are any doubts in any of these numbers. Variable cost 10,800, 27,000, 32,400. 60 students, 150 students, and 180 students. Any doubts on this? Clear? Fixed costs. Fixed costs. In the fixed cost, we have rent. If we have 60 students, how many buses will be needed? 2, 6,500 into 2. And if you have 150 students, 3, 120 students, 120, 120. 120, if we are not doing 120, I'm asking if 120, how many buses? 3. 120 also 3 buses, 150 also 3 buses, and 180 will need 4 buses. 6,500 into 3 buses. So it is a fixed cost, but it keeps changing. It is a fixed cost, but it keeps changing. We saw in marginal costing one question where we said that the fixed cost can change. We used to do tentative break even and then final break even. Rent done. Next is special permit fee. 500 per bus. So 500 into 2 buses. 500 into 3 buses. 500 into 4 buses. Teacher allowance, which depends on the number of buses. One bus will have two teachers, and each teacher is paid 500 rupees. 1000 into 2. 1000 into 2. 1000 into 2 into 3 and into 4. Teacher allowance. Apart from that, block entrance fee. Block entrance fee 2500. Prices 500. Prices 500. Total fixed cost. Prices 500. Total fixed cost. Total fixed cost. Fixed cost by nature should remain same, but it is increasing because of the increase in buses. Fixed cost is increasing because of the increase in number of buses. Total cost, number of students and cost per student. They've asked us to calculate cost per student. Total cost, let me know if you get anything different. 496, 360 and 374. Clear? Any doubts on this? What question I said is compare the average cost. What will be your conclusion regarding the break even point if the school proposes to collect 400? Collecting 400 here, 60 students means I'll not be breaking even. Whereas 150 students I would have broken even at some point of time because 400 I'm going to collect. 374 cost again I'll break even. So we have to calculate break even point. Break even point formula is fixed cost by contribution per student. But the problem is the fixed cost will keep changing. And fixed cost keeps changing based on the number of buses. We will do break even point with four scenarios: 0 to 50 students, 51 to 100, 151 to 200, or we can directly do 51 to 100. 0 to 50 not needed because minimum is 60 students, assuming minimum 60 students will be there. Ignoring 0 to 50, 51 to 100 one calculation, 101 to 150 one calculation, 151 to 200 one calculation. In that we will see where is the break even point happening. It could be falling in the class interval, that's break even. If it's not falling, then it is wrong. Next, computation of break even point. Particulars in three situation. Particulars 51 to 100, 101 to 150, 151 to 200. Fixed cost can be any of these level. 51 to 100, 101 to 150, 151 to 200. Total fixed cost. total fixed cost. If it's 60 students, we had 19,000, which is 51 to 100 representative, two buses, three buses, four buses, two buses, three buses, and four buses. 19, 27, and 35. Two buses, three buses, and four buses. Contribution per student 400 minus variable cost is 50 plus 100 plus 10 plus 20, 180 rupees. Break even point could be valid, could be invalid. If it falls in the class interval, it's valid, otherwise it's invalid. All the three are valid break even. All the three are valid break even. Now it's a unique kind of a situation. What happens is, when I take the second bus, I'll break even at 86 students. That is, if I'm taking the second bus, 60 students and all is not sufficient. 86 students I need. 86, 90, 99, 100. If 101 student come, I will again get into loss making situation, because for that one extra student I have to take a bus and I'll get into loss making. Then again I'll break even at 123 student. After 123 again we will earn profits. At 150 we would have made profits. 151 we will start making losses. 151 we will make losses. 159 break even will happen. So break even, three times break even will happen. If I'm taking two buses, minimum 86 students I need. Less than 86 I will not take two buses. And if I'm taking three buses, minimum 123 students I want. And if I'm taking four buses, minimum 159 students I want. If you see the calculation here, cost per student, 90 students 391, which means you would have broken even. 400 you are collecting, but 60 students no break even. 120 students no break even. 405 means break even did not happen, because 123 is the break even point. 150 is okay, 180 is okay. But if the final number is going to be 60 students or 120 students, I will reject it. I don't need 60 students or 120 students. I need 90 students, 150 students or 180. Two buses, minimum 86 students. Three buses, minimum 123 students. Four buses, minimum 159 students. Clear? Go through the next question. Okay. BT Limited achieves a sale of 73,12,500 with COGS of 40%, operating at 75% capacity. COGS is 40% and operating at 75% of the capacity. I'm not going to do any admin cost calculation, no selling cost calculation, no distribution cost calculation. Only thing we will calculate is sales and COGS. Once that is done, it says office salary 1170, 1170, 1170. General expense, whatever is the COGS for different capacity, 5% of that. 97,500, 97,500, 97,500, 113,750, 113,750, 113,750. Salaries depends on sales. So you'll have to calculate sales and COGS for 85% capacity, 100% capacity, and 115% capacity. Let's start. Computation of sales and COGS for 85%, 100%, and 115% capacity. Particulars in four columns. First column is 75% existing number. Particulars 75%, 85%, 100%, 115%. Question has talked about more than 100%. Okay, whatever they say, 75, 85, 100, and 115. Sales, sales. How much the sales at 75%? 73, 12, 500. They have not talked about any changes in sale figure and all. So 73, 500, 73, 12, 500 divided by 75 into 85. Divided by 75 into 85. Divide by 75 into 85. 82, 87, 500. Divide by 75 into 100. And into 115. 1 crore 12 lakh 12,500. Sales figure. COGS is how much? 40% of sales. Again, no changes. So just take 40% of this. 29, 25, 33 lakh, 15,000, 39 lakh, 44 lakh, 85,000. Any doubts on this? Once this is done, various items have been given. You just need to keep multiplying and then writing them and then put a total. Three budgets they've asked: 85%, 100%, and 115%. The starting part is sales and COGS. Starting is sales and COGS. Once that is done, you can keep adding numbers. Clear? Any doubts on this? With this, my flexible budget discussion gets over. Now we have to do functional budget. Functional budget starting is sales budget. Based on sales, we decide production. What is production? Is sales plus closing stock minus opening stock. Based on production, we calculate raw material consumption. Production into input by output ratio. Based on raw material consumption, we'll calculate raw material purchase, and production will separately give something called as a manpower budget. Production will separately give manpower budget. Go through question 6. Okay. A single product company estimated its sales for the next year quarter wise as under. Sales is given in the question. Always starting is sales. Sales is given. If sales is not given, we use the formula of marginal costing, profit plus fixed cost by contribution per unit, and get to know what should be the sales. Opening stock is 10,000. Company wants to maintain a closing stock of 16,250 at the end of the year. Production pattern is 80% of the sales in the current quarter, 20% of the sales of the next quarter. Normally production is equal to sales plus closing stock minus opening stock. Here production is 80% of current quarter sales, 20% of next quarter sales. Similarly, raw material opening stock is given, closing stock is given. Company proposes to purchase the entire annual requirement in the first 3 quarters. Production budget in units, raw material consumption budget in quantity, raw material purchase budget in quantity and value, price toast ledger, which I am not going to do, which is first in first out method, price toast ledger, which needs to be done. Let's first start with production budget. Working note 1, production budget, particulars in 4 quarters. Quarterly they've asked, particulars in 4 quarters. Normally production is equal to sales plus closing stock minus opening stock. Here they have given little differently. Particulars in 4 quarters. Particulars in 4 quarters. 80% of current quarter sales and 20% of next quarter sales. That is the production. 80 only quantity they've asked. If nothing is mentioned, we have to do quantity and value. 80% of current quarter sales, 20% of next quarter sales. Q4 alone you will get stuck. I'll explain that. First let's do 80% of current quarter. First quarter, how much the sales? 30,000 into 80%, 24,000. 37,500 into 80%, 30,000. 41,250 into 80%, 33,000. 45,000 into 80%, 36,000. 80% of current quarter sales. Next is 20% of next quarter. Next quarter is 37,500 into 20%. 37,500 into 20%. 41,250 into 20%. 45,000 into 20%. We will get stuck here. Quarter 4 we will get stuck. 45,000 into 20%. Any doubts till this? 80% of current quarter, 20% of next quarter. Next quarter means next year I need. Below this, annual production is equal to annual sales plus closing stock minus opening stock. Annual production is equal to annual sales plus closing stock minus opening stock. We are doing annual calculation, that is quarterly calculation. Tell me the sales of all the 4 quarters put together. 153, 750. 30 plus 37 plus 41 plus 45. 153, 750. I know the closing stock at the end of the year. I know the opening stock at the beginning of the year. End of the year closing stock, you know. Opening stock beginning of the year. Quarterly we don't know, but yearly I know. What is the closing stock at the end of the year? 16,250. Opening stock. Now let's go up here. 31,500. 38,250. 42, and this is balancing figure. 160 minus balancing figure. 160 minus the quarterly production. How much? 48 250, and this is 12 250. 48 250. 48 250. Normally, production budget is sales plus closing stock minus opening stock. You will see this in many questions we do. As we do, you will see that. But here, production is equal to 80% of current quarter and 20% of next quarter. 80% of current quarter and 20% of next quarter. Any doubts on this? Clear? Can you proceed? Working note 2. Raw material consumption budget. They ask production budget, then consumption budget only quantity, production budget in units, consumption budget in quantity, purchase budget in quantity and value. Raw material consumption budget, particulars in 4 quarters. Particulars in 4 quarters. Particulars in 4 quarters. Consumption budget is dependent on production. Consumption budget is dependent on production. So first line item production, and then some input output ratio would be given, that will give raw material consumption. Starting is production here. Production, starting is production. Production, input output ratio. Input output ratio, basically how many units of raw material is needed. It says each unit of finished product requires 2 kg of raw material. Each unit of finished product requires 2 kg of raw material. 2 is to 1. 2 is to 1. Raw material consumed. Production into input by output, 31,500 into 2 by 1. Sixty-three, 76, 500, 84 and 96, 500. Production into input by output. Production multiplied with input output ratio. Any doubts on this? Then the question says raw material purchase budget. Now what purchase budget says is the company, for purchase also our normal approach is, what we do is, in the normal approach we calculate the consumption, add closing stock, deduct opening stock. Here they have not given closing stock, opening stock and all. They said the company proposes to purchase the entire annual requirement. So quarter wise I don't know the closing and opening. Yearly I know. What is yearly? I know in the year closing stock will be 5,000 kg. Beginning of the year is 10,000 kg. So first we will get the annual purchase quantity, and then we will get quarterly, because whatever you want to buy, first quarter 30%, second quarter 50%, third quarter 20%, 30, 50 and 20. Next, raw material purchase budget. Raw material purchase budget. Purchase budget. Annual RM purchased is equal to annual RM consumed plus closing stock minus opening stock. Consumption plus closing minus opening is purchase. It's basically consumed is equal to opening stock plus purchase minus closing stock. That formula goes to the other side. Total of all the 4 quarters consumption. 63, 76, 500, 84, 96, 500. How much? 3 lakh? 20,000. 320 plus closing is how much? 5,000 kg, 5,000 kg plus closing is 5,000 kg minus opening 10,000, 3,15,000 kg, 3,15,000 kg. Any doubts on this? 3,15,000 kg. Clear? Next is particulars and 3 quarters. Purchase happen only in 3 quarters here, not in 4 quarters. Particulars in 3 quarters we will do the purchases. They want both quantity as well as value. Quantity purchased, purchase price, value of purchases. Quantity purchased, purchase price, and value of purchases. Value of purchases. Now, what question says is my entire annual requirement is purchases 30, 50, and 20 in the first 3 quarters at a price of 2, 3, and 4. At a price of 2, 3, and 4. I'm purchasing it and then I'll be consuming. I purchase in the first quarter, consumption in the first quarter, purchase second, consumption, purchase third, consumption third, and only consumption in the fourth. That is your price to ledger. So this is 3,15,000 annual requirement into 30%. 30% in the first quarter. Then into 50% into 20%, 30, 50, and 20, 30%, 50%, and 20%. Purchase price given is 2, 3, and 4. 2, 3, and 4 is the purchase price. Once we multiply, we'll get the value of purchases. 1,89,000, 472,500, 252. Clear? Any doubts on this? Done? This is your price to ledger. Every quarter purchase, consumption, purchase, consumption. FIFO method, you have to do lot wise tracking and then keep writing it. Go through 7. Okay, let's go through this. A company is engaged in the manufacture of three products. The sales will happen in the ratio of 3 is to 4 is to 2. This will be a very important information. 3 is to 4 is to 2. Selling price, material cost, all these are material cost, variable overhead, labor cost. Laborer work 8 hours a day for 25 days a month. Opening stock of subassembly is given. Subassembly is the raw material. Sorry, subassembly is the finished product, because these three are my finished product, and components, which is the raw material. Fixed overheads is 757. Monthly profit target is given. First requirement is sales budget. Sales budget in quantity and value. Normally sales budget will be given, but they have not given sales budget. How will I get sales budget? Is by using the formula sales to achieve desired profit. This formula, you will do profit plus fixed cost, get contribution divided by contribution per unit will give you the sales in units. The problem is we will have three different products, so we'll have to do composite contribution per unit. Let's start. Question 7. Contribution per unit calculation, I'm not spending time. Let's directly look at the numbers. 96, 130 and 62. Contribution per unit is 96 rupees, 130 rupees and 62 rupees. That is not going to take that much of, it's a very fairly simple thing. 96, 130 and 62. Now right, note 1, computation of number of units to be sold. Number of units to be sold. Composite contribution per unit is equal to composite contribution per unit is equal to 96 into the sales mix is 3 is to 4 is to 2, 3 by 9 plus 130 into 4 by 9 plus 62 into 2 by 9. To avoid rounding off, I'll write 103.555. 103.5555. Just to avoid the rounding off part. 103.555. They have not given the units to be sold, so we'll have to calculate that first. Sales to achieve desired profit is equal to desired profit plus fixed cost by contribution per unit. We had three different numbers, we clubbed them and made it a single number. Desired profit plus fixed cost by contribution per unit. What's the desired profit? 12 lakh. Fixed cost 757, 200. 18,900 units. Now we'll prepare 18,900 we have to sell, that we will split in the ratio of 3 is to 4 is to 2. That's the sales budget. 18,900 units need to be produced by the company. 18,900 units need to be produced by the company. Need to be sold by the company. 18,900 units need to be sold. Note, working note 2, sales budget in quantity and value both have been asked. Particulars in three products. Particulars in three products. units to be sold, 18,900 into 3 by 9 into 4 by 9 and 2 by 9. 3 by 9, 4 by 9 and 2 by 9. 3 by 9, 4 by 9 and 2 by 9. Selling price, selling prices, how much the price? 520, 500, 350. Sales, 32 lakhs 76,000, 42 lakhs, 14 lakh 70,000. Clear? Working note 3, production budget, only quantity is asked. Production budget, only quantity is asked. Particulars and 3 products. Sales and production budget is for the finished product and other budget is for the raw material. Particulars and 3 finished products. Production budget quantity. Sales, add closing stock less opening stock. Sales, add closing stock less opening stock. Production, copy paste the number. Sales, add closing less opening. Production, 6,300, 8,400, 4,200. Sales, add closing less opening. Opening is given in the question. How much is the opening? 800, and closing is going to be 10% lower than the opening. The company is eager for a reduction of closing inventory by 10%, by 10%. So 720, 10% less, and this will give you the production number. Production budget. Now, based on production budget, we'll get component usage budget. What is component usage budget? Is raw material consumption. Component is raw material here. And we have 4 components here. Baseboard, IC8, IC12, IC26. All are basically components. All are components. In the below table, they've said component is baseboard, IC8, IC12 and IC26. Next, raw material consumption budget. Raw material consumption budget, or whatever name, component usage budget. Component usage budget, particulars and 4 columns. Sales and production is for finished product, these are for raw materials. Particulars, baseboard, IC8, IC12 and IC26. Particulars and 4 columns. Baseboard, IC8, IC12 and IC26. Now my component is based on production and I have three different types of production. So first you will write RM, or you can write for ACB, for ACB production input output ratio raw material consumed, for ACB, then for MCB, then for DP, and then finally you'll have to put a total. So it's a multi-product situation. Only fill IC8 column, other columns I'm not filling it. 6220, production is 6220, you can write in all the four. But after that we will only fill IC8. We'll only fill IC8. Baseboard IC12, IC26, I'm not filling it. What is the input output ratio between ACB and IC8? 8 units of ACB is needed for 1 unit of ACB. 8 is to 1. Multiply 6220 into 8. 49,760. For MCB, for MCB, production input output ratio RM consumed. Production is 8280. 8280. Input output ratio is MCB and IC8 is 2 is to 1. 16,560. 16,560. Then for DP, again production input output ratio RM consumed, and in the end overall RM consumed. In the end overall RM consumed. Production is 3920. 3920. 3920 was the input output ratio. 2 is to 1. 7840, and then put a total. 74,000. 0. Check the total again. Yeah, 74,160. 74,160. 74,160. Question has asked for only quantity, so quantity is done. Next is component purchase budget. This budget ideally has to be done for all the four. Same four columns will open, but we'll do only IC8. Particulars and four columns, but we can do only IC8. Others we have not done the calculation. Component purchase budget. Component purchase budget. Purchases depend on consumption. Consumption, add closing stock less opening stock. RM consumed, add closing stock less opening stock. RM purchased. RM purchased 74,160. 74,160. 74,160. Closing stock is, opening stock is opening is 1,200. Opening is 1,200. Closing is 10% less, 1,080. Purchase price value of RM purchased, purchase price and value of RM purchased. This product purchase price is 20, 14 lakh 80,800. Separately, the purchase budget, separately the production budget can give something called as manpower. Sales gives production, production gives consumption, consumption gives purchase. Production parallelly can give something called as labor budget. Working note 5, manpower budget, manpower budget. They've asked for manpower budget showing the number of workers and amount of wages payable. There are two types of workers, grade A and grade B. Particulars, grade A, grade B. Grade A and grade B. Based on production, will prepare a manpower budget. Grade A and grade B. Same thing. You will have to write this again for ACB, for MCB, for DP. You have to write this again. For ACB, it's all based on production. For ACB production, hours per unit, hours needed. For MCB production, hours per unit, hours needed. Hours per unit, hours needed. We'll only do grade A. No need to do grade B. Hours needed, overall hours needed. We'll only do grade A. Production, hours per unit, hours needed. Only grade A. Six two two zero, 6220, that's the production. How many hours needed for grade A? 8 hours. Multiply 49,760. 49,760 hours. Then MCB production is 8280. How many hours? 6 hours. 49,680. Then the last product 3920. Hours per unit is 4. 15,680. And the total now. 1,15,120. 1,15,120 hours are needed. The purpose of doing this calculation is to get to know how many employees are needed, which we'll calculate now. Any doubts on 115, 120? Any doubts on this? Next, working hours per employee. One employee will work for 25 days, 8 hours a day. 25 days and 8 hours a day. 25 into 8. Divide number of employees. 575.6 rounded off to 576. Even if you get 575.1, it has to be rounded off to only 576 because I need that extra 0.1 employee. 575.1 also 576 only, and 575.9 also 576 only. 575.6 employees we need, so totally we need 576 employees. Question wanted number of employees and amount of wages payable. Next, employee cost per month. Employee cost per month, and then total wage cost. Employee cost per month, Grade A workers will work for 200 hours and we pay them how much? 5 rupees. So 1000 rupees will be paid to every employee. 200 into 5. 200 into 5. 200 into 5,000. 576 into 1000. 5,76,000. 5,76,000. Clear? Any doubts in this? 576 into 1000. 5,76,000. Worker A, 576 employees are needed. If you look at worker B, that rounding of adjustment you will see here, it is, if you divide 230, 240 by 200, you will get 1151.2 rounded off to 1152, 1151.2 rounded off to 1152. Clear? Any doubts on this? Done. Take it. Let's take a break of 15 minutes. Okay, let's proceed. Let's come to question 8. Go through the question. It's an MCQ based question. Go through this. Let's look at the question. It's an MCQ based question. There are a lot of requirements. Let's first understand. It produces product P. Cost accountant has to prepare the budget. Sales is given. With sales, we'll get production. From production, we will get raw material consumption of Q and R. And from raw material consumption, we'll get raw material purchase. That will answer part 1. That is question 11. Question 14 and question 15. Apart from that, you have to calculate variable cost of production and budgeted net income. Net income is profit for the year. So that will also need to be done. Let's start working note 1, production budget. Production budget, particulars and units, sales, add closing stock, less opening stock, production. Sales, add closing stock, less opening stock, production. What's the sales number? 1 lakh. Closing and opening is given directly. 15,000 minus 12,000. Production is This will answer one of the MCQ requirement. Production is 1,03,000. Working note 2, raw material consumption budget. Raw material consumption budget. Particulars and two raw materials are there. Particulars, two raw materials. Material Q and material R. Q and R. Based on production, we will get raw material consumption. Production 1,03,000. Input output ratio. Input output ratio. For the first product, 3 is to 1, 3 kgs of raw material. Second product, 4 is to 1, 3 is to 1, and for each unit of product, we requires 3 kgs of raw material and other needs 4 kgs. 3 is to 1, 4 is to 1, raw material consumed. 309 and 412. 309 and 412. Based on raw material consumption budget, raw material purchase budget. I'm just doing quantity, value if needed will depends on the MCQ requirement. Let's first do only the quantity part. Value will be needed for this, but that will directly write. Raw material purchase budget. Consumption, add closing stock less opening stock. Consumption, this came as a 10-mark MCQ in exam. Add closing stock less opening stock. RM purchased. Consumed, add closing less opening, RM purchased. Three 309 and 412. Closing is given. 26 and 36. We get the RM purchase quantity. What's the purchase number? Sorry, 3,03,000 and sorry, 4 lakh 4,18,000. This will answer some of the MCQ requirement. Apart from that, they wanted profit statement and cost of producing 1 unit. We had to calculate cost of producing 1 unit. It says, let's answer the requirement. Total cost of material Q. How many units of Q we are buying? 303 into 2. 303 into 2, 6 lakh 6,000. 12 and 13 we'll see in some time. Units to be produced of P is 1 lakh 1,03,000, and R to be purchased is 4,18,000. So all these parts are done. 12 and 13, they have asked us to calculate what is the variable cost of producing an unit, only variable cost of producing an unit till manufacturing cost, and what is the budgeted net income. Let's start. Working note 4, variable cost of production. Variable cost of production. Cost of production is equal to, I'm not doing it as a statement and all, cost of production is equal to, first is raw material cost, 3 kg into 2 rupees per kg. 3 kg into 2 rupees per kg. 1 unit we are doing. Each unit of product P requires 3 kgs of raw material Q, 4 kgs of raw material R. 3 into 2 plus 4 kg into P. 3 into 2, 4 into 3. Apart from that, there's a raw material cost. So there is a labor cost. How much is the labor cost? It requires 10 minutes of direct labor to produce 1 unit of product P. 10 minutes. 10 minutes, 50 per hour. Tell me the cost of 10 minutes then. 50 per hour, 10 minutes. 8.33. 50 rupees into 10 minutes. And the last one was variable manufacturing overheads 10. Fixed and all will not come. That they've asked only to calculate variable cost of production. Variable cost of production 3 into 2 plus 4 into 3 plus 50 into 10 by 60 plus 10. How much? 36.33 per unit. Only the variable cost. 36.33 per unit. 36.33 per unit. Any doubts on this? Clear? Working note 5. Net income computation. Net income computation. Net income is basically profit. Net income is based on the sales. Now, right, net income is equal to how many units we are selling? 1 lakh into what is the selling price? 50 minus 36.333, you write, because that will make a difference. 50 minus 36.3333. From there, subtract the fixed cost. From there, you have to subtract the fixed cost minus 3 lakh minus 25,000. 3 lakh and 25,000. 10 lakh 41 667. 1041 667. Clear? So net income is 1041 667 and this was 36.33. 36.33. Any doubts on this? Clear? Can you proceed? Go through question 9. Let's understand this question. This is on something related to wastage and rejection. G Limited manufactures two products, M and N. Both products use a common raw material Z. Raw material is purchased at 72. The company has decided to review inventory management policy. Following forecast has been extracted. Sales is given. Finished goods increase by year end. Increase by year end is add closing minus opening. Increases closing minus opening figure. Directly they have given closing minus opening. Post production rejection rate. So we'll have to see how to give effect to rejection. And there is some wastage which is also given. Raw material wastage is given. Production rejection is given. Usage of raw material is constant. Annual cost of holding raw material, cost of placing an order. EOQ is asked in the question. We are not going to do the EOQ part. That is materials chapter. Prepare functional budgets under the following heading: production budget for M and N, purchase budget for material Z, calculate the EOQ, which we are not going to do, and there is some sole supplier condition. What happens because of that? We'll see. Working note 1, production budget. Production budget. Production budget. Particulars and two products. Product M and product N. Production, sales, sales 28,000, 13,000. Stock increase by year end. Stock increase by year end. What is stock increase by year end? Is closing minus opening. 320 and 160. Stock increase by year end 320 and 160. Good production needed. Why we use the term good production? You'll understand in some time. 13 160. Good production needed. Provision for wastage. Final production or rejection. Provision for rejection. Final production. Provision for rejection and final production. Final production. Now the question has said it is talking about post production rejection rate of 4 and 6%. So let's take final production to be 100 slash 100. 100 for the first product, 100 for the second product. Rejection is 4 and 6, which means good production is 96 and 94. 96 equal to 28, 20, 4 equal to question mark. 94 equal to 13 160, 6 equal to question mark. 96 equal to 28 320, 4 equal to question mark. 94 equal to 13 160, 6 equal to question mark. What's the number you get? 1180. Other one 840. So we'll have to produce more. We have to produce more because of the rejection. How much is the production? 29,500 and 14,000. Any doubts on this? Working note 2, raw material consumption budget slash purchase budget. Both are same here, no opening and closing stock data. Raw material consumption and purchase is same. Particulars calculation amount. Raw material consumption slash purchase budget. Particulars calculation amount. Consumption slash purchase budget. Particulars calculation amount. Particulars calculation amount. Now the questioner says that I will be using 5 kg and 6 kg, but there is some wastage also on the raw material side. On the raw material side, product M, for product M, good raw material needed, provision for wastage, good raw material needed, provision for wastage, final raw material needed. Good raw material needed, provision for wastage, final raw material needed. Final raw material needed. Good raw material is 29,500 units into 5 kg. 29,500 units into 5 kg. 147,500. 29,500 into 5 kg, 147,500. The problem here is there is going to be wastage. So final RM needed 100. Wastage is how much? 10. Good RM needed is 90. 16,389. 163,889. 163,889. For product N, for product N, good RM needed, provision for wastage, final RM needed. Good RM needed, provision for wastage, final RM needed. What is the production of this product? 14,000 into 6 kg, 84,000. Final RM needed is 100. Provision for wastage is 5. Good RM needed is 95. 95 is equal to 84,000. 5 equal to question mark. 4421, 88, 421. Clear? We had to apply the wastage percentage on the raw material as well as on the production side. Also on the production side. Total RM needed. Total RM needed 163,889 plus 88,421. 252,310. 252,310. Clear? Any doubts on this? 252,310. Clear? Now, question had asked for purchase budget for quantity and value. Okay, let's do the value also. Purchase price and value of purchases. What is the purchase price? Raw material purchase price is how much? Right? 72. 1 crore 81 lakh 66,320. Any doubts on this? Clear? Now, apart from this, we have to go ahead and calculate economic order quantity, which I'm not doing. EOQ square root of 2 into annual demand into ordering cost per order divided by carrying cost per unit per annum. Next, if there is a sole supplier for raw material Z in the market and the supplier do not sell more than 4,000 kg of material Z at a time, supplier does not sell more than 4,000 kg at a time, and I have a policy of not placing more than 40 orders in a year. Now, because of this, what will happen? I can buy only 40 into 4,000, 1 lakh 60. Whereas my requirement is 2 lakh 52,310. If raw material goes down, production will proportionately go down. Production will proportionately go down. Working note 3, production with raw material constraint. with raw material constraint, with raw material constraint, particulars, ideal and possible, ideal and then possible, ideal and possible, raw material needed 252310. Ideally, I need this much raw material 252310. Production of M, production of N. If I get 2,52,310, I will produce 29,500, 14,000. 29,500 and 14,000. 29,500 and 14,000. The problem for me is my policy says you can do 40 orders and supplier says maximum 4,000. I will get only 1,60,000. Proportionately, production will go down. If 29,500 is equal to 252, what is 160? Proportionate calculation. 252,310 is equal to 29,500. I cannot get that many raw material. 1,60,000 equal to question mark. 18,707. We'll have to cut down on the production side. We don't have a choice. I want to produce, but because of limitation, I'll have to cut down on the production side. 18,707. Cut down on the production side. Same thing here. 252,310 is equal to 14,000. 1,60,000 is equal to question mark. 8878. Clear? Any doubts on this? Clear? Go through question 10. Again, a good problem. Go through this. Okay. Concord Limited manufactures two products using two type of material, one grade of labor. Shown below is an extract of the company's working paper. Sales is given. Based on sales, we'll get the production. And material X and Y cost 4 per kg, 6 per kg. Labors. Overtime premium is 50% is payable if a worker works for more than 40 hours a week. There are 180 direct workers. Productivity or efficiency ratio. This we would have learned, you will learn in labor chapter, or you would have learned from there. You'll have to use this formula. By the direct workers is 80%. There is some non-productive downtime. There are 4 5 days weeks, and it's anticipated that sales and production will occur throughout the year. They've asked for material purchase budget and wages budget. But for material purchase, I need material consumption. For material consumption, I need production budget. So starting is production. Sales is starting always. Sales is given. So from sales, let's do production. Production, consumption. From consumption, get purchase. And production parallelly will give wages budget. Wages budget is very good in this question. Let's start. Production budget. Production budget. Particulars and two products. Product A and product B. Sales, add closing stock, less opening stock. Production. Sales, add closing, less opening. Production. 2400 and 3600. 2400 and 3600. Closing stock, they have said 4 days of sales. 4 days of sales. And the budget, what is given here is there are 4 5 days week. So whatever is given is for 20 days. Whatever is given is for 20 days. They want 4 days sales and 5 days sales. So 2400 equal to 20 days. Question mark equal to 4 days. Question mark equal to 4 days. 480 and 3600 equal to 20 days. Question mark equal to 5 days. 4 days and 5 days. 4 days and 5 days. 480 and 900. 480 and 900. Opening stock is 400 and 200. 2480, 4300. Based on production, I'll have to get the raw material consumption budget, and after getting the consumption budget only I'll be able to get the requirement of the question. So we have just got till the production budget. Clear? Working note 2, raw material consumption budget. This will be particulars and two raw material, and then for product A, for product B, input output ratio we have to do particulars, and two raw material. What are the two raw material here? Material X, material Y. For product A, below that, production, input output ratio, raw material consumed. Then for product B, production, input output ratio, raw material consumed. Total RM consumed. Total RM consumed. First product production is 2480, 2480, 2480 and 2480. What's the input output ratio between product A and material X? Product A and material X is 5 is to 1. Product A and material Y. Product A, material Y is 4 is to 1. 5 is to 1 and 4 is to 1. Product A, material X, product A, material Y. Product A, material X. This is the data. 5 is to 1 and 4 is to 1. Product A, material X, product A, material Y. 2480 into 5 and into 4. 12,400 and 9920. 5 is to 1 and 4 is to 1. Product B is 3 is to 1 and 6 is to 1. 3 is to 1 and 6 is to 1. 12,900 and 25,800. 25,300. Other one is 35,720. This also is not the requirement. Using this, we will now get the purchase budget. Requirement was to do purchase budget, but in order to get to that, we have to do all this calculation. Any doubts on the consumption budget? Working note 3, raw material purchase budget. Raw material purchase budget, particulars and two products. Particulars and two products. Raw material purchase budget. Start with consumption, RM consumed. Add closing stock, less opening stock, RM purchased. Question has asked for quantity and value both. Showing the quantity and value, purchase price, value of RM purchased. Be very clear on the formats. Once you are clear on the format, it is easy to do. RM consumed, add closing, less opening, RM purchased, value of RM purchased. Closing stock is defined in the question. What they've defined? 10 days of consumption. So 20 days equal to 25,300. 10 days equal to question mark. 20 days is 25,300. 10 days consumption. And this is 20 days equal to 35,720. 6 days equal to question mark. 10,716. Opening stock is 1,500. 1,500. Beyond this, it's a fairly simple adjustment. 1,500. Wages budget is one which is very tricky and good adjustment. 1,500. RM purchase figure is how much? 36,950 and 930. Purchase price is given in the question. Material X and material Y cost 4 rupees and 6 rupees. 4 and 6. One 147,800, 275, 616. 147,800, 275, 616. Raw material purchase budget. Any doubts in this? Clear? Next, working note 4. Manpower budget or wages budget, whatever name they have used. Wages budget. Wages budget. Particulars calculation amount. Wages budget. Particulars calculation amount. Wages budget. Now Normally, manpower budget will help us in calculating number of workers. This question, number of workers, is not the calculation. They are asking us to calculate something called as, here the requirement is wages payable, number of workers is given in the question. 180 workers are only there. Then what will we do? Some will be normal time, some will be overtime. That analysis needs to be done. First, for hours needed for product A, hours needed for product A, how many units of product A we are producing? 2480 into 2480 into 3 hours. We could have written like three separate rows. I'm written it directly, 7440. Hours needed for product B, for product B, 4300 into 5, 21500. Total standard hours needed. Why this term and all you'll understand. Total standard hours needed 28,940. Total standard hours needed 28,940. 28,940. 28,940. Now listen, it says the productivity or efficiency is only 80%. Productivity or efficiency is only 80%. That is, if you work for 100 hours, you will get only 80 hours of production. Efficiency formula you learn in labor chapter. Efficiency is equal to standard time by actual time. Standard time by actual time. There's another formula called actual output by standard output. So using this, I will now calculate how much time is needed. Next, write efficiency. Right here itself, right below, efficiency equal to ST by 80. 80% equal to 80% equal to 28,940 by actual time, and get the actual time. People are inefficient, they'll end up taking more time by 80%. 36 175. Actual time is 36 175. So actual time needed 28,940 divided by 80%, 36 175. 36 175. The scenario doesn't end here also. On top of it, they're saying there is a non-productive downtime. People were working earlier, but production was not happening fully. But now there is a non-productive downtime which is 20%. Add non-productive downtime 20% into ICI has taken it on 36 175. It's assumption because people did work for 36,000 hours. On that 20% are on 28,940. That's an assumption. ICI did this. We'll take same assumption, 7235. Total hours needed. Total hours needed. 43,410. 43,410. Now, in a normal question, once I get the total hours needed, what I will do is I'll divide by working hours per month and get number of employees. Here I have only 180 employees and they will do normal working for 40 hours a week. More than 40 hours a week, if you tell them to work, it is overtime, and this overtime you have to pay extra. Normal, you have to pay only, what is the labor rate per hour? Somewhere it would have been 20. Yeah, labor is paid at the rate of 25 per hour. But if you tell them to do overtime, you have to pay 25 plus extra 50%. So in this total hours, normal working hours, 180 employees into 40 hours per week into 4 weeks. 40 hours per week into 4 weeks. 28,800. Normal working hours 28,800. balances overtime working hours, overtime working hours, balances overtime 14, 6, 10, and finally labor cost. Labor cost. Question wanted only the labor cost. It was not the requirement to calculate number of employees here. 28,800, you pay 25 rupees, and extra you have to pay 37.5, which is why companies try to avoid overtime to the extent possible. 12 lakh 67,875. 1267,875. Overtime was done, and because of which we have ended up spending 1267,875. Any doubts on this? Yep. Can you proceed? Go through 11. Okay. Two, three good adjustments here. One is on the closing stock part, and second is the wastage analysis. DC Limited manufactures and sells two products, Super and Deluxe. DC Limited budget department gathered the following data. Sales is given, selling price is given, opening stock is given, closing stock is given as 10% of production. They have not given the closing stock directly. They've said it is on production. What happens, we'll see. And then two raw material is needed for the Super and Deluxe. Some wastage information is there, and inventory is there. Cost of opening stock, target inventory, some FIFO method analysis also will be needed. What is that? You will understand. Working note 1, production budget. Production budget. Working note 1, production budget. Production budget will be for the finished product. Production budget. Particulars and two products. Super and Deluxe. Sales, add closing stock, less opening stock, production. Sales, add closing stock, less opening stock, production. Add closing, less opening, production. 48,000, 72,000. 48 and 72. Now problem is closing stock is not known. It is 10% of production. Closing stock is not known. It is 10% of production. So come down for super 48,000 plus zero point 0.1 P. P is the production minus 3,900 is equal to P. 48,000 plus zero point 0.1 P minus 3,900 is equal to production. Once you get production, we'll fill it in the table. 48,000 plus zero point 0.1 P minus 3,900 is equal to P. P equal to, let's now get to that. Undo it for the other product also. For deluxe. For deluxe. First product 48,000 plus zero point 0.1 P minus 3,900 is equal to P. Second product 72,000 plus 0.08 P minus 7,600 is equal to P. P equal to 70,000. Let's go back here. 49 and 70. Let's go back here. Closing stock is 49,000 into 10%. 4,900 minus 3,900. We should get 49,000. Else some error in calculation. 70,000 into 8%. 49 and 70. 49,000 and 70,000. 49 and 70. Any doubts in this? This is the production budget. Based on production budget, we'll have to get the raw material consumption budget. Working note 2. Raw material consumption budget. Raw material consumption budget. Particulars and two products. Particulars and two products. The two raw materials are material A, material B, material A and material B. For product super, for product super, for product super, for product super, how many units of product super we are manufacturing? 49,000. What is the input output ratio between super and material A? 49,000 into 2. Super and material B. 49,000 into 3. Now this is the good raw material needed. There is a provision for wastage to be done. I can do the provision for wastage as the last line item here. I'm not doing it initially itself because the wastage percentage is same. When we did that earlier problem, the wastage percentage was different for one product and the wastage percentage was different for the other product as compared to the finished product. Next, for product deluxe, good raw material needed. Good raw material needed. What is the production of this product? 70,000 into 70,000 into 4, 2 lakh 80, and 70,000 into 2.4. Total good RM needed. Total good RM needed. 280 plus 98. 378. Other one, 3 lakh 15,000. 378 and 315. Provision for wastage. Final RM consumed. Final RM is 100, 100. Wastage, what is the percentage? Both are 4, 4, 4. Good RM is 96, 96. 96 equal to 378. 4 equal to question mark. 15,750. And this is 96 equal to 3 lakh 15,000. 4 equal to question mark. 13, 125. Put together you get 328, 125. Doesn't end here. They've asked quantity as well as value. Now, value, you cannot say that you'll multiply with the 60 and 80. That is wrong. Reason is opening stock is there, which is at 57 and 75. And current year you will buy at 60 and 80. And we are going to follow FIFO method. We are going to follow FIFO method. So consumption is opening stock into 57 and balance at the rate of 60. Balance at the rate of 60. We'll be buying more than that, but consumption FIFO method. FIFO method. First opening stock is consumed. Value of RM consumed. Value of RM consumed. 32,500 into 57 plus 32,500 into 57 plus 361 250 balance at the rate of 60. Balance at the rate of 60. Two crore 35 lakh 27,500. Similarly, here first you consume the opening stock, which is 28 800 into 75 plus extra is 328,125 minus 28 800. 299 325 into 80. 261 6,000. Any doubts on this? 261 6,000. Raw material consumed, directly just multiplying with one price will not help here. You will have to do 57 for the opening stock, 60 for the current year purchase. And we are following FIFO method. Weighted average means you'll have to do a weighted average and then do the calculation. Any doubts on this? Next, working note 3, raw material purchase budget. Raw material purchase budget. Raw material purchase budget. Particulars material A and B. RM consumed, add opening stock, less closing stock, add closing stock, less opening stock, RM purchased. And question has said only units, quickly close it. RM consumed is 393 750 and 328 125. Closing stock, the questioner says 10% more than the opening stock. So 32 500 plus 10%. 10% more, 35 750 minus 32 500. Other side it is 28 800 plus 10%. Plus 10%, 31 680 minus 28 800 was a 3 lakh 97,000. 31 005. In case question had asked for weighted average, then for price you have to take opening stock into opening price, purchase this quantity into purchase price, whole divided by both the quantity, and then get the price. Any doubts in this? Clear? Can we proceed? Go through this question 12. Last question in functional budgets. Okay. There's only one important thing to be discussed here. RS Limited manufactures and sells a single product. Sales revenues 302.4 lakh with a profit of 20% on selling price. Each unit of product requires 6 kg of metal A, 3 kg of metal B, processing time of 4 hours, 2 hours in assembly shop. Factory overheads is 20%, variable selling and distribution overhead, fixed selling and distribution overhead, purchase price, all that is given. Calculate the number of units proposed to be sold and the selling price per unit. So what is missing is the units to be sold. And here the formula is not sales to achieve desired profit. You cannot say desired profit plus fixed cost. What they have done is they have given the sale figure. This sale figure is has a profit of 20% on sales. So that will give you the cost figure. What is cost figure? Number of units into material A cost, material B cost, labor cost, overhead cost, all costs put together, you'll get the number, and somewhere units will become balancing figure. Units will become balancing figure. Working note 1, computation of units to be sold. Computation of units to be sold. Once that is done, then it's more of a formality. Units to be sold. Cost of sales is equal to sales minus profit. Sales minus profit. Sales equal to 302.4 lakhs. 302.4 lakhs. Profit is 20% of 302.4 lakhs. 241.92 lakhs. 241.92 lakhs. Now, what is this 241.92 lakhs? Is direct material plus direct labor, some factory overhead, something they've given, factory overhead, selling and distribution overhead, all put together is 241.92 lakhs, 2 crore 41 lakh 92,000. Then we'll write each of them. Direct material, direct labor, factory overhead, selling and distribution overhead, 2 crore 41 lakh 92,000. This is only for the units sold. We are not doing for the units produced. Units produced will be little different. Now, what is direct material is? It says each unit of product require 6 kg of material A. Number of units is taken as X. If number of units is X, my material cost is X. I call it as A. A into 6 kg into 160 rupees. A into 6 kg into 160 rupees. A is the number of units, not the raw material. A is the number of units. Then again A into raw material B, 3 kg, 100, 3 kg into 100. A into 6 kg into 160, A into 3 kg into 100. Then labor cost is 4 hours in machine shop, 2 hours in assembly shop. 4 hours in machine shop and 2 hours in assembly shop. So 4 into 140, let's do it. 4 into 140, 2 into 70, all put together how much? How much? 700. 4 into 140, 2 into 70. So labor cost is 700 A. Labor cost is 700 A. 4 into 140, 2 into 70. 4 into 140, 2 into 70. I could have done per unit calculation and done that would have been little better rather than taking A, but okay. 4 into 140 plus 2 into 70. Factory overheads is what? 20% of 140A, 20% of direct labor. 700A into 20%. 700A into 20%. 140A. 140A. Then selling and distribution is 60 per unit sold. 60A plus 60A plus 69 lakh 12,000. Please get the number of units. How much? 8,000 units. We'll just then quickly check the calculation. 8,000 units. 8,000 units. Now, quick check is, listen, my material cost is 960 rupees. 6 into 160. Labor cost is 300 rupees, which is 3 into 100. 700 rupees of, sorry, material cost is 960 and 300. Labor cost is 700. 140 plus 60. How much is this all put together? 2160 into 8,000. 2160 into 8,000 plus 69 lakh 12,000. 2 crore 41 lakh 92,000. Clear? Any doubts in this? So we are getting 8,000 units. Let's now do the budget. Working note 2, number of units to be sold and selling price. Okay, selling price also needs to be calculated, which is we'll divide and get it. Sales budget, particulars and amount, particulars and amount, units to be sold, units to be sold, 8,000 units, units to be sold, 8,000 units, selling price, selling price, 302.4 lakhs by 8,000. 3780 per unit. 3780. This is the starting. Without this, nothing much can be done. One question we did, sales to achieve desired profit formula. Here the sales is given. They have given the value. You have to do all the calculation. Next, production budget. All this is formality. You keep doing it. Refer the screen once you're done. You refer the screen after you're done. Production budget. Production budget. Do both production and material purchase budget and then refer the screen. Sorry, 8,000 and 5,500. 7,500 and 4,000 was the value. Any doubts on this? They've asked only units. The first thing we had to do was this calculation. Once this calculation is done, balance is more of a formality. Any doubts on this? With this, budgetary control discussion gets over. Primarily two areas. One is fixed versus flexible budget, and second is something called as your functional budgets. Now, I'm not starting with the next chapter now because I'll do only two questions, so I don't want to do it now. Tomorrow, we will start with service costing. We move to the next chapter. Tomorrow, once I complete it, I'll let you know what we are doing for the balance. Maybe I'll take one more day, that I'll update you tomorrow. So, today, we are kind of done till this. We are done with four chapters. Block 1 is fully completed. In block 2, we are done with budgets and budgetary control. Three more chapters are there in block 2, which is your service costing, material cost, and employee cost and direct expenses. Once, let's see tomorrow how much we are able to complete in that, and then we decide the balance areas. Clear? I'll end with this thing.